time, the question is, will it really happen? There you go. You get that sense of why this is going to be a pain point in that very narrow area. So Neeraj, this morning, it's all about fear and surprise. I mean, on Friday, we were talking about how Trump did say 2 weeks.
Yep, and maybe the taco trade is out because he's not doing that. In fact, he's doing everything but the opposite. But must say, guys, that this is a lot more well-behaved and a measured reaction by risk assets worldwide relative to what could have been feared on Sunday, because oil prices too maybe started off 5% higher, but are currently about a couple of percentage points to 2.5%. US futures are down but not out. Asia, again, down but not out, less than 1% for most of the Asian markets. So looking okay. Let's see what happens to Straits of Hormuz. I think that's the key thing, and what kind of retaliation comes in from Iran. Because remember, this morning, Iran government has been quoted as saying that the measure of the response will be decided in due course of time. Now, following reports of Iran's parliament approving a proposal to close the vital Strait of Hormuz, United States Secretary of State Marco Rubio spoke to Fox News, labeling such a move as an economic suicide for Iran. He further urged China to leverage its influence to deter Tehran, citing rising tensions in the region.
Well, I encourage the Chinese government in Beijing to call them about that, because they heavily depend on the Straits of Hormuz for their oil. If they do that, it'll be another terrible mistake. It's economic suicide for them if they do it. And we retain options to deal with that. But other countries should be looking at that as well. It would hurt other countries' economies a lot worse than ours. It would be, I think, a massive escalation that would merit a response, not just by us, but from others. So, look, they're going to say what they need to say. You know, these are the things that need to happen for their own internal politics and so forth. But in the end, we're going to judge them by the actions that they take moving forward. We had 3 objectives. We struck those 3 objectives with decisive force. And that was the point of this mission. And that's what we achieved. What happens next will depend on what they do. They want to negotiate. We're ready to negotiate. They want to get cute and do things that are dangerous. We have responses available that are devastating.
Okay, that interview last evening on Fox News. Well, Steve Englander is joining in. He's Global Head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank this morning. Steve, what a morning to be speaking, at least morning for us. So how worried are you right now? The Strait of Hormuz has never actually been closed in the last 5 or 6 decades, though they've threatened to do it several times. Is that now the biggest concern?
Well, I think it's the immediate concern to markets. And, you know, obviously the oil prices responded significantly, but it's nowhere near the levels that were feared if there was real disruption in oil markets. And as your colleague mentioned earlier, there's, you know, markets are, you know, the fat tail that has emerged from this war is not as fat as other episodes of geopolitical tensions. So there's things could get worse. They're far from pricing in the worst outcome, even though, you know, they're pricing in a lot of uncertainty at the moment.
Steve, so how big is this uncertainty? I mean, there are people on either sides. One set saying that, oh, is this the start of, or wondering whether this is the start of a larger conflict? And 2 saying that with the US wading in, this probably marks the beginning of the end. Which side are you on?
Well, you know, I wish I had the answer to that question. I think
the hypothesis, Steve.
Look, I think that there's incentives on both sides. I mean, overnight we saw that the Iranian attacks on Israel were relatively muted, you know, probably the lowest in a week. There's various signaling going on that may be looking for room to de-escalate. So, you know, we'll have to see how this plays out. I don't, you know, both sides can do damage to each other. The question is whether they want to at this stage or want to back off and you know, see what happens if, you know, they sort of give peace a chance, you know, in coming months.
What's the worst case scenario here, Steve? Just trying to understand from equity markets, because and all of these asset classes, because so far there seems to be a sense that it won't go further than this. But what would be the worst case scenario? What would be the best case scenario from here on?
I think that the best case scenario would be what I discussed now, that both sides decided that they've made their point, that they'll inflict damage without any gain on each other in the future if they persist. I think the worst case scenario would be that if it became a broader war, or if the Straits of Hormuz were blocked for an extended period. At the moment, I think global oil inventories are pretty high, so it might not be as big an immediate issue, even though there'd be some damage done. But I think the markets are being very careful not to really price in the worst case scenario here. So I think, unlike, say, immediately after Russia invaded the Ukraine, or we're seeing sort of limits to how much are being sold off. So I think that this is sort of a unique geopolitical event in which markets are the fat tails are not as fat as they generally are.
Yeah. That is, I think it's complicated. Thank you so much, Steve Englander, for speaking with us today. And I think that's the way to look at it. It's not yet clear how this will end, where this will fall. Ramesh Damani helping us wade through all of that, market veteran. Mr. Damani, always a pleasure to speak with you. Very good morning and very interesting morning. What are you making of all of the statements and the developments over the last 48 hours?
Yeah, good morning, and thank you for having me on your show. I'm generally having a more optimistic view of financial markets, given what happened over the weekend. I think another way to look about this conflict between Israel, America, and Iran is to look at bark versus bite. And clearly, I think events as they have unfolded have proved that Israel and America have bark and bite, whereas Iran has only bark. So in my sense is that it was a very monumental decision that President Trump made over the weekend, but it has completely changed the contours of the Middle East. And I think investors can look ahead to an area of peace, prosperity, FDI flows in the Middle East.
Wow.
So a lot source of the tension for the last 40 years is now dissipated.
That's an astonishing counter view, Mr. Damani. So you think that Trump has thought about it and is going to get away with it, and it's a calculated move to send in those B-2s and bomb those 3 sites?
I think so. Let's look at the evidence. I mean, forget what my view is. Let's look at the evidence. Within 12 hours of the fight starting, Israel had decapitated the entire leadership of Tehran, including the nuclear scientists and the generals. Within 48 hours, they had complete control over the airspace of Iran, complete control of the airspace of Iran. In fact, they sent 200 planes on the first day, and they came back unharmed. The U.S. sent its B-32 bombers. They came back unharmed. So my sense is Iran has a very limited capacity to retaliate. There might be a stray terrorist incident, a stray cybersecurity incident. We can't rule that out. But I would seriously doubt that. I think they're basically, as I put it in my earlier statement, they are more bark than bite. And I think the world will recognize that. And I think over time, may I just point you out to what is the most relevant index to look at this time? It is the Tel Aviv index, the TA-125, which made a new high on Saturday. It is up 5%. Last week it's up almost 40%, outperforming the Dow over the last 2 years since the Hamas attack happened on October 7th. So that market is telling you that there's a prospects of peace, prosperity that is within sight in the Middle East.
Ramesh, good morning. This is heartening to hear, and kind of the risk assets are showing that oil may have started off 5%, but just about couple of percentage points higher. My question is really that if Iran were to go ahead and do some tinkering at the Strait of Hormuz, and one doesn't know how short-lived it will be, would it just be a flash in the pan move, or could that be some deterrent for risk assets because oil prices may spike up, so on and so forth?
There would be knee-jerk reactions, but I think basically Iran is out of options. I mean, you really, there's an old saying, Neeraj, in the Hindi language, ki jiski lathi uska bhais, which is a crude translation is that might is right. And I think Trump is playing that out with Israel in the Middle East, that we have the power, we have the bombs, we can knock you out, we can kill whoever we want. I think Iran is just out of options. I think for 40 years they've called a bluff game with the U.S. administration. I think finally someone has called their bluff. So I think while they might try this or that, they basically don't have many options that are good.
Got it. Okay. Well, in some sense, Mr. Damani, this for risk assets worldwide, do you reckon that they would view this as the beginning of the end of the conflict, and therefore not just for Middle East, which you alluded to, which actually get a new era of fund flows, etc., but for risk assets worldwide, this could be the start of something more predictable and constructive?
I think yes. The short answer, there will be a honeymoon period. So yes, I think it'll be good for asset classes across the world out there. But market will now, fortunately, unfortunately, have more time to focus on U.S. domestic politics, where the threat of Trump's tariffs, threat of inflation, threat of deficits are not going to go away. And the market will start reacting to that more sharply. It has been quite focused on the conflict in the Middle East and the going-ons there and so forth. So over the longer-term horizon, the challenges that pervade in the U.S. market will still remain. But I think in the short run, the market, I think sooner rather than later will join the celebration. I believe that the all-time high of the Sensex was around 86,000 made in September, October. I think there's a good shot that this quarter will challenge that high.
Just one last point, Mr. Damani, and for those who will see some weakness today and markets are likely to react at open, any kind of conflict of this sort of uncertainty, would it be an opportunity for those who have a longer point view or longer term view on India to come in and buy and shore up positions?
I think so. I mean, to me, it seems that the fears are a bit unfounded, and this dip in the market will present us a buying opportunity that we should take advantage of. The market seems ready to, I mean, the 1,000-point rally that we had on Friday suggests that the market is a powder keg ready to go off, and I wouldn't be on the short side of the street at this point.
Hey, that's wise words there. I wouldn't be on the short side of the street right now, says market veteran Ramesh Damani. Thank you so much for speaking with us this morning. I found that quite heartening, Neeraj.
Yeah, and Tamara, to an extent, we spoke about just before Mr. Damani came in, right? That the risk assets are actually showing that crude may have started off 5%, but just about a couple of percentage points. Asia is down, but not out. Less than 1% for most of the markets. You mentioned it at the start, right? Our implied open, if it is true, is just about 100 points. I mean, that is nothing.
That's an average Monday.
That's an average Monday, exactly.
No big shakes.
Exactly.
Thinking about, something that hasn't happened in the last 50 years, what happens if it does? First of all, I don't think people are sure that it's going to happen. Like Mark Rubio says, it's economic suicide for Iran.
Yeah.
China, who gets a bulk of, I think, close to 30% of its oil from the Strait of Hormuz and is the biggest financial backer of Iran right now, will they come in and say that, hey, don't shut us off?
Yeah, and the US has urged China to restrain Tehran, part one. And I think yesterday or day before, when the US Secretary of State gave those statements, they mentioned that there's no evidence of any kind of involvement of China when it comes to Iran as well. So, I mean, it is on its own against the mightiest military in the world right now. I would suspect that de-escalation is probably the way forward as opposed to escalation.
And Trump is talking about regime change this morning. So a lot working out there. Okay, now what's happening on the India front? According to top government sources, authorities are closely tracking oil trends in India given their impact on inflation and growth. This is considering that if this closure continues for over a week, it will jolt global economy, including India. Shrimi joining in with what she's picking up with her sources.
Clearly, India is on high alert, and in fact, authorities is closely tracking the oil price trend and their impact on the inflation as well as the growth outlook. Sources tells us that being an extremely sensitive sector, even a slightest of disruption could shoot up the global prices. And here we are talking about the unprecedented situation. So they are cautioning here that if the disruption continues over a week, that will have a clear blow on the global economy, and India is not insulated for that. And if you see the projection for FY26, we have 6.3 to 6.8% of range. And if this geopolitical tension persists and the price trend on the higher side continues, it will be in the range of the lower side, which is 6.3 to 6.4% is what the cautioning coming from the policy corridor. Now, sources also did underline that they expect this situation to be short-lived and it will come back to normalcy very soon. However, there are certain contingency plan which is in work. One is, of course, how to increase the import of oil from Russia. It will all depend on the price trends and the discount they are getting. They could also explore other partners as well. And the second, of course, the excise duty reduction, which is a kind of measure government typically takes when it breaches a certain threshold. And here the case would be that it could breaches like 105 per barrel, then they could perhaps think about this measure and some, reduction in the excise duty, but that will have a fiscal consequences and it will impact the revenue of government as well. So all those measures could be considered depending on the price trend and the overall situation, how it will pan out. But for now, they clearly think that this is going to be short-lived and things will be back to normal very soon.
Well, oil is the big draw, right? And amidst, thanks to that, Shimi, of course, but amidst all of this global oil market concerns, Union Minister Hardeep Singh Puri reassured the nation that India's crude oil supply remains secure, citing diverse import routes and ample domestic reserves.
Out of the 5.5 million barrels of crude oil that India consumes daily, about 1.5 and 2 million only come through the Straits of Hormuz. We import roughly 4 million barrels through other routes, and our companies, the oil marketing companies, have enough stocks. Most of them have stocks up to 3 weeks. One of them has, in fact, 25 days stocks. And we are also confident that we can increase the supply of crude through other routes should the situation so warrant. We are in touch with all possible actors in this, the supply routes, etc. And I believe that there is no cause for any alarm on this score.
Was a word coming from Hardeep Puri, a union minister, that we don't need to be alarmed. Ajay Bagga joining in now, and someone who's been tracking this very, very closely. Ajay, I've been following all your posts on X, and I think you've been doing a minute-to-minute breakup of what has been happening. Now, the street seems to think in its wisdom that it's not that bad. Do you agree?
Well, the markets always know, Tamanna. We don't know. What Trump has done very successfully. China will not go near Taiwan also for till 2028, till Trump is there, because you don't know on which side of the bed he gets off. And what does he do? There is his vice president saying we are not at war with Iran, we are at war with China, Iran's nuclear weapons. So we can also say we are not at war with Pakistan, we are at war with Rawalpindi Air Base. So one cannot analyze all these logically. What you can do is understand from the market. And yesterday, when the Gulf markets did not react, and they in fact went up, and Tel Aviv Stock Exchange, whose building has taken a hit from an Iranian missile, the Tel Aviv Stock Exchange went to an all-time high. One said, okay, maybe there is not so much to it. There is less to it than meets the eye. So very difficult to really make a logical conclusion. Very difficult to have the long game, long strategies in this kind of a scenario. A really very tough environment for traders. Good environment for investors, and best environment for SIP investors who have just disciplined in a disciplined manner kept investing. They are the real winners of this year. Everybody's forgotten July 9th Trump tariff deadlines. Everybody has forgotten the big beautiful tax bill which is meandering through the Senate, and this has taken precedence. Total GDP of Israel and Iran put together is 1% of the globe. If Iran's oil goes out of the global supply, the Saudis and UAE themselves have more than enough capacity to ramp up. But if you look at the Israel bombing, they have bombed the Iranian internal storage oil depots. They have not touched the Iranian export terminals. So the Israelis also have some kind of a tacit agreement with the Chinese, who get 15% of their oil unofficially from Iran, that they will not hurt Iranian exports. Otherwise, the first thing you would have done is try and curb Iranian exports so that the regime doesn't have whatever little money that they have left. The Israelis have not touched that. So very interesting things, Tamanna. If you look at the just below the surface and try to see the patterns. But then comes along President Trump. Till yesterday, US was saying we are not looking at regime change. This morning it's MEGA.
Yeah.
What it was MEGA was in February, make India great again. Today it is make Iran great again. And he's saying, watch out, guys.
Mr. Bagga, you are on a roll today. We're talking about the Iran conflict and you moved to Taiwan already. So that's quite something really. But so good listening to you being so positive, because before you were speaking to Ramesh Damani, he mentioned that he would not be on the short side of the street right now. For now, as you rightly said, right, markets know best. Oil is just up about a couple of percentage points. Asian markets are down just about 1%. You think this is just another day now from a risk asset perspective, or would you actually be constructive because this could mark the beginning of the end of the conflict, at least the Israel-Iran conflict?
Yeah, Neeraj, if you look at, how bad the situation for Israel was about 2 years back, there was a full, what Iran calls axis of resistance and what the Western world calls axis of evil, right from Syria through Lebanon to West Bank to Hamas. In Gaza, and then to the Houthis in Yemen, and then Iran sitting as their protector and funder in chief. And Soleimani really, controlling half of Middle East. That was the situation about 2.5 years back. Started with Trump taking out Soleimani, and they saw that there was no reaction. Everybody was afraid, like North Korea, nobody touches. Iran was again a no-go situation, that they've got nukes, or they are very near to nukes, and they have a huge arsenal of missiles, so we can't take them on directly. We saw that getting upended last year in April and October, where Israel and Iran traded missiles. And if you remember, the first time the missiles went, both said, we are done. One and done. Now we have launched, and if you don't escalate, we won't escalate, because both sides were afraid. Where does this lead to? I think Israel after that worked and did a lot of scenario forecasting, really penetrated the Iranian intelligence. So in terms of an end game, they have taken out a lot of the military leadership. They've taken out the nuclear leadership. They've now, through US, they wanted the US to get involved. They've got US involved. They've bombed the nuclear facilities. We don't know how much of that has been successful. We'll get to know that only a couple of months later. Radioactivity has not increased. So probably they didn't reach, or the uranium stockpiles had already been moved out. That could be a possibility. And they were hunting out the wrong areas. But be that as it may, the US coming into the war is a very big achievement for Netanyahu. After what he faced in 2023, which was an intelligence failure. So he's done very well. US endgame, they are also very clear that we are not getting into a war, because the Trump base wants US to be isolationist rather than getting dragged into foreign wars. So there is no appetite in the US for boots on the ground anymore. By air, they are fine, and to get out fast. So they are also saying, once we did it and we are out of it, but if you retaliate, we'll come back at you. I think Iran will keep making sounds, but will not retaliate on the US, because that is then assured, self-destruction for them. So I think that is well understood. You will have a lot of rhetoric, lot of noise, but markets are cutting through that, Neeraj. That's the good thing. And, with artificial intelligence writing the headlines, this morning, the wirehouses were carrying Asian market plunges. So I woke up 3:34. I was waiting for Tokyo to open, and then it says Asian markets plunge, Asian futures pointing to a plunge. Then I looked at it, 0.6, 0.7%. I said, I don't know who's writing these.
Someone, Ajay, possibly someone who's written it and gone for a nap.
I can assure you, though, Mr. Bagga. Mr. Bagga, in the NDTV Profit newsroom, there is no AI writing the headlines.
It's all us. It's not AI. That's the scary part about AI writing the headlines. How are you going to predict what humans are going to do when no one knows what the US president is going to do?
And then, Tamanna, the AI catches the headlines and they say too much chatter on plunging, so let me go short. So, the algos take over. So it's becoming so destructive.
No, true.
Then they said Asia declines. They changed the headline to Asia declines. And I heaved a sigh of relief. I said, where is it? Even the dollar you look at, it did not strengthen. So there is no safe haven. And then the usual crypto czars, the big whales came in. This is the time for crypto, this, that.
True.
And
So for those who are not using AI to trade and who are not the big whales and not the czars but are watching us right now, what should they do today, Ajay? When markets open, you might see a little bit of softness, and we'll just pull up the implied 100 points odd is what you might see when India opens. What should be the move?
I think Friday market was very strong, and we were setting up for a recovery, and now this geopolitical risk has come. It will blow away. We are setting up for a much better market. So I would say buy the dip, and that's what our retailers have been doing continuously. So nothing wrong with the Indian markets per se. It's been a global overhang which has been holding us back. And we've had about 9 months now where we have been below the September highs. So it's a matter of time. Normally, at worst, it goes to about 18 months, but on average, by 12 months, you recover when you go down like this. And I think we are set for that. So another quarter, we should be able to see all-time highs again on the Indian markets, if not sooner.
Okay. Thank you so much, Ajay. Pleasure speaking with you. Ajay Bagga there, and just has a way of words and way of putting it together. What I'm surprised is that all our guests this morning are, confused by how Trump says 2 weeks and then bombs, but think at the end of the day, it's a good idea. It's a solution to a problem that has been simmering in that region.
Yeah, for this one for sure. And maybe, as all of them said, Mr. Market is telling it, Tel Aviv, crude, or Asia. So far, so good actually from a market's perspective.
Yeah, I mean, not that markets are cheering, but definitely not as bad as it could have been.
Exactly.
But, just to get a ground report, and our colleague Ankit Tyagi is reporting from a hotel bunker in Tel Aviv. He's made an arduous journey, one of the few Indian journalists in Tel Aviv right now, because it's not a location you can just fly into. And he has described hearing the live sounds of bombs as Iran launched missiles targeting the city. Listen in.
There were air raid sirens which just went off in the city. Remember on Sunday morning, I get here, I just had to run from my room in the hotel where we are staying into this shed where I am right now. And we can hear loud thuds outside. It seems that there is another air raid or a missile attack which is taking place at this moment at Tel Aviv. Iran has launched another retaliatory attack, and this happened. This is now early Monday morning. The VRs here on Monday, and on the other hand, on Sunday we saw one of the largest barrage of missiles that came in from Iran, and we showed you the damage that it did to Tel Aviv and other areas. Even at this moment, loud thuds can be heard. These loud thuds, of course, could be of the air defense systems here, the Iron Dome, trying to intercept the missiles which are coming in from Iran. We'll know whether something has penetrated and landed in Tel Aviv only after the air raid sirens go off. But emergency sirens all across the city as we speak at this moment. And we are in one such shelter. There is another gentleman who is from this hotel also at this moment here in this shelter with me. We'll keep bringing the updates as it happens from Tel Aviv.
Wow. And this is exemplary courage, and this is exemplary journalism, and well, we're trying to give you some glimpses of that. By the way, full focus back on trade now, and remember the implied open suggests the start, which is yes, down in the red, but nothing alarming at that. And I'm really waiting to see what Parag Thakkar has to say, because he's been very constructive all through. Let's see if he thinks of it the same way as Ramesh Damani Ajay Bagga did. Would be interesting to get in the trades from Kush Bora as well. But speaking of trade, let's try and get the trade setup up on the screen. And you know, effectively, I mean, I kind of start off with that, and I don't know how Tamanna thinks of it, but oil prices well behaved in light of the magnitude of the conflict and the chatter around it is a big positive to my mind, and therefore that is something that you got to take on board, that oil prices behavior this morning. It may have started off 5-6% higher, but right now very well behaved in light of the magnitude of the conflict. The only fly in the ointment is that internally the market breadth has not been very, very constructive. In fact, only 47% of the small caps are now above the 40-week EMA, and they were much higher at the start of the week. So maybe just kind of look at it that way. Maybe large caps do a bit better, etc. And if indeed the conflict settles soon, then Tamanna, the interesting piece was auto stocks making the comeback that they did the whole of last week. Autos and autos ancillaries, and maybe they become trading favorites if conflict settles. In fact, people who look at the relative rotation graphs are saying that that sector is moving from a space of being out of favor to gaining strength and momentum, and may actually be a stronger piece to watch out for. So maybe look out for that if indeed the conflict were to settle. But broadly, just 100 points lower for the gift is really quite something.
Do we want to reckon that markets will close in the green?
I would actually be on the same side as you.
So, okay, so we don't have anyone to bet against
We don't
today.
have, maybe Parag Thakkar or Kush Bora.
Maybe Parag Thakkar or Kush Bora. But okay, you know, that's what we're saying, that it's likely that markets would close in the green towards the end of trade today, because look at what factors you have. So crude could possibly stay at $80 levels for the next week or so if tensions continue, but as we speak it's still at 78, so you have Brent cooling off. Watch out for ONGC in today's trade. OMCs is negative for them if crude goes up. Pain stocks might be hit. Airline stocks, I think, for a variety of reasons, not just crude prices. I mean, which airline do you fly and where do you fly right now? If you want to see international travel, you don't know which airspace is shut. Is it safe to fly this airline or that airline? So I think in terms of travel, you might see a bit of a hit on aviation stocks in this period. Defense stocks, I reckon, will be in focus as winds of war blow over the region. BEL, Hindustan Aeronautics, even Zentech have all made announcements in the last 48 hours. Over the weekend, you have exchange filings on various deals that they have got. So watch out for defense stocks. That would be on my list to focus on. A liquidity squeeze could be expected in cash markets as 6 main board and 11 SME IPOs aim to raise 15,800 crores in this week itself. I think this is a big factor that no one's really talking about, that there is going to be sort of you know, throttle or chokehold on liquidity as well. Meanwhile, let's look at what happened on Friday. Nifty surged 300 odd points to close at 25,112, snapping a 3-day losing streak. It was the first close above 25,106 sessions. The Indian stock market is poised for a complex trading session on June 23rd, though. Friday cues were positive, but broader sentiment will be influenced by escalating geopolitical tensions in the Middle East. And it's tough to say, you know, what happens in the next couple of hours. Are there more strikes? Is there a statement? All of that is up in the air. Nifty has been consolidating, though, within a broad range, 24,450 to 25,200 for several weeks. Immediate psychological and technical resistance is at 25,200. A decisive and sustainable close above this level is crucial for a strong bullish breakout. The other level to watch out is 25,145. Support remains at 24,700, followed by 24,500 to 24,450. A fall below this critical zone could trigger a strong bearish attack. Other levels to watch out are 24,880 for the Nifty. But let's go across to Puneet this morning to look at what the F&O trends are pointing to.
Well, thank you for that, and very good morning to you. The key aspect today is that the GIFT Nifty is indicating a 100-point downtick at the start, but that's largely tricky on such days, especially when there are such big events globally that could impact the open. So while not, as you guys rightly mentioned, not as worse as expected, it will be one of the key aspects to watch out for. 25,000 as a key support is something that we've been talking about, and the other one on the lower side is 24,800. But if we are able to maintain that at close today, that will be something which will be a key positive. On the banking side, we've seen largely 55,500 being one of the key supports, but we're very close to those levels again on the Nifty Bank, and that's another key aspect, because while NBFCs, Gold Finance, and we've been speaking about this, that they have moved along, banks haven't yet fired up in trade. So PSU banks is something to watch out for again in trade, continuing from the last week, while we've seen open interest just marginally been down almost 1% for both the Nifty as well as the Bank Nifty. When you move on, look at the long-short ratio as well as the other positions of the FIIs, it's largely being short across index as well as Nifty options, but they've increased the longs in the system. Now, last week on Friday, it was about 22%. Let's move on to the next graph and see, because right now it's somewhere hovering between around 24%. So this is of course the FI position, but let's go on to the long-short ratio chart for the FIIs, and this is what we've been talking about. The index long have been steadily building up from the last Monday levels of about 16% to almost 23% now. So it's a positive up move on the index longs, while the net OI PCR has been hovering around the 1 to 1.05 levels as well. Finally, in terms of open interest positions, both on the long and short side, we've seen 25,000 again see a very big candlestick in terms of the calls, but largely maintaining the 24,800 and the 24,900 level for the puts. In terms of stocks, we have seen some kind of long unwinding as well as short build-ups across stocks. Some short build-ups seen in Shree Cement, and so cement pack will again be in focus, as there is a potential price hike expected in July now from all industry players, while some long build-up has been seen in IFL Finance as well. Finally, in terms of open interest losers as well, some short covering across the board, stocks like Ultratech, and we've spoken about this again, that the cement pricing is again in focus, while something like a Reliance and Granules is also in focus. So again, a very key important start, but the ending, as you guys rightly mentioned, will be one of the key levels to watch out for today.
Okay, so it's also going to be monthly expiry this week, so we have to watch out for what kind of positions to take. So thank you for that, Puneet. All right, stocks on my radar. I'm looking at IT stocks this morning. I mean, all things considered, war or not war, Accenture reports were pretty decent, ahead of expectations in Q3. And remember, that's sort of the bellwether that the street watches as an early signal for what is happening with IT companies. So revenues were up 7.65% for Accenture at $17.7 billion versus 16.4 billion. Net profit was up 13.25% at 2.2 billion. Now, what does it mean for Indian IT? I'm just picking from what Morgan Stanley says as an example. They say no major negative surprise for Indian IT. Accenture's results are neutral to slightly positive for Indian IT services. The demand environment has not deteriorated in the last few months. Accenture shows strength in the financial services vertical, bodes well for Indian IT. Demand environment has remained relatively resilient. Pickup in discretionary is still missing. Clients have shown inclination for larger scale transformation. They expect Accenture's implication on Indian IT to be neutral to slightly positive. So the view for Indian IT is positive. If you see a pickup, IT stocks could be one of those outliers. The other one, LT Foods, and this is a clear thumbs down in terms of news for LT Foods. The US Department of Commerce has imposed the highest possible countervailing duty order on organic soybean meal from India. That duty is at a eye-watering 340% on exports of organic soybean. It's the highest possible, and such duty is imposed when necessary information is not provided. So this will impact a subsidiary of LT Foods, EcoPure, which said it is currently reviewing all possible legal remedies. So expect some pain on that counter today. Two real estate stocks is what I'm also looking at because of this interesting take from acquirers on both. So Suntec Realty first. They've initiated a long on Suntec Realty with a target price of 543 rupees. They say it's a high-end core asset-light edge Smart bets in untapped high potential markets. Multi-brand model is fueling growth along with asset light, of course. The expansive pipeline targets 25% pre-sales growth. They see an annuity income growing 5 times, a lean balance sheet supporting growth, leverage under control, and provides more rooms for new business development. They're very excited about AB real estate as well. They've initiated along with a target price of 3,076. They say big brand, big land, bigger plans. So interesting header there. They say the business development additions of 40,000 crore rupees strategic tie-ups are fueling growth visibility. 20 to 25% pre-sales CAGR expected between FY25 and 28 estimated. Annuity upside, paper exit to boost growth firepower. So some real estate stocks on the radar as well. This is, of course, Neeraj, with all things considered of what can happen in the next few hours.
Yeah, I mean, that's the caveat that comes with every mention this morning, including the ones on the small finance banks, Tamanna, because this RBI is on overdrive, right? And doing all the right things. So they've reduced the PSL requirements for small finance banks to 60%, priority sector lending requirements for small finance banks to 60% of the NBC from 75%. Effectively, the move enhances lending flexibility for the small finance banks. In simple words, most brokerages believe that diversified small finance banks like AU and Equitas are better positioned to benefit because they have a broader product mix and stronger presence in secure lending categories. So watch out for AU Small Finance Bank, Equitas, ESUF, and a lot more. I mean, a lot of these could benefit today. Lloyds Metal has commissioned a 4 MTPA pellet plant in Maharashtra. They've also commissioned an 85-kilometer iron ore slurry pipeline from Hedri to Konsari. Effectively, the locations don't matter. What matters is that there is a 4 MTPA pellet plant and an iron ore slurry pipeline, both commissioned. One would reckon this would add to the revenues this year, and therefore watch out for that stock. And watch out for Northern Arc Capital. The name that has come out in terms of the buyers is Cohesion MK Best Ideas, which is Madhu Kela's trust, which is buying 10 lakh shares. But I'm told it's not just MK, but also some other high-noted investors which have bought into Northern Arc Capital. It trades at about 1 times trailing 12 months price to book. You want to watch out for this one. Maybe, just maybe, a bit of a reaction might come in today. So these are the top 3 on my radar. And remember, viewers, there are a lot of other stocks which we'll highlight during the course of the show.
All right, let's now get to our guests. Kush Bora of kushbora.com, Parag Thakkar joining us. But before we get to them, a quick look at the implied open as well. Interestingly, in the last 20 minutes or so since we've started the show, in the last half an hour or so since we've started the show, we've seen crude staying steady, not going above the $78 mark. We've seen the implied open also not looking very, patchy or jittery, just about 100 points odd. So are we perhaps set for a better morning that most could expect, all things considered? We're going to take that question first to Parag Thakkar. Parag bhai, very good morning to you. If there is an opportunity today that the market affords with a weak opening, do you think that it's an opportunity to dig in?
It's not a weak opening.
Relatively.
100 points is nothing.
But no, I'm saying from the point of view, look at how Friday's close was. It was some firecrackers.
Yeah.
Yeah. So,
see, even market is not giving up that also. So basically, I will be very prudent. I'll be honest that these are too difficult things for me to predict. And so I will be happy if market falls more, and then there will be opportunity to buy. The buying theme remains same, but the point is that I would love if market falls 400, 500 points on Nifty. This is just 100 points, nothing. So nothing you can do as much. We are holding to 9% cash, 9-10%.
Can this lead to that 500 point fall, or you don't think so?
No, see, if Iran actually, that Iran Security Council, they actually approve this Strait of Hormuz thing, then you can have a fall.
Okay.
But that is not right now. The market is, as we discussed last time also, market is going on the narrative that Iran is too weak, and Iran will not do it because Iran supplies to China, and so Iran cannot stop it.
The fact is that if they really wanted to do it, nothing is stopping the Security Council from having taken that call yesterday itself. It's not as if there is some big process or they cannot do it for some reason.
Absolutely. So that is what market is going with. But in this kind of geopolitical tensions, I would not like to second guess anything. I will keep 10% cash till it falls significantly. And then see the situation.
Kush, what about you? What are you seeing on the charts? If there is 114 down is showing on the implied, I don't know if this will even disappear by the time we get to open because of the kind of rock and roll we saw Friday evening, Friday close.
For all you know, this is that chalawa we keep talking about, right? As far as GIFT Nifty is concerned. But if you were on a digital detox, over the weekend, and you woke up this morning looking at what markets are doing, you'd probably think this is some reaction to another Trump tweet, MAGA, MIGA, or some new acronym that he's perhaps come up with, right? But earlier it was follow the headlines, now it's follow the price action. If you look at the price action, it's not showing up anywhere. In fact, yesterday we did a special show, on a Sunday where even the Bitcoin, which is supposed to be very volatile and reactive to these things, was down about 1% or so. So not much reaction since yesterday, and today also we're seeing the same thing, follow through. Interestingly, as long as we talk about the price action, look at what the FIAs have done. FIAs have in fact covered short positions on Thursday, on Friday, and as Puneet mentioned, they are now at 24% long, which is actually up from 18% over the last week or so, right? Put action, put writing has been massive. So there is a great deal of confidence that, the near-term supports will be intact, and the first one comes at 24,800. So as long as that is maintained, in fact, one would be hoping that, there would be a test of that, and then perhaps we'd rebound, as Parag also said. Not even that, right? So hold on to your horses. Now, this is where technical analysis also sort of, comes into play. While we were constructive on Bank Nifty on Friday, and we said 56,000, 56,200 are the targets to watch for, the upsides were a little iffy beyond that. And this is reflecting now. The same thing applies even now. The conviction on the Bank Nifty is much stronger for me at least. And if we get a dip closer to 55,000, 55,500, I would suggest another round of fresh long positions on the Bank Nifty, again for targets of 56, 56,200. On the Nifty, that number comes close to 25,200, 25,250. Those levels being taken out might perhaps take some time, but any dip closer to support zone should be taken as a, as a buying opportunity to create fresh longs from a very near-term perspective.
Okay, Nifty, Bank both. I'm guessing the answer is the same, right?
It is just that my conviction is slightly higher on Bank Nifty. Yeah, 55,500 or anywhere closer to that. If it comes, then yeah, you're better off creating a fresh long position there.
So do the stock positions or the stock calls reflect that today, Kush? Are they more towards the BFSI space?
They're not, and the reason is that as I usually do on Monday mornings, the weekly setup, I look at it from a weekly lens. So the long call is on Nava. The weekly volume action on this one for the last 3 weeks has been tremendous. So I think there is a very clear accumulation and build-up happening on this one. The price action is also confirming that. But what I'm more interested is in the volume action that I've seen over the last 3 weeks. So for an upside target of 10%, a mid target being 5%, 595 and 620 being your targets, 535 being your stop loss, I think you could consider a medium-term position in Nava. Just because there's so much happening, there's a short call as well in there. Initially, I had 2 longs, but I had to include one short call, and that's on Pidilite. It's been under a bit of a pressure. It might see some short covering rally if the news de-escalates, but for now the positioning indicates that there could be further shorts. So 29, 25, 28, 95 are your targets on the downside. 25, 85 is where you place the stop loss. And just a quick word on AB Real Estate, because I saw Tamanna cover that as part of her Equirus update or report as well. Friday we had a call on it. It was a little muted, but even I remain very constructive on AB Real Estate for targets of 2,700, 23, 25 thereabouts are your stop losses.
Okay. In terms of IT, Parag bhai, what Accenture has reported, and no one is going rara over it in terms of Indian IT, but they're saying neutral to positive.
Yeah, it is neutral to positive, plus the bookings were a little bit down, and I think Accenture ended at 6% below the last close after the result in US. So I would say it's a very mild positive. And as I said last time, we added Wipro in our IT stocks list last time because we thought that 6% cash flow yield plus there is a possibility of a buyback. So here I am taking a very, very neutral stance, not very aggressive stance, because who would like to bet on US economy right now? Right now, with so many things happening, who can say what is going to happen? A company sitting out of US, how it can decide that they will increase discretionary spending in such environment? Every day there is something or the other happening, tariff, war, who would like to bet on the, so basically it's better, and the companies are fantastic, right? Indian IT services companies throw so much of cash. They have 40-50,000 crore cash in their balance sheet. So, and 4% dividend yield in TCS, Infosys, HCL Tech. So, I am not betting against the sector. Neither I am very positive on the sector as I am in cement or select banking names.
But I thought that the continued bookings growth, right, including Gen AI, upward revision to the narrowed guidance, etc., would that accrue positively, independent of the stock reaction?
So today, if you see, for example, if markets would have reacted slightly negatively to this news, and if oil would have spiked to say 79, 80, then IT would have gained a lot, because then there would have been a rotational trade where rupee would have depreciated, and so people would have shifted to IT. But that is also not happened.
Okay, so it seems like maybe not too much happening on IT. Nevertheless, what are top brokerages saying on the IT pack this morning? That includes Morgan Stanley, Goldman Sachs, Nomura. Puneet is joining us to break that down. Puneet, start with what Accenture's numbers look like.
Well, thank you for that. The numbers definitely beat the estimates, compared to what analysts were hoping for. And the key aspect is that, the company, of course, follows a September to August year. So this was Q3 of FY25. But they reported results which was ahead of estimates. Now, they've also gone ahead and increased the revenue growth guidance. They've essentially narrowed it from 5 to 7% earlier to 6 to 7% earlier. So it essentially guarantees, in a sense, from the management that at least a 6% growth can be achieved in this year, and that was one of the key positives. On the negatives though, the overall booking number was slightly subdued in this particular quarter. It's actually down almost 6% on a quarter-on-quarter basis, and roughly about 7% on a constant currency year-on-year basis. So it's largely mixed, but the numbers ahead of estimate is what is exciting brokerages as well. So we've seen a few come out on that. Nuvama's maintain a positive view on the sector as a whole post Accenture's results. They've said that they see an over a medium to long term a positive outcome because of this. They've also said that the recovery in macro environment will largely encourage tech spending. The other aspect is Goldman Sachs, where they suggested that Accenture's results were broadly unchanged demand environment, which is also a positive because it's encouraging tech spending and also not deteriorating from what was expected before the quarter. They've also gone on to say that they are actually forecasting a 6% growth in revenue on a YOY basis versus 1.2% last year. So it's a growth outlook. And finally, in terms of MK as well, they've gone on to say that they don't see any kind of further deterioration in demand environment, continuing Goldman Sachs' point. And they actually have a pecking order of Infosys, TCS as well as HCL Tech as the first three stocks. So while there is the revenue growth did beat estimates, the order booking was slightly slow. But I think the key highlight is that the demand environment hasn't worsened, and it's not expected to worsen as well going forward.
For that, Puneet, having said that, IT has been fairly rock steady last few sessions, even though the up and down, but on balance, the IT index has been in the positive, about 4.5-5% in the last 1 month or so, about 2% in the last week or so. Kush, that pecking order that Puneet mentioned, would Infosys, TCS and HCL Tech in that order, would that be your preference as well on the charts for IT, or is IT something you're also quite blah towards this morning?
No, the large cap names, yes. But even if I were to pick a pecking order, TCS wouldn't come so high right now. I think I was listening to you, Neeraj, that there is a pair trade going on, which is, long Infosys and short TCS. Brilliant. Even if you look at the setup right now, my concern is that Infosys and HCL, the two that were doing well, have also now come up to resistances and are now starting to go flat. Again, incidental that, Parag Bhai mentioned Wipro, and we also discussed Wipro some time back. There is still some headroom there. And if you see Thursday and Friday, the volume action on Wipro, even now, despite the kind of move that it had over the week or so, is very encouraging. So I would in fact put Wipro, and it's a dark horse. I don't really discuss this stock, often because it's not done much, but right now the setup is such. So it would be Wipro, Infosys, and then HCL Tech and TCS. But I'd like to throw in one more name, which is Tech Mahindra. That one's gained terrific momentum and could continue to do well.
Okay, we'll take a very short break. Let's look at the implied before we get into that break. We're coming back with pre-open rates. We're coming back with more ideas. We're coming back with telling you what's going to run today in the market. You might get an opportunity of a bit of a gap down when we open. What should you buy? All of that when we come back.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down. Cut through the noise and set the context for you. Hear from top policymakers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience? The questions you care about, asked and answered. The big question.
Back with India Market Open right here on NDTV Profit. Remember, the implied open is about 100 points lower, and that's about it. Let's see if indeed that is how it starts off, or does it actually do better than that? Remember, a lot of individual stocks in focus as well this time around, right? There is IT as a pack, there is small finance banks, there is Sharda Motors, Lloyd's Metal, there is order wins for a clutch of companies. So all of those will be spoken about for sure. But I think the other really important piece is what's happened in terms of the Reserve Bank of India. Like we say, this new RBI regime is on overdrive on making things easier, much easier than before, than what they used to be. Let's put it that way. And in line with that, the RBI has reduced the PSL requirements for small finance banks to 60% from 75%. Simply put, what does this do? It enhances lending flexibility for small finance banks. Now, Parag bhai, you look at this, RBI moves very, very closely, right? You're constructive on NBFCs as well. Does this make small finance banks enter your list of consideration if they were not already?
Yeah, so basically, and especially the one name you mentioned, Equitas, that stock has not gone anywhere. So that's a good stock to look at for sure. And I would say that, see, RBI, absolutely, as you rightly said, it is on an overdrive. And see, government and RBI both have understood that RBI will have to do weightlifting. There's very little fiscal room which we have right now with this geopolitical tension and all, oil going up. There is a threat to fiscal deficit, current account deficit if something bad happens up to. Of course, right now market is not factoring that, but RBI is doing like phenomenal. In fact, I will tell you, the reason why I'm 90% invested in the market is because of RBI. Otherwise, I would have much more cash because there is no short-term trigger in the market. The June quarter results are going to be muted, right? It is monsoon. So banks are going to show 10-12% growth. There is no big demand. There is no big short-term trigger in the market. It is only because of RBI's narrative and the fact that dollar is weakening. So FII flows can come. And RBI is, see, first they did OMOs to improve equity. Then they cut rate by 100 pips. Then they cut CRR by 100 pips. Then they reduced that project financing. They diluted that provisioning for project finance. And now they are giving small finance banks flexibility to lend.
On that note, on the project financing bit, we have in fact a superb interview lined up this morning. Pradeep Kumar Das, CMD of IREDA, joining in. And that has been one big relief as well. Sir, just let's start by talking about some of these factors.
Yeah, very good morning, and thank you for inviting me here. Can I come to the question? Yeah, what are your questions?
Yeah, no, Mr. Das, good morning, of course. So we want to start it off with all the relaxations that the Reserve Bank of India or the regulator has done last week as well for businesses such as yours, right? The brokerage or the analyst community was very constructive. Any thoughts you want to share on how did you read them?
So first of all, when they initially brought the draft guideline 5%, there was a panic in the sector. And if you recollect, even I was in your channel and I have spoken that certainly there will be a deep down stakeholder consultation and all. So not only IREDA, even other stakeholders, we had given our suggestions, and there is a very beautiful way of incorporating the suggestions and coming out with a guideline. See, from 5% now it is 1%. So I don't know whether you are talking that sigh of relief and all. Well, this 1% is quite healthy. The reason is that during construction period, having 1% provision is quite fair. And post commissioning, it is 0.4%. And actually, in IREDA, we have 0.4% provisioning in case of commissioned assets. So as far as we are concerned, in commissioned, we don't have any impact at all, number one. Number two, doing under construction period 1%, it's a good healthy sign. So there should be some difference between a construction project and a commission project, which was not there earlier in RBI's guidelines as far as the segregation of construction and commission. The guideline was during construction, if it is PPP and commission project, then only you will get 50% risk weightage, otherwise it will be 100%.
So, sir, just trying to make it easy for our viewers to understand, what's the final impact therefore? I mean, how do you see the impact in the current year because of these project finance norms?
Now, see, if you're asking specifically on IREDA,
yes, please.
There will be not much impact. The reason is, as I said, the commissioned asset, we are already having 0.4% provisioning. And in the greenfield assets, unlike other project financing where the gestation period is pretty long, in our case, 6 months to 1.5 years in case of solar and wind, and in case of hydro, it takes 2 to 3 years. And if you have, which we are doing now 0.4%, and if you do 1% during construction period, many of the assets which will be starting this period and then ending in the next quarter and next period, and many of the assets can start and get completed during the same year. So annual basis, some of the assets will not have impact. Some assets will be having impact, for which we need to have additional provisioning.
But just to understand that when this 5% guideline came out, some organizations had started provisioning for it. Did you have any provisioning at all?
Not at all. Okay. Because we're quite confident that what is true and fair, what is correct, that is to be done.
Oh, wow.
Rumors and hearsay, we are not going to do our accounting or risk management. In renewable project, risk mitigation period is pretty small. And if you handle that well, post-commissioning, your assets are generally de-risked. So there is no question of having that kind of 5% provisioning and all.
So just one last point. We've talked about how this is a sigh of relief. You're saying that no major impact because anyway you do not provision for 5%. What is the kind of appetite you're seeing for project financing? Let's understand that side of it.
First, the perception about the project management and project financing and risk management with respect to project financing and project lending, that is going to improve. There will be a disciplined approach that during construction, you have to have X percentage, post commissioning, you will have Y percentage. That is very clearly spelled out, which was not there earlier. My kind of organization is going to be rather benefited because our quality, asset quality, is further going to improve. Because the rating agencies and others, even the auditors and all, when they used to come and look at our financials, they generally tend to carry the inertia of referring to those other organizations who is having 10% in their book renewable or having 20% renewable in their book. They may be gigantic organization and they may be comparing with us in the pure banks and all, which is having retail books. But whereas our kind of organization, which is having 75% minimum project lending and 100% green financing. So therefore, our asset quality is going to further improvise by this process, and the perception about our project development will be much more clear. And I think our investors is going to be more happy with the asset quality what IREDA is carrying and going to carry in the time to come.
Okay. Thank you so much, Ms. Das, for speaking with us. That's Ireda talking about the appetite for project financing. You already saw, positive move on some of these stocks when that provisioning final guideline came out. But another conversation we're having this morning is with Biocon. They have raised funds worth 4,500 crore rupees via QIP. What is the reason for this? What are they planning to do with the funds? What's the strategy ahead? I had a chat with Siddharth Mittal, CEO and MD of Biocon. Siddharth, let's start with the rationale for the fundraise. Debt reduction, of course, but is that the primary reason?
So let me contextualize. We have a bank debt of $1.2 billion. And we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
What would your debt level sit at post this?
So the debt level will be still at $1.2 billion because we are not repaying any of the bank debt or the bond debt that we had. So we have just basically what we have done is on a fully diluted basis, Biocon would have held 72% of stake in Biocon Biologics. And once we have given the exit to these investors, we would increase our stake to 79% in Biocon Biologics.
Okay. So, one question that comes to mind, and you spoke about Goldman Sachs specifically, would they not have had the options for the conversion of their debentures in Biocon Biologics? Why would they not be exercising that?
So Goldman Sachs had the option. It was an optionally convertible debenture.
Right.
While the other investors, Kotak and Edelweiss, is non-convertible debentures. But coming back to Goldman Sachs, of course, they had an option to convert it into equity. But today we are also we are all aware that some of the headwinds that we had in the last couple of years because of facility issues, not receiving the approvals, and the growth that the business had, that probably influenced their decision to not convert. Of course, I would let Goldman Sachs comment on what was the rationale for redeeming the OCD and not converting. But today, I think I'll move forward and say that we are very well placed. We have addressed a lot of those issues, whether it was relating to facility approvals, whether it was relating to product approvals, whether it was relating to gain in the market share for various products in the US or other markets, and coming back to the growth trajectory. So I think we are very well placed. And I think the QIP or repaying some of these investors, as I mentioned, give us the opportunity to increase our stake in Biocon Biologics, which can then be unlocked at a much better valuation in the.
Okay, you can watch that entire conversation with Siddharth Mittal ahead on NDTV Profit, but just a few minutes for markets to open. Let's quickly get the big brokerage call of the morning. Harsh standing by. Yes, Harsh, what have you picked?
Well, it's Aditya Birla Lifestyle, which is going to list today, and therefore it looks interesting. You have a Motilal Oswal note which talks about how the demerged entity now looks in terms of numbers. What they're saying is this entity has a track record, of course, for execution. Revenue has gone from 200 crore in 1999 to around 7,800 crore currently. It runs brands Louis Philippe, Van Heusen, Alan Solly, Peter England, among many others. They also deal with emerging brands, Van Heusen, Innerwear, Reebok, American Eagle. So all of those should drive growth going forward. Stated objectives is 11% CAGR growth FY24 to FY30. Motilal expects this growth to come in a shade below at around 10%. 700 is the net store addition they are penciling in. Store productivity improvement to likely drive margins, 80 bips on the gross margin front to 59%, 140 bips on the EBITDA margin front to 16.6%. They're valuing this at 16.5 times, 190 being the target price and 171 is the implied demerged price.
Okay. Certainly watch out for that. Thanks a lot for that, Harsh. 3 minutes left for the markets to kickstart trade, and we're not starting off on a very good note. Obviously lower, but 172 odd points. Let's see how this fares off. In line with probably what one would have anticipated. Kush Bora, now is there a trade here on open, or would you wait for some time? Nifty, any stock, anything at all?
So one, I'd wait for a trade. Two, I'd wait for a trade and look for the trade on the long side. I just want to see where this settles, where it deepens, if it deepens further or not. But yes, both the things. I'd want to wait for the first 5, maybe even 15 minutes just to see how things go. Because a lot of strong stocks, that we were seeing are also giving you a softish kind of an opening. So just to see whether this deepens or not. But I would be on the lookout for a trade on the long side.
Okay. Any of the NBFCs, Parag bhai, would you be betting on in this weakness? Because as we've discussed, right, RBI is doing a series of moves. Do NBFCs give you a chance? And if so, what are some of the NBFCs that you would look at? Keep in mind, the HDB Financial's IPO price is much lower, so that's a bit of a dampener.
Yeah. So basically, and as we discussed last time, many NBFCs have moved also.
Yes.
Right? Bajaj Finance has moved. AB Capital, we discussed it 170, now it is 260. So I think most of the move has come also. So I would not be now very, very desperate to buy NBFCs just. And plus, if this geopolitical tension, if oil stabilizes at a higher price, the probability of further rate cuts are very less. As such, RBI stance has moved to neutral from accommodative. So I don't know, some small finance banks like Equitas can be looked at. Of course, we don't have it in the portfolio right now, but they can be looked at.
Okay, let's look at how the pre-open session has settled. You just have about a minute or so to go, and not half bad. About less than 3/4 of a percentage point down on the Nifty. About 172 points down is what we're showing. What's moving early this morning? Look at an Oil India expected with crude impact prices. Look at a Tata investment. Remember, the DRHP has been approved by SEBI for the Tata Capital IPO. You might see some action there. A GE Shipping also buzzing this morning in early trade, as is Bharat Electronics. I would say look out for defense. Any top defense pick very quickly, Kush?
I think in HAL, we've seen a good bit of short covering rally on this one come about on the back of the developments that are happening geopolitically. However, about that 5,000, 5,050, that's a bit of a resistance. But once it crosses that, then 51, 50, 5200 kind of levels open up. Good accumulation going on at the moment. So HAL, on the radar from a short covering perspective.
Yeah, well, and a couple of positive news flow for HAL as well. We'll talk about that post-market open, but 7 minutes left. Now, one would have thought it is braced for impact, but it doesn't seem like that. Let's see how we start off this Monday morning, a day after the big geopolitical event that happened. 0.6% lower for the Nifty. Banks are a lot more well behaved, by the way. But okay, you could argue marginally in line. Let's pull up Nifty IT and see if there is movement because of Accenture's numbers. No, in fact, 1% lower. Much like how Accenture ended lower, Nifty IT is starting off low too. Parag Thakkar was spot on. Let's get the mid cap and the small cap indices and see what's happening thereof. 0.4% or 0.37%. It's not bad at all. Nifty mid cap is not as low. In fact, small caps are outperforming. This is quite an open this morning we have, ladies and gentlemen. Let's get the heat map up on the screen and show you what's moving and what's not. Maybe a lot more red. Yes, a lot more red and a defensive bent to the winners. So you have a Nestle up 1.47%. ONGC, because of that oil price uptick, naturally. Remember, Oil India, as Tamanna spotted out, is up about 1.5% too. BEL, some order wins. SBI Life, Cipla, a fairly defensive bent to the market, save for maybe an IndusInd Bank. But on the losing side, IT's come off. So clearly, about those order winnings is something that seems to be impacting the mood. Order winnings in Accenture, which were a bit lower maybe. Infi, HCL Tech, Wipro Tech, Mahindra, that entire IT pack is sulking. HUL is lower. Shriram Finance, Dr. Reddy's, Hero MotoCorp bring up the rest. But it's steady at this 0.5% lower mark. Volatility not really massively spiking, just about 3.64% at 14 for the India VIX. Tamanna, not a bad open, pretty much in line with what we anticipated.
Yeah, I would say bearable. It's bearable pain compared to what you would have expected after everything that's happened over the last 48 hours as well. Let's just pull up the broader markets for a second and see what's happening there. And when all else fails, go in for the bonus share. So which is why Nestle is doing well today as well. But less than 0.5% down on mid-cap 150. I mean, you couldn't have asked for better when you think that the Strait of Hormuz may be shut. The small cap 250 pretty much flat. You are seeing a resilient Indian equity market this morning. Even the Nifty less than 0.75% down in the red. Let's pull up the sectoral heat map very quickly for you and see what's moving and what's not. India defense. We told you this morning, watch out for defense stocks when there is winds of war brewing in the region. Defense is expected to do well. Plus, you've had news flow in Hindustan Aeronautics. They're going to make rockets. Bharat Electronics has a new order book. Zentech has new orders coming in as well. Defense is the only green there on the screen. Nifty IT doing very, very badly. I mean, forget Accenture is on one end of the spectrum. But if you have uncertainty in that economy, where are discretionary spends going to come from? How are companies going to want to go out there and put some money on the table? Maybe that's what's bogging down Nifty IT this morning. Consumer durables also middling, but look at that entire range. 0.5% up on the Nifty India Defense and just 1.5% on Nifty IT. So it's quite consolidated. The underlying strength perhaps showing because India VIX also not spiking to that extent. Let's look at specific stocks. Indigo Paints, Berger, Asian Paints. I want to see what the paint stocks are doing because crude trending upwards is not the best idea for paint stocks. Berger Paints is doing all right. Indigo Paints and Asian Paints feeling some of that pain coming in. LT Foods, before we get to LT Foods, let's look at India Oil. Let's look at IOC, HPCL, BPCL, all of those coming in. And as expected, some impact there. Remember the Union Minister saying that we have enough inventory. We don't have to worry too much. India has been shoring in imports from Russia over the last few weeks as well. So we seem like we're on top of that situation. LT Foods, a 340% countervailing duty has been imposed on soybean, something that one of their subsidiaries called EcoPure sells in the United States. 3.5% down on that. Bharat Electronics, because of those new order wins, should be showing some spot of green, about 1.5%. GE Shipping. Trouble brewing, freight rates could go up. GE Shipping also nearly 1% up. Tata Investment is the other one that I want to see. That DRHP was approved. Is there any green over there? Yes, some coming in. So tough to spot winners this morning, but I would say not too hot, not too cold, Neeraj. At least there's no big drawdown in the markets.
Yeah, spot on, Tamanna, except for maybe IT 1.24% lower, so that's that pickle or the this thing. Just a couple of other stocks that I very quickly want to mark. Remember, PVC prices would be range bound now relative to what was believed earlier to be the case, and I think as a result of which you're seeing stock price movements in Astral, Supreme Industries, etc. So I think that bucket is actually coming lower because BIS implementation in PVC has been pushed to December, and therefore these stocks are correcting in trade, so keep an eye out. And SCI is among stocks which is actually doing well, so keep that in mind. Okay. India Cements, by the way, up 2.5%. So maybe some of the cement names are doing okay. Before I come to Parabhay on cement, very quickly, Kush, opening thoughts, anything that is worth a trade? We are actually now down 0.8% on the Sensex.
So, Neeraj, this is why, the wait and watch approach, when you asked me, because we opened, saw that 50-point bump up, and then we're again back to, those 190, 180-point kind of a downtick. So, not a bad idea to just, weather this out, at least for the first half an hour or so, right? I mean, you're not going to miss much. In fact, as Parag had mentioned, if it dips a little further, might just be a buying opportunity at lower prices. What still looks good, first is Nava, the stock that we discussed. very good volumes on open, already a good price action on this one. Add to that a home first finance, again for the last week or so it's been making good strides. It's just the volatility that's been keeping the upside in check, but on the whole, very good moves on this one. So a couple of names on the cards. I think what will now happen is 25,000 to 24,800 will become a very narrow range for this week, which also happens to be the monthly expiry for the indices. So just a little cautious. Still looking for that buying opportunity, particularly on the bank nifty, but I'm as I've said before as well, I don't want to be the first one. I'm okay to let go of the first few points. Once I know a clearer trend has emerged, even for the day, is when I jump in and buy. But yeah, some caution, not a bad idea to begin with.
Okay, Pranay, very quickly, pockets to look at, and cement features in your list.
Yeah, so cement is my long-term pick. I would like to caution your viewers that it's a long-term pick, because in short term you can say that monsoon, so plus March quarter is always a peak volume for cement, so April, May, June it generally drops off. There might be some people who will say that crude oil going up, so petcoke price will also go up. All these things are there, and there might be people who will say that the prices cannot sustain. But my simple view is that in December we were at a 10-year low in cement prices, and from there the entire industry has started taking some price hikes. Of course, the demand is not very supportive because monsoon has come early, but I am betting on a fact that there is an improved profitability. And see, if for example a company like say India Cement, for example, Ultratech wants to turn it around as fast as possible, right? And after 1st April we have seen price hikes in South, so that will only help them. So India Cement is a good buy. As Ultratech, for example, I spoke to them. They have said it on the call that they are going to save 300 rupees per ton over next 2 to 3 years in their cost structure. Yeah. They are developing a construction chemical business which is close to 1,000 crore today, becoming 3,000 crore with 35 to 40% ROCE. Plus, this is the only company which is talking about 9 to 10% organic volume growth, and 15 to 20% including India Cement and Kesoram, that is acquired capacity volume growth. Plus, you will have a 200 rupees per 300 rupees per ton price increases, or I would say EBITDA per ton increase. Sure. So this is the only large cap, I would say, in my view, at least within my circle of competence, where I can see 20% EBITDA growth from FY25 to 27.
Okay, all right. So, but that's a long-term view.
Yeah, absolutely long-term view.
So stay, focused on that as well. Although the day is not looking half bad in terms of opportunity, so we should say that as well. Kush, Parag Bhai, thank you so much for joining in on this leg of India Market Open. We're continuing the conversations, and Ajay Srivastav joining in now. He's MD Dimension Corporate Finance Service. Ajay, great to have you on the show.
Good morning.
Why are markets so unbothered? Just look at the last 48 hours. America has struck nuclear installations. We don't know yet whether there is some impact of that or not. Iran is saying they'll shut the Strait of Hormuz. Markets relatively don't seem so worried.
Of course, that happens. Tamanna, that's the beauty of the market, is that the shorts have kind of finished in the market in the last decade. Nobody goes in shorts. In earlier time, you would have seen massive shorts coming into play at this point of time. Short strategy has not paid off. People are ambivalent in terms of immediate result of their portfolios. Very, very ambivalent to say, okay, it doesn't matter, it'll blow up and it'll be an opportunity. But the fact remains that if you enter, important is not that you're holding off, the market is holding off. Important is, are you buying in the market like this, or are you sitting on the sidelines? And shorting, I would say, is a different animal altogether. Leave it aside for a minute. And are you booking profit where you see exuberance? That's a key difference, because the portfolio performance for the next 3 years determines on where you enter the market. You can be absolutely ignorant, put your head in the sand, and as you rightly said, nothing happened to the world, but that's not true. A lot happened to the world in the last 48 hours. And if as investors you don't respond to it, it's your peril. Nothing. Market will do what it's supposed to do. It can remain exuberant, can remain irrational. And you saw what happened in September. When the cuts came, they really came.
Okay, no, I'm going to take that forward. So what you are saying, and from what I'm understanding, correct me if I'm wrong, is that even if you're seeing relative calm in the street, doesn't mean that you shut your eyes and bury your head in the sand. You need to right now look at what's happening with your portfolio and make your own decision. Is that what you're saying? And there is, there are clouds there on the horizon.
Of course, and not only on the horizon, the cloud is right here in our fine print. The cloud says that the advanced tax growth is 4% at this point of time. Net is 1.6, but let's say gross number is 4%. So you're looking at an economy where the advanced tax payment is 4%. Now, hard to imagine that you will buy stocks assuming a 25% earning growth or 20% earning growth when the advanced tax estimate says it's 4% across the board for the industry. So it's not just the global cloud, it's Indian cloud. Liquidity is huge, humongous in India. And as interest rates go down, people pump more and more into the equity market. Fine. The question is, do you going to get a return out of this investment over a period of 3 to 5 years? Time will tell, but I still believe that where your return gets defined as entry price, this is, I believe, the worst time to perhaps enter the market and start building up portfolios because your domestic is not so good, advanced tax. Global is what it is. Wait it out. April to June quarter has never been good for Indian economy or Indian companies. So, as market can prove anybody wrong or right, but the fact is, merit says, fact says, data says, hold off your investment rather than rush in and build up and put everything into it.
Ajay, good morning. With playing the devil's advocate, wouldn't the quarter one numbers benefit from the base effect of last year?
You may be right, but the fact remains that the absolute change in quarter to quarter is not going to happen. And even if you look at absolute numbers in terms of just the data metrics that you see, whether it is power consumption, whether it is mining, whether it is two-wheeler sales, whether it is PV sales, the absolute numbers are not panning out. And that tells you the story of advanced tax. So, statistics, you can cut it whichever ways you want to say, year to year, quarter to quarter, running quarter, last quarter. But the fact remains that in a calendar year, April to June is the weakest quarter of the year in any case at the end of the day. Very hard for you to get earnings surprises in April to June quarter. Other quarters, you can well gather it. In such an environment, market elevated, P's elevated, stock prices crazy, and smart money in cashing. Have you noticed how much sale is taking place? Every P worth its salt wants to get out in cash it's holding. And in the private market, when they talk about it, they just can't believe the bonanza they're getting. There is a company, for instance, which was valued in a PE market at less than 6,000 crores last year, less than a year back. Nothing good, and it got the projection, everything was given. Today is valued at 16,000 crore in the market, and the PE investor is happily selling. Remember this, smart money is selling and booking profit. How much profit you have booked is up to you, but the fact is, money is churning, profit is being booked, institutional money is going out, mutual fund money is coming in place. Let's see where the metrics ends.
Okay, so Ajay, let me ask you, if this is the worst time to build a portfolio, are you sitting on oodles of cash? Have you taken that cash call? Are you invested in other assets? What is it?
See, for everybody, not only for us, of course, now suddenly over a period of time, gold, silver have become big asset. Our big asset is power transmission REITs, which give a very handsome yield, liquid, absolutely. So you never go in cash ever, but you move the allocation around to say, okay, how much is in your precious metals? How much is in the power transmission REITs? How much you keep actual cash on the books? How much is in a dividend yield assets? So I think it's a mix of it. But the idea is that you are right now having money in your bank, at least in various instruments which are giving alternate returns to equity at this point of time. RBI's interest rate policy is over. It has failed because the yields in the government have not gone down. So I'm not sure whether EMI rates are going to go down in the manner that we all envisage, because RBI yields are up, in fact, not down from the day of the credit policy. All in all, the environment is tough out there, my friend, and equity exuberance can last for years. Nobody can argue with that. But the fact is, real economy is real tough at this point of time.
Okay, I'm just wondering, Ajay, and time and again we talk about defense stocks, and the conversation is look at the valuations, and then time and again this happens. Look at India defense today. The fact is that when there is war in the region and we don't know which way it's going to go, every country is going to, shore up its resources. Do you think that defense is still a play that is out there, or it's becoming ridiculous in terms of valuations right now?
Taman, I would say this way, that if you want to play defense today, one would tend to play with the overseas market, particularly the US companies. And there, for instance, I'm not recommending it, but just for information of customers, the ETF of defense and aerospace is up about 30% for the year YTD. Indian defense companies are primarily the big ones are PSU. So it's a PSU play. Yes, you can play with it. How much they deliver, what happens to them, we don't know the answer. You saw the performance. Maybe one or two companies can be an outlier, Tamanna, because they can do well at this point of time given the dynamics. But the fact remains that at these valuations and the delivery, okay, and being mostly PSU stocks, if private stocks are incredibly stupidly valued. I would use the word that Gavaskar used for one day for the Pant inning called stupid. It's stupidly valued for them to give you 200% return just because in defense. There are about 800 companies producing drones in this country now. So, you can just imagine that drones is a good idea, but 800 companies doing it. So I would say temper the return. Remember this, when at the peak defense mutual funds launched defense schemes, those schemes were underwater for the first 8 to 9 months. One of the schemes is barely above 10 rupee mark at this point of time. As I said, the companies are good. The theme is good. The question is, how well do you walk into the schemes? How well do you walk into the shares at what prices and where you make your returns? That's why I advocate that when you buy at these valuations, what are you expecting the company to do at a P of 100 plus? What are you expecting the company to do at this point of time? So one of them may be lucky, but how much of your capital gets allocated to that versus loss maker, you can imagine. If a mutual fund couldn't get it right on defense schemes, you as a portfolio builder should also be careful to say, I will get in, but when the valuation is right. World is not going to fall apart. Company is not going to go away. Things will happen. I have seen this market. You have seen the market. Nikunj has seen market, much smaller than my tenure, but you'll always get opportunities to get in. September was an opportunity to get in. You will get it again. My friend, be patient, relax. It's the month of June. If the children got a holiday, do something about it rather than fretting about a market where we don't know what Mr. Trump will do tomorrow.
What are your holiday plans, Ajay? The reason I'm asking is I was speaking to someone yesterday who wanted to plan a holiday, and they were saying, right now, I don't know which part of the world to go to. Which airline should I take? Should I take Air India? Should I take an American airline? What if, Iran tries to shoot down an American airline from the sky? Should I travel anywhere? What should I do? Which is why I'm asking you, where do you take a holiday? And is this really bad news for that entire sector which has been booming?
Well, it's good news, in fact, for the Indian hospitality industry, because all the traffic which is going to the Middle East and so on and so forth may temper down or travel a little bit. To that extent, I think it'll, on the reverse side, it'll give a bit, fill up to the Indian hospitality, because you say, okay, I forget it. I'm not going to go to the famous places of Baku and et cetera, which have been the flavor of the last 2 years, but I may just, holiday in India. Some of us are a little lucky to have a private places to go to. So, to that extent, that's a luckier part of the segment, thanks to the hard work we've all done. But the fact remains that there are 100 destinations to go to. If you look at Far East, this is a brilliant place to go to. It's cheap, it's economical, it's fantastic, it's hospitable, it's next door, away from all the wars. So there's no shortage of places to go to. I think you just have to switch off the screen and say, we made enough in our life.
Ajay, where are you going? So where are you going?
As I said, some of us are a little lucky to have a private thing. So I think I don't need to travel anywhere, luckily. So I can go switch off and relax in my life. But as I said, it's hard work. We've been lucky because hard work. And hard work means that never get so greedy that you start following the people into a stampede as they jump off the cliffs. Mm-hmm. That's the only reason why I think we are here today. Because we've been prudent about what we get into, not what we get out of it.
Fair enough. Thank you so much.
You're welcome. Have a good day.
Thank you so much, Ajay, for speaking with us. You have a great day as well. I must say that, it's too early to say that all is well. Definitely, because we don't know how things are going to pan out in the next couple of days. And oil companies will be in prime focus on the back of this conflict, which has resulted possibly in a threat that the Strait of Hormuz may be closed. So Amit is joining in with more details on what this could mean.
Well, for the oil marketing companies, if you look at, yes, increasing crude oil prices would be negative given the fact that crude is one of the key raw materials for them, and increasing crude oil prices will increase the overall cost of manufacturing that crude and selling, and hence their marketing margins could come under pressure. Hence, oil marketing companies would remain in focus. But apart from that, crude is again a key raw material. The cost of crude makes up for nearly 30 to 35% for paint sector, so paint companies will also remain in focus. Apart from that, aviation, for aviation companies, if you look at ATF is the key raw raw material or the key cost for them. Nearly 40 to 45% of the total cost is fuel cost, and ATF is the major form of that. And increasing crude oil prices could lead to increase in ATF prices and could impact the margins of the aviation companies. For tire companies, crude derivatives, synthetic rubbers, various other chemicals and carbon blacks, the prices of these raw materials are derived via crude. So increasing crude oil prices could lead to increase in prices of these key raw materials as well and impact their margins. And when it comes to lubricant manufacturers, for lubricant manufacturers, nearly 50% of the raw material cost is crude related, and increase in crude oil prices with a lag impact could increase their raw material cost as well. So broadly, these sectors or these companies remain in focus because of increasing crude oil prices. The raw material cost for these sectors and these companies could increase going forwards. With specific to oil marketing companies, yes, the marketing margins could come under pressure, but on the refining side, the refining margins continue to remain higher at around $6.50 per barrel level, which is way higher compared to what we had seen in the previous quarter. So on the refining side, oil marketing companies are better placed, but on the marketing side, the marketing margins could come off due to rising crude oil prices.
Okay, Sumit, thanks for that. And let's pose that question to somebody who has run HPCL for such a long time and would have a great insight into what oil marketing companies could or could not get impacted, or how will they get impacted. Mr. M.K. Surana, former CMD of HPCL, on the show. Mr. Surana, great having you. Thank you so much for taking the time out and being with us. How do you foresee the to and fro's for oil marketing companies in a scenario as uncertain and volatile as it is right now?
Good morning, and thanks for having me on your show. As far as the crude prices are concerned, we are slightly in an uncertain territory right now. It depends on how Iran reacts to the situation which has developed on Sunday. And the two possibilities we should concern is, one, closure of Strait of Hormuz. Second thing, if Iran retaliates with some action against the other oil-producing assets or storage assets. While generally it is believed that the possibility of both should be lower, in spite of the fact that yesterday Iran Parliament has approved a closure of Hormuz, but subject to their Supreme Leader's assent. But I'm sure that US would have considered this scenario before taking the action which they have taken. Now, in the current scenario, the crude oil, which is running right now at $78 or so, I think, as I mentioned earlier also once on your channel, that till $80, I don't think that there is likely to be any change in the prices. And if it goes above $80 only, there is some thinking maybe there on that issue. And of course, the reduction of the excise duty remains as a tool with the government. As far as oil companies are concerned, if the market prices are not adjusted to the international prices, it will have an hit on their margins, especially the marketing margins. But in past few months, the marketing margins were good, so they will have a little bit of leeway to play with that temporarily, not on a long basis.
Got it, sir. Sir, one question. I mean, the last couple of quarters, it was expected that the marketing margins would inch up higher and that will take care of the profits. But of course, there were inventory losses maybe. And it was believed that now that 2 quarters have passed, the inventory losses would be behind companies, and predominantly everybody highlighted HPCL. Even today, brokerage notes are talking about HPCL being the key beneficiary as well. My question to you is this: would 15-20 days of an oil price move above $75 per barrel really hamper the overall profitability for oil marketing companies, or one needs to look at the average for the quarter? I would presume it will be the averages for the quarter.
Actually, the inventory gains or losses depend on day to day, actually depending on the way the pricings are determined. So pricing is determined with the rolling average of 15 days on day-to-day basis. But because the marketing pricing are not moving in line with that, so that differential basically adjusts the profit, and that profit may be part of two things, either the inventory gains losses or the operational margins. So as far as the market price is not being adjusted to the crude prices, it will basically be whether we have got inventory gains or loss. And I won't think that 15 days will make great difference unless there are huge spikes and downs. If it is a gradual thing, if it is a continuously increasing, then you may get the gains. If it is continuously down, you may get a loss. But if it is up and down, it does get adjusted to that extent. And right now we are in a volatile market to that extent.
Said that, Mr. Surana.
But it will also depend on what the prices you have on the closing of the period, that is the quarter ending or the year ending.
Okay. Having said that, Mr. Surana, oil marketing companies have had a cushion for quite some time because excise duties have not really been tweaked in line with where crude prices have been going. How long does that cushion last in your view? And at what level will there be a significant change to the pump prices, if at all?
No, we need to also consider that there may be cushion in MS and HSD, but we have got under recovery in the LPG.
Yeah.
So if the overall you see, we need to see the integrated margins of the companies, and there is an accumulated loss on the LPG. So I would think that that cushion is slightly a metaphor, rather, to say to that extent. Unless the whole of the LPG under recovery is recovered, I won't see that cushion exists.
Yeah, the cushion is thinning out, if we have to take that metaphor forward. Having said that, just on the petrol and diesel part of it, at what point do you think that the needle moves on pump prices, or we're far away from that portion?
I think we are far away unless there is a substantial change in the ground situation which leads to closure of the Strait of Hormuz, or there is some action which affects or impact the oil marketing oil companies' assets in the surrounding areas. Which both the possibilities I see slightly less likely right now, because there will be an impact on Iran also if the Strait of Hormuz is closed, and also the other regional players who will also try to ensure that the Strait of Hormuz is not closed, and it has not been closed even in the worst of the scenarios earlier. Second thing is because the nearby countries have at least spoken in favor of Iran, I don't think that Iran will try to attack any of those assets in the nearby and create a further negative narration. And the third thing is there is always a possibility of an retaliatory action if the Strait of Hormuz is closed by the people who get affected, including US. So I see that we may see a little bit of uneasy calm for some period in which the oil moving between 75 to 80. Depending on the news, it may go above 80, come down below 80. But the possibility of it crossing three-digit figure is only in case of the Strait of Hormuz is really closed, not said to be closed.
Okay, really closed and said to be closed is the big differential there. Just, your take, Mr. Surana, on India's needs, and just let's pull out from just HPCL right now because you have that amazing perspective. In terms of India's needs, alternates already exist from Russia, etc. How vulnerable are we to all of the geopolitical tension right now?
There is a substantial amount of oil and LNG which flows through Strait of Hormuz. So it is not only a question of, because the oil is an international commodity all said and done, and if there is a shortage of oil in the world, the prices will go up. So supply-wise, I don't see that concern because there is a surplus capacity available in the world. And fortunately, India has diversified their sources over a period of time, and while we are still dependent, but less dependent than earlier on the crude which is passing through Strait of Hormuz. But if there is a blockade at Strait of Hormuz, then definitely there will be a sudden spike in the crude price, and that should be worrying to us as well.
Okay. Mr. Surana, one final word. I don't know how much of a liberty you are at to speak about this, but just judging from the capacities that you set up HPCL to build out, right? And now everybody is recognizing that and talking about how earnings for the next 2-3 years could actually be good. I mean, ceteris paribus, oil prices behaving themselves. You reckon from your vantage point that the earnings strength for an HPCL or some of the other oil marketing companies, but HPCL in particular, could be very strong in the next couple of years?
The HPCL has taken actions to increase their capacity, strengthen their product portfolio, and diversify their product portfolio. And many of these projects are coming to fructification. Some have already commissioned, some are going to be commissioned soon. So so HPCL definitely have got a trigger point for building up their profitability on that. And if it is coupled with the good refinery margins, I think that HPCL will be beneficiary of it. The second thing is that if the crude price, normally we believe that the base range is 60 to 65, and all the risk premium which are built in to take it above 65, it goes down over a period of time as the tension settles. Then I would believe that all the oil marketing companies should be a beneficiary of that, and HPCL more because of the projects which are coming to fructification now. But that's my personal opinion.
Okay, thank you so much, M.K. Surana, there, former CMD of HPCL, giving his inputs and perspective on what is happening right now. Thank you so much, Mr. Surana, for putting that in place. So, no need to panic as of now. There is some time before you see any impact on pump prices, some time before you see any impact on the books of oil marketing companies as well. It's a threat right now that there will be a closure of the Strait of Hormuz. In fact, we'll pull that up for you in just a couple of minutes. But and you know, there's actually a website which gives you a live map of what's happening in the Strait of Hormuz, and you don't really see any stoppage or, you know, slowdown in traffic over there. So as of this morning, not so much. Although I must say that the Nifty has taken a turn for the worst, near close to its lowest point of the day, as I can see from that chart, over 1% down. 255 points down. Just look at that map, Neeraj. I found that very interesting. All those little very busy bits you're seeing is actually all of the action in the Strait of Hormuz.
Wow.
Yeah. And so you can see that it's business as usual right now. There will be a whole process before they do that. And what they will do is they will get their warships there. It's a very narrow passage. So first they'll get their warships in, and they will get, you know, those warships to then stop ships passing through. It's fairly simple for them to do, and they've done it temporarily for countries that they don't like. So this is a little more complicated than it's being made out to be. It's not as if, you know, it's a rail track crossing ke aapne patri niche kar di. This is going to be some time before this bears out.
Yeah, but as they say, right, a picture can speak 1,000 words, and that kind of showed it very, very well. So yeah, very interesting. Okay, and you know, while that has been the big talking point, there is a lot of other smaller pieces around markets, right? And let's focus on those for a bit. So before we get the big battery of other guests, market guests coming in. So first, defense companies, they are in focus obviously on back of various order wins as well. Anushi Johnson to tell us about BEL, Zen Technologies and HAL. Anushi, good morning. Why are these in focus today?
Hi, good morning, Neeraj. So BEL in focus on the back of the order win that we are looking at, roughly the size of 585 crore, and they've got orders for fire control and sighting systems for missiles, communication equipment and jammers, along with spares and services. Now, do note that the company had a margin of 29% in FY25, but now they're guiding for a 27% of a margin forward, so that is something we need to keep a track of. 15% is the revenue growth projection as well, and order inflows would be particularly interesting to watch out for. 57,000 crore is the kind of size that we are seeing for inflows for BEL this year. This, of course, includes the big ticket order size of 30,000 crore of QR SAM project as well. Now, HAL, on Friday, we did highlight that it was, as per reports, that it had won a 500 crore of an order win. Now we have that wherein the company has won the bid for manufacturing small satellite launch vehicles developed by ISRO, and this is a new opportunity and foray for HAL forward. Again, this 500 crore was stated earlier in the media reports as well. So, and this is a big update that we are seeing for HAL, is since for ISRO, this is the first of its kind of an order that they have given to a company like HAL. Order book positioning, if you look at for HAL, that stood at 1.84 lakh crore, which was a 95% of an upside considering last year's levels. And final one in focus is Zen Technologies, wherein they've acquired a majority stake in Tessa Aerospace. Now, Tessa Aerospace specializes in Indian development loitering munitions along with UAVs, that's unmanned aerial vehicles. Now this is a move to strengthen their presence in the drone market that we are looking at. So Zentech already has a presence in anti-drone system, but now they want to expand their presence in the drone market as well. So an interesting update that we are looking at here as well. So these are the three stocks in the defense space in focus.
So defense in focus, Zentech about 2.5% up. Let's pull up Nifty Defense, the chart for the day. It's come off some of the highs of the day, even as the market mood is fluctuating at this point. But Paras Defense doing well, as are some of the others. HAL and BEL also in focus. What's not doing well is IT. Let's pull up the Nifty IT as well as its components, and you'll see some pain there. Why is that Accenture read-through seen as so negative? 1.5% down on the Nifty IT. Sushovan Nayak joining in. He's research analyst at Anand Rathi Institutional Equities. Sushovan, good morning to you. What did you find, if anything, a little worrisome in the Accenture read-through? Because most of the notes look at it as neutral to positive for Indian IT.
Yeah, hi. This is Shovan here. Hope my voice is audible.
Yes, you are. Please go ahead.
Sure. So basically, one of the reasons why it would have corrected post the results is basically the bookings, right? If you look at the bookings, that is reduced by 6.5%, and within that, the outsourcing bookings have reduced by 10%. The other bit was also your headcount. There has been a decline of almost 1% QOQ. But if you look at it on a YOY basis, that's actually increased. So one of the reasons I believe it would have been construed negatively is because of the US government-related contracts that the management did mention during the con call that there would be almost a 200 bits headwind on account of that. But if we look at it from an Indian IT perspective, I think the BFSI growth, that is almost 13% YOY and 9% quarter on quarter, which is actually very good for the BFSI focused play. Having said that, the discretionary demand environment remains weak, and even in our thematic, we had basically highlighted that Q1 and Q2 may not be that great for an Indian IT perspective, but because the tariff exposures also would result in some weakness. But overall, from a BFSI focused place, those companies should do well, is what our view is.
Okay. So Shovan, it's been good morning and thank you for joining in. It's been a bit of a what we out here call a tic-tac-toe move for IT services, right? The last 2-3 weeks, up one day, down the next, and it's literally been a pattern of sorts. Is there a breakout from this range anticipated because of business reasons, or a breakdown maybe because of business reasons, or do you reckon RT says range bound for the foreseeable future?
At least the next 1 or 2 quarters, it will be more like one has to be very stock specific, because if you look at the ER&D plays, right, given their exposure to tariffs or whichever companies have got exposure to manufacturing, those are the ones which would get impacted from the next couple of quarters. But if you look at the BFSI focused plays, I think those are the ones which will do really well. And that's basically the thought process.
Would be your pecking order, Sushovan, for Indian IT right now, if you want to build a position, and since it is a bit of a down day?
I would say from the large caps, we really like LTIM and we like Infosys from a large cap standpoint. From the mid caps, we believe that someone like an Mphasis, which has got high BFSI exposure, possibly a Coforge, high BFSI exposure, should continue to do well. Persistent has been doing well. The other bit is Intellect Design is also one of the companies which we like, and Happiest Minds. These are the two companies, because Intellect being a 100% BFSI play, the other one, Happiest Minds, there is an M&A transformation play, which is focusing more towards the BFSI and healthcare. Those are the companies which we like as of now, or which will be beneficiaries on account of the BFSI exposure as such.
Okay, thank you for that, Sushovan Nayak there, and quite a long list of stuff that they like coming in. But quick look at where the markets are headed at this point. And Neeraj, I reckon a little bit of a turn for the worse, not massively. You're still under 1% down on the Nifty. Some pockets which are showing weakness, and we should pull up the sectoral heat map there for perspective. Definitely IT, what we spoke about right now. The fact is that markets can't make up their mind on what's happening. And these are some of the quotes. Guys, we've spoken to some of the biggest voices to get you a sense of what they are thinking, what the street is thinking. So let me start with what Nilesh Shah has told us. He's told us Indian equity and Rates market is like man having average temperatures. One leg is in cold water and the other is in hot water right now. He says domestic factors support current valuation for long-term investors, expecting moderate returns. So a bit of a reality check there. Says traders should be extremely cautious. Investors should use correction as an opportunity to accumulate. If you look at it that way, then today is a day to accumulate.
Yeah, and some more voices, by the way. So from the micro to the macro, Manish Dangi, founder of Macro Mosaic Investing and Research, says that we've entered a forever war world. No quick resolution expected in the Iran-Israel conflict. Market impact will be substantial if it hits oil flows and prices. That's the real transmission channel to us in India. Purely from reaction function standpoint, Iran blockading could be likely, and oil is the insider of geopolitics. And if that is the case, then for now, oil is not showing that much of stress, which is maybe a positive.
Meanwhile, here's what Navneet is saying. Navneet Munot says the Iran-Israel conflict is witnessing a significant escalation and may induce further volatility in global markets. For Indian markets, while fundamentals remain strong, there could be a knee-jerk reaction led by global concerns. However, India's robust domestic demand, macroeconomic stability, and ongoing policy momentum provide resilience. Investors should avoid knee-jerk reactions and stay aligned with their long-term goals. Diversification and asset allocation are key. So these are some of the quotes that we have. We have a very short break that we're going into, but on the other side, we get you more news. We tell you why diagnostic stocks are reacting negatively today. We tell you what to do with small finance banks, and of course, that great conversation with Prashant Khemka coming up. All of that on the other side of this break.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Welcome back. You're watching India Market Open. Joined now by Prashant Khemka, founder of White Oak Capital Group. Prashant, very good morning to you, and thank you so much for speaking with us. You know, unbothered, largely speaking, is what Indian markets seem to be saying, and the message that they're giving investors. Is there trouble brewing under the surface that we're not really seeing right now? How are you looking at the way markets are responding to all of the action and events in the last couple of days?
Sure, Tamanna. Thanks for having me on the show. So actually, I'm a bit surprised. I would have thought today there would be a bit of a relief rally.
Oh.
Yeah, so we might see a green market. But reality is not that the market was beat up much on worries around the Middle East conflict. So maybe, there wasn't, it wasn't that much of a rally I was thinking, but I was my gut feel was that it might be green, but obviously the markets are down, as you can see on the screen, by a percentage point or so. The reason I felt it could be a relief is because I think the actions over the weekend, the developments over the weekend, and not going into geopolitics, because I'm certainly not an expert on geopolitics, if at all in any subject, not going into who's right, who's wrong. But I do think this would lead to, it would result in a relative period of calm, or a period of relative calm. There could be some ripples, but there's nothing that suggests to me that it would escalate into a wider conflict. No other countries got involved. Obviously, US got involved, but when US gets involved, that in itself may lead others to stay out of it. Yeah. So that's how I view it. I would have expected, now that there is this risk that people are talking about Strait of Hormuz, but very little that I know about Strait of Hormuz. While it is 20% of global oil transits through there, 80% of that, or more than 80% of it, is the destination is Asia. Largest one being China, then India, South Korea, Japan. None of these countries had a role to play in war. None of these countries, against Iran in any, did not express anything, or there's no history of any animosity with Iran. So yes, I've read that the parliament has approved, if the leader there decides to shut down the Strait of Hormuz, but it's not going to hurt neither Israel nor US. So I just don't know whether it's just a belligerent act of, punishing someone in the world, then it's a different thing. But it is a self-inflicting wound as well. It's like apne pairo pe kulhadi types. They are one of the biggest beneficiaries of oil transport through Strait of Hormuz, and the other beneficiaries are all Asian countries. So why would someone do that? It's hard for me, but as I said, I'm not a expert in geopolitical strategy or anything. But it would seem to me that's not a high probability event. And even if it does materialize, I don't believe it is sustainable for any material period of time, because it inflicts more damage on Iran and other Middle East countries than anybody else.
Prashant, good morning. In some sense, what I'm trying to understand from your opening answer is that this could well mark the beginning of the end of the conflict, at least the one which has been the most recent one, which is involving Israel and Iran per se, right? And therefore, should that be viewed constructively for risk assets, given that the other conflicts still linger on?
I agree. I think you put it well, Neeraj. It could mark beginning of de-escalation or end, because the main area of concern was, for many years, was the potential nuclear capabilities that Iran was building. If indeed those capabilities have been set back, nobody knows for sure. America or Trump has claimed that those, as he put it, obliterated those capabilities and all. If indeed that is true, then that risk is no longer a risk that Israel or America want to eliminate anymore. So Israel and America are now that, yes, from our perspective, the job is done, unless they find something contrary to their assumption that those capabilities are obliterated. Yeah, and once, I think if America and Israel pull back, then it should lead to de-escalation of at least conventional warfare. Now there could be, that's why I'm not saying it would lead to peace, but it could lead to relative calm. On the surface, at least, the conventional warfare should calm down. Beneath the surface, it could be like there was in Cold War, always people are building their next step. But that could be very long period. It may not manifest itself in form of conventional warfare, is my belief, naive belief, you may say.
Prashant, so then, from an investor perspective, It doesn't seem as bad, but no one, I think, is willing at this point to stick their neck out and saying all is well. We are in times where, you wake up.
Tamanna, the moment the market goes up 1%, everyone would say on your channel, all is well. It's just that market is 1% down. That's why people are assuming that market must be seeing something still of concern, and that is why all is not well.
No, Prashant, for a second, let's keep what the markets are doing today aside. Just the fact that, this was something that people didn't expect, that the US will actually go into Iran and bomb 3 nuclear sites and then wait and see what happens. We've not seen the what happens next. That's the only part that I'm trying to say. All right, you will keep this aside. We're 1% down. Should have been much more if there was any real concern as of this moment. But having said that, my question is then, is this a wait and watch kind of moment as you are looking at as an astute market reader? Is this a let's go all in while there is still turbulence moment? How are you feeling about the investment horizon in light of what's happening?
So certainly, I think, Tamanna, look, the oil markets, the way they have been behaving, and if you read and hear, obviously Trump is completely unpredictable for himself as well. So we can't say that based on his actions and comments, this was to be expected. But a lot of what he said over the last 2-3 weeks, and he was changing his comments in this direction, initially saying US has nothing to do with it. And then maybe in 2 weeks' time, he likes to keep that element of surprise. So it was building in the direction that US may get involved in some form or fashion. And they've done this in a clinical manner right now. Be that as it may, what is in the past, I think, yes, we always have to wait and watch how it comes through. All I'm saying is right now, based on what has already happened and what US is claiming that it is done, we are happy. We are satisfied with the outcome. Now, US is no longer the aggressor, and nor would Israel be anymore towards Iran. Now, Iran, whether it retaliates in a very aggressive form, it remains to be seen. And yes, that is a wait and watch. I am willing to, and obviously we are not betting anything in our portfolios basis this. This is just an entertaining, analysis of a geopolitical event. I would say that my bet would be that from here, regardless of commentary and maybe some actions which are, like minor ripples of the main event, but nothing that would perturb the market. And we should see de-escalation, at least from a conventional war perspective in Middle East, especially related to Iran-Israel.
Got it. Okay, Prashant, that's great. And Prashant, with your permission, I would also want to invite Mahesh Nandurkar or Jeffries into this conversation. Just good to get both of you on the same platform and just try and understand how both of you think about it before we let you go, Prashant, because I know you've given us 10-12 minutes, so we won't exceed it beyond. But Mahesh, we were just talking to Prashant, right? And he's saying that he believes that, one, he's surprised by the market reaction today. And in his wisdom, this might well be the beginning of the end of the conflict. And Prashant, I hope I'm not misquoting you here, but Prashant believes that might be constructive for risk assets by and large. Now, what is your sense, Mahesh?
Yeah, hi Neeraj, hi Prashant, hi Tamanna. So I would agree with what Prashant said in terms of the market reaction today. We've been watching the region as well. I think the market movement even from the region is not really that scary. Oil prices are up, but they're up about 2% or so. So again, not scary. So I would tend to go with what Prashant said, that from the reaction that we've seen for today, it looks like not a scary scenario. But whether it's a great news for the market from the medium term to long term perspective. The event itself probably is not turn out to be as scary as we just discussed. But obviously, outside of the event, there are many other things, which is the valuations, the earnings growth, what we're seeing in the corporate earnings and so on. And I think and more so the corporate equity supply as well, and keeping all those things in mind, I would say that it's not very easy to take a very bullish view on the markets at this point in time.
Not easy to take a bullish view, perhaps, and I want to come to some of those other factors with Prashant very quickly. Look at the advanced tax numbers that have come out, muted to say the least. Yes, the RBI is trying its best. We've had some push coming in from the RBI, but they did change their stance back from accommodative to neutral. Do you think that from an Indian perspective, maybe there are not bigger fish to fry, but other problems that we need to tackle as well before we head into Q2 and get more cues from there on corporate earnings?
Yeah, Sudhamana, these are all part and parcel of what I call conventional macro. And I think historically they've not really moved much the market. These are how many times, Tamanna, you see over the last 2, 3, 5 years, you would have muted numbers from advanced tax or from GST collection. Sometimes they're strong, sometimes they're weak. These are just day to day. Even if they move the market, they might move by some basis points, 5, 10 basis points, which would not be evident from watching the market because there's just normal volatility there. So I think they're all part and parcel of normal life. And we don't really follow these so much. So I don't have a very or any view on the impact of these. I think earnings growth through all this should, because you have like dozens and dozens of these factors, right? The monsoon is good, something else is poor, and so on and so forth. So I think low double-digit earnings growth for the coming year is reasonable expectation. And that's good enough for market where it is currently valued at the average of last 10 years, 10, 11, like from 2014 till now, last 11 year average is about 20, 21 times, which is where the market is today on forward 12 months number. So it's a normal valuation for a average kind of earnings growth over expected, not just over the next 12 months, but I would say looking forward for years to come.
Mahesh, just want to get your sense about the kind of appetite that you expect to see going forward, looking at what's happening in promoter stake sales, what's happening in the private equity space, in the IPO space. Do you see that cash squeeze continue? And what are you reading in the tea leaves when you see so many promoters coming in to maybe cash out?
Yeah, so the equity paper supply, in my view, is a reasonably large factor for all of us to keep in mind. I would say that the second half of last calendar year, which is between July to December last year, we saw a pretty big jump in the equity paper supply, and our calculations suggest that it was upwards of $7 billion a month. And this time around, we obviously started the year on a quiet note because the market itself was not really doing that well. But in the month of May, we saw about $7 billion of money being raised. June is moving towards that direction. And from what I understand, if the market stays where it is, then probably this type of supply will be continuing going forward as well over the next several months, and which I think in turn will probably cap the market return. So that's, is one of the reasons why I feel that I feel that the markets may not really move dramatically upwards from here on. The demand side for equity, which is the flows that we talk about, the domestic flows, the foreign flows, I think those are on the positive side. Although the domestic flows, understandably so, have come down somewhat, but still in the net positive zone as we speak. The foreign flows have turned positive over the last 2-3 months, and I would say that my interactions with global investors suggest that there is an incremental interest, coming towards, I would say broadly the non-US markets like the European eventually should flow into emerging markets as well. And India is obviously one of the more prominent of all of those. So that's been on the positive side. So that I think story is well flagged, but I think this equity supply is something that we need to keep in mind. I would broadly say that it's not such a bad thing for the equity supply to have increased, because I think this will also help keep the market valuations under check, in my view.
Okay, Prashant, before we let you go, and it's an interesting point that, of course, Mahesh has spoken about as well. Two factors to this, because you are also an investor into global markets, which are competing with India. And at the same time, you're a recipient of flows from your investors who might want this India exposure in a meaningful way, right? How do you see this playing out? When you are looking at a GEM fund, are you increasing or decreasing the allocation to India? And what do you hear from your clients, Prashant, about the feel to invest into India or non-US assets, as a lot of people, including Jeffrey Gundlach, has said that, put money into India and don't look at the tape for the next 30 years and you will benefit, etc. How do you think about it as an investor?
Certainly. So see, in our EM fund, we are usually, and our clients also, expect, or we've set that expectation with our clients also, to expect India to be almost always be a higher allocation than the benchmark. So over allocated to India. It's not necessarily a top-down bullish view that India would outperform the rest of the world or anything. It's just that the bottom-up alpha opportunities, the opportunity to outperform the market, we find more compelling numbers in India, larger number of such opportunities in India, and also where our capabilities are the strongest. We have a home ground advantage in India as well. So it is overweight, but for different reasons, not necessarily because we believe India would outperform. We, consistent with what Mahesh was saying, I would say that we expect India to deliver moderate or average returns, which it has delivered historically, which is low double-digit returns in rupee terms, high single-digit in dollar terms, which is not expected to be too different from what other emerging market countries may provide at an index level. But at a stock selection or at a portfolio level, we expect the alpha or outperformance in India to be stronger given the capabilities we have and given the nature of the Indian market.
Prashant, thank you so much for your time and extension of your time here. And we really enjoyed that conversation with you and Mahesh, but we'll let you go.
Always a pleasure, Tamanna and Neeraj, and good to see you, Mahesh.
All right, so Prashant Khemka there. We'll continue the conversation with Mahesh Nandurkar, of course. And Mahesh, I just want to pick up from what you said last, where you said that the interest from foreign investors is beginning to shore up when it comes to India. Where is that interest going? Because your typical sort of destinations, your BFSI, is not showing that kind of spark. Do you think that there are underlying worries there? What are you liking right now when you see, the markets from an India perspective?
Yeah, so you're right. So typically, the large FPI flows, when we see the tides turning, it usually goes in favor of BFSI segment, as you rightly mentioned. But I think, this time around, I think the key point to note here is that despite the fact that we've seen such a large rate cuts by the RBI, and the fact that it is likely to have a negative near-term impact on the bank's EPS because of the net interest margins going down, the banking sector has actually performed in line with the market, actually slightly better than the market. So in fact, I would say that the large banks that did underperform for a period of time, year to date in this current calendar, they've actually done reasonably well. And we were expecting it to be that way. And I'm glad that it has turned out to be that way. So I would say that from the foreign investors' point of view, banks and also I would say NBFCs would continue to be one of the areas that would look interesting to them. Also from the valuation standpoint, while one would argue that the current MSCI sort of index trading at about, let's say, 22 times 1 year forward earnings is about one standard deviation higher than the last 10-year average, but the average at the index level have been held down because of the banks. If you actually take the BFSI segment or the banking sector out, the 1 year forward earnings multiple for the market as a whole would jump up to 26 times, which is quite steep. So it's the valuation comfort and also the fact that the RBI has turned significantly pro-growth as compared to the stance that it had most part of last calendar year is also a big positive for the lenders, for the BFSI segment as a whole. So that does remain one of our most attractive sectoral bets.
Got it. Got it. And yeah, I mean, with the new Reserve Bank of India, it seems to be a different landscape altogether. Mahesh, the other factor is whether this whole geopolitical piece that continues now in such a wide fashion, despite the hopeful de-escalation, at least with Iran and Israel, does it make the richly valued defense stocks still stay center stage in the minds of investors and firms like yours, which are writing notes on these companies? Do they occupy mind space?
They do, and I think it would continue to do. It would continue to be that way, in my view, because increasingly what we are seeing is that there are more and more such instances that we are seeing over the last 2-3 years. And as far as India's defense expenditure goes, I would say that the defense capex as a percentage of GDP today is at about 50 basis points. Over the last 20 years, if you see, it has ranged between 50 basis points to 1 percentage point of GDP. And given all the geopolitical tensions all around the world, also in the subcontinent, I think even for India, it needs to be towards the higher end of the historical range and not the lower end. So my sense is that over the next 5 years or so, I would expect India's defense capex to be rising by 25% CAGR. And plus, on top of that, there are other things like Make in India, and there are some small examples of Indian armaments being exported as well, etc. So there is a pretty strong growth outlook for many of the companies that are involved in this defense space. And I hear what you said completely, that the valuations are rich and it's going to take some time for the order book to grow and etc. But I think from a thematic perspective, it still makes sense to be positioned in that space.
So we've talked about BFSI, you're constructive, defense, you're constructive. How are you feeling about IT, Mahesh?
IT, we are not feeling that constructive. So it's a sector that we have been, underweight on. And I think, given where the stocks have moved up very quickly in the last, 1 month or so, towards the higher end, in fact, almost like 1 standard deviation higher than their historical averages. And clearly the economic outlook in the US is not really very conducive in terms of the discretionary capex for the large US corporations to be rising at this point in time. In fact, one of the large companies that just reported results over the weekend, the numbers were actually, not that great, and they've ended up cutting the guidance as well. So my sense is that given the combination of pretty richly valued, PE multiples, and combined with that, the fact that the outlook from the US corporations increasing their discretionary capex doesn't look that great, we would be underweight on IT services.
Just on Accenture, Mahesh, a follow-up there, because, the way Accenture read from brokerages as well, this morning as well, it didn't seem half as bad. Which is why just a little bit more of elaboration there from you. Growth guidance 6 to 7%. What, if you had to narrow down or pinpoint, what is the concern or the red sign or the red flag that you're seeing there, which is of course a spillover for Indian IT?
Yeah, I unfortunately cannot talk about individual stocks here, but what I would broadly speaking say is that the fact that the growth guidance was brought down. And as I mentioned earlier, what we really need for the Indian IT services companies to kind of outperform going forward is the confidence that the discretionary capex from the USA is going to be rising, and we are not getting that comfort at this point in time.
Okay, Mahesh, one final word, and which is that what's the dark horse here? I mean, in a market which you don't anticipate to go so high, and some of the usual suspects like BFSI and defense being top of the mind, if you will, is there a dark horse, something that you guys might be a minority on, either on the bullish side or on the bearish side?
Yeah, so on the bullish side, I would say apart from these two, the other sectors that we like are telecom. I would say cement, and also two-wheelers. So those are the other three sectors that we like. Now, one might say that telecom is not really a dark horse because it's a sector that has already done quite well. So yeah, maybe not. I would also highlight cement, as a sector here, because I feel that the pricing environment in cement has turned around, and I think cement pricing is really the key for the stocks to perform. And my sense is that after remaining subdued for a very long period of time, for nearly last 10 years now, in my view, the cement pricing is showing some initial signs of moving up. So I would say that can be, a pretty strong dark horse going forward. And one of the factors that I wanted to sort of support that thesis with is also the fact that if you look at, and it's a slightly different angle, a differentiated angle, which is, on the GST side. So we all know that when GST was implemented, back in 2017, there was, a 5-year window that was given for the state governments in the form of GST cess collected on some of the categories and distributed to the states as a way of compensation. And that was supposed to get over by 2022. But then afterwards, because of the COVID that came in between, there was a shortfall, and then that compensation period was extended, through to like March 26. So it's basically this current financial year, FY26, is the last financial year, wherein that compensation will be paid, and which basically means that, almost a $20 billion annual GST cess collection will be surplus from next year onwards. And government has a lot of options to use that $20 billion. I mean, one is obviously upping the defense sort of capex, bringing down the fiscal deficit, and variety of other things. But specifically in case of GST, also I see a strong case for the GST on some categories where it's sitting at a very high level of 28% can be viewed. And I would say two-wheelers and cement are the two sectors where there's a possibility of that being sort of viewed. So that's an additional point, for cement. But as I said, the basic thesis that we have is the pricing environment has started to improve.
All right. Thank you so much, Mahesh. Always a pleasure to chat with you. Mahesh Nandurkar of Jefferies there with, that clarity and view. I think the big headline coming out from there is also that foreign investors have started showing more and more interest in Indian markets, and that really is beginning to be seen. All right, one stock which is in focus this morning, before we wrap the show, we want to talk about it very quickly, Zee Entertainment. Now, over the weekend, they put out their investor presentation. In fact, yesterday, there's a reason that stock is 8% up. They are hoping to achieve break-even in Z5 in FY25 itself, or FY26 is it? Hiral, give us more details.
Thank you, Tamanna, for that. So that's an interesting point that they've made, that they will achieve, they're planning to achieve a break-even in Z5, with regards to an EBITDA loss that was posted of around 548 crores on FY25. And this is, they're talking about FY26. They're looking at maximization of risk-free treasury income as well. So that is going to be an addition, other income benefit that the company is looking to get. Very quickly, what they've indicated is a significant cash reserve is what they are aiming at. And this is mainly to compete with competition effectively, for which they've actually gone ahead and enhanced their digital offerings as well in a profitable manner. And this is in the domestic and the international market without going beyond the content ecosystem. They're developing new business verticals as well to expand its target audience and augment the revenue streams. And they're looking at a new distribution business model as well, so that they capture a larger, portion in terms of eyeballs. They're enhancing their content offering from long format to short format. And because of this, if you see the stock price run up in the last 1 month as well, it's pretty much on an upward trajectory. They will look at expansion in the inorganic format through acquisitions or strategic partnerships, and this will mainly be done in high growth verticals such as digital music. And they've said that they will maintain a healthy balance sheet and closely monitor any medium term capital requirements. They have proposed a preferential issue as well, and this is through fully convertible warrants of around 2,240 odd crores. The conversion price per warrant is around 132, wherein the floor price is around 128. So it's 25% of the upfront consideration, whereas the balance 75% will be within 18 months, and the conversion will happen into equity post the receipt of 100% consideration, for which they are looking at a shareholder approval at a meeting that will be held on the 10th of July. And post this conversion, the promoter stake then will be around 18.39%. Very lastly, in terms of growth initiatives, they've said all of it will be core to the business and scalable and value accretive from here on. The capital that will be deployed with regards to where the growth initiatives are concerned will be mainly aimed at enhancing profitability of the company in the next 3 years, and it will surpass the highest earnings per share that was delivered by the company, and this was at a capital base of around 16.5. This was back then in FY19. So the plans are looking absolutely strong with regards to the commentary that they've put out in the investor presentation. Execution is going to be key from here on, and the meeting on the 10th of July with regards to the warrants is going to be interesting to watch out for.
Okay, so all right, Z, and frankly, media is doing well as well. Saregama also up this morning. So some bright spots there. We're leaving the show with markets, I would say, consolidating but range bound, less than about 1% down, which all things considered is not half bad, Neeraj, as we wrap up India Market Open.
Yeah, summed it up well. So nothing more to add to that. Consolidating, range bound, 1% lower, an outcome much better than what people would have anticipated. But if you have specific queries, stay on. It's a wrap on India Market Open, of course, but Ask Profit comes up next. So stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Source is an ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Markets move fast.
And so
Hi, thanks so much for joining in. Happy Monday to you. My name is Alex Matthew. With me is Mahima Vachrajani, and this is Ask Profit. I know a lot of you woke up this morning getting ready to buy the dip, but Mahima, where's the dip?
exactly. Like we were joking about yesterday, also we were talking to a lot of market analysts, and in fact they said that the markets are mature enough to take this, and we might not see a significant amount of downtick. But yes, there's no dip as such to buy the dip.
Absolutely.
For sure.
So let's talk about what's happening, right? So, and ultimately from India's perspective, the big focus has been crude oil prices, and Brent crude has remained pretty much where it was over the course of the weekend, or actually last week, and it's hovering around that $77 per barrel mark. And why this is that while there is a threat to close the Strait of Hormuz, which is, as you know, a major maritime route that allows the transfer of both crude oil as well as natural gas, that hasn't happened yet. And as a result of which crude oil prices are where they were. Of course, there is a risk premium, that is because of this increased geopolitical tension. The analysts are saying that as much as $10 is added to the cost of crude, but it's not very, very bad at this point. It's not, as some people were projecting, rising as much as $100 per barrel. And that's good news for India. So you have the benchmark that is trading with cuts of about 0.9%. And this, when compared with what happened on Friday, where the equity markets rallied in a broad-based rally, and you had the Nifty 50 that went above 25,000, well, this is par for the course. You expect that there would be some unwinding of what happened on Friday. But the broader markets are looking better. In fact, the mid-cap index is down just about 0.1% or 0.2% or so, and the small-cap index is trading in the green. I also want to take a look at the market breadth to see how it's changed over the course of the morning so far. I wouldn't be surprised if the gap is narrowed, and that indeed has taken place. So there you see, at the start of trade, you had a pretty wide gap between the advances and declines. The green there is the advances, and that has closed quite a bit. So you could see that panning out over the course of the session as well. I'll very quickly point out one sector that is in focus, or rather two. One is IT. IT is the big laggard in trade today, down about 1.6%, and that's because the Accenture numbers flattered to deceive, you can call it that. And so quite a few of the large cap names are losing ground. Infosys is one of them, which is the biggest loser on the Nifty 50 and down about 2.5% or so. But defense on the other end of the spectrum is doing particularly well for obvious reasons, because geopolitics is once again at the forefront and is gaining about 1.4%.
Right, and some other counters that are doing well, Z Limited especially, because the entertainment, because of the presentation where they've mentioned that Z5 will achieve break-even in FY26, and the stock is soaring on the back of that, up almost 9% as we speak. LT Foods under pressure because its US subsidiary received a countervailing duty of more than 340%. BL, HAL on the back of order wins, Zentech as well on the back of order wins. Of course, the geopolitical reason as well. There's Lloyd's Metal, which is also buzzing in trade on commissioning of two of its plants. There's Aventil again on the back of an order win. The stock is up. NLC India also on the back of an LOA is up and doing well in trade today. But these are some stock specific names of course. With that, let's also welcome in our guest for the day, Nilesh Jain, Centrum Broking, from Centrum Broking, and Saurabh Jain of SMC Global Securities joining us now. Before I take stock specific questions, Nilesh, your quick view on how you're expecting markets to pan out this week.
Very good morning to you. Good morning, everyone. So this week, since we have monthly F&O expiry for the Nifty and Bank Nifty, we are expecting a bit of volatility. Today, we have seen a gap down opening, and markets are not able to hold on to its gain that we saw on Friday. And today is more sort of a consolidation we are witnessing. Good part is that Nifty is still trading well above its 21-day moving average, that is placed at 24,860. So that is likely to act immediate support from intraday point of view, followed by 24,500. That's the strike where we have seen huge amount of put writing. So from this week's point of view, I think the broader range for the Nifty could be 24,500, 25,200, and narrow range could be somewhere around 24,700. Nifty should find some bit of support, and we may see rebound from here. And on the upside, a breakout about 25,000 will open further upside of 25,200 as well. So overall, we are expecting a bit of volatility where stocks and sector specific moves should continue. And the volatility index today spiked up close to 3%. It is currently at 14.11. So overall, it is very much in the comfort zone as of now. But any rise from here would be a cause of concern. So watch out for important levels as highlighted. We are expecting sectors and sectorial and stock specific move to continue.
All right. So, by the way, we started the show. I assume that a lot of you know this, but in case you don't, you can call us on the number that is on the bottom of your screen, or you can send us a message on the number that is on the top of your screen, as quite a few of you have already done. So, without further ado, let me go across to the first question. And Kailash Patil is writing in from Pune and asking about NMDC, which he's bought at levels of 40 rupees. He's considering adding more at the current price. Is this the ideal time to accumulate further? And is this a good idea to hold as a portfolio stock? He's identified that he wants to hold this for at least 10 years, which is quite a long period of time. Saurav, very good morning to you. What would you say about NMDC?
Good morning, Alex. See, for the 10-year perspective, I think it is a kind of a value stock, and on the valuation side, it is quite comforting. Since he has got a very long horizon, I think it makes sense to add on the clients.
Could you tell me a little bit more about why you're saying this is a good value stock, earnings-wise as well?
Earning-wise, I mean, there is a bit of cyclicality in the metals. So, being a ore producer, we expect things to improve gradually going next year. And when things will improve, prices will also increase, and it will give margin expansion and higher profitability to the company. So, in that sense, I am saying it is a value stock.
So that's with regards to where NMDC stands. Our next question is from Pakshal Jain, who's writing in from Bellary. He's holding Manappuram Finance 160 shares bought at 177 a piece, and wants to know if he can hold or book profits. He wants a view for the next 2 odd years. Saurabh, I'll come to you on this one. Manappuram Finance, what's the outlook like?
While the business outlook is good, there are quite a bit of guidelines which has come for the gold loan companies. But in my opinion, I think when you're betting on a gold loan company, I think Muthoot Finance is a better choice than Manappuram.
Okay. All right. So that's a pick in the gold financing space. We've got our first caller of the day. Pradeep is calling us from Bengaluru. Pradeep, very good morning to you. How can we help you today?
Good morning to everybody there. See, I am a long-term investor, small-time long-term investor with a vision of another 2 to 3 years. Now, I had bought Pidilite Industries about 3.5 years back at 2,324 rupees. Now, this stock has not delivered significant returns in this period. So I just wanted to know whether I should hold on to it or whether I should book profits. And if I book profits, whether Shriram Finance is a good choice.
Okay. So, okay. All right. So, 2,324 was your buy price. You've held it for a little while. I think it's been a decent run. Of course, Pidilite is a very large company and large stock. So, therefore, the gains that you've had over that period are nothing to sneeze at. But the question is valid. So, let me go across to Saurabh. Saurabh, gains to the extent of it's now 2,941. So, he's made a pretty penny. Would you find a better outlet in the finance space? And a lot of people are pivoting in anticipation of an improvement in lending rates, etc.
Yeah, I mean, finance is anyway a good option. In fact, the choice he has made is also a good pick. But in my opinion, I think betting on a large cap bank like Axis or ICICI may also be a good choice.
So that's with regards to where these counters are concerned. Our next question is on Suman Capital. It's on Castrol India, and the person is a long-term investor. Ratish Menon is writing in, by the way, and he's a long-term investor, and he's holding 240 shares of Castrol India bought at 204 a piece. Wants to know if he can average or exit at the moment. So I'll again stick with you for this one for a specific reason, because Castrol India is that counter that uses oil as derivatives, and if crude intends to spike up further on the back of the entire Iran-Israel conflict, what is the kind of outlook for the company that you're watching out for, because that's a key raw material for them?
If you look at the automobile space, there has not been much growth. It's been basically all the OEMs are reporting, very negative or maybe a smaller growth rates. In case of Castrol India, it is not that its raw material is directly linked to crude oil prices, but it is related to base oil prices. Normally, company tries to maintain their margin in adverse conditions also. Yes, it is a good stock to hold for the long term. But in short term, I think there would not be any price movement with respect to the broader markets.
Okay, all right. So some of you are asking, in fact, Lalita, who's just messaged, is asking, I'm not sure my messages are being noticed. They are being noticed. It's just that Mahima and I can't respond to all of them. And by the way, this is addressed to you, Mahima, but I will take it if that's not a problem. Reddington is the name of the company that Lalita wants to know about. She's bought at levels of 45 rupees. She's asking whether it can be added at this price. Wow, 45 rupees, is that right? Can we pull up the very long-term charts and see when it hit that level? Okay, so I can't see 45 rupees on that chart as well. I'm wondering, yeah, at least 5 years. So she's been holding for a while. She's wondering whether it can be held for another 1 year. Can more be added? So Nilesh, I'll come to you on the charts. What are the prospects?
So Alex, this stock has given a good multi-bagger kind of return, and looking at the overall structure, still it has a potential to move towards 350 to 400 from a short to medium term perspective. Maybe next 1 year we may see the stock moving towards 350 to 400 zone. So overall, it's a buy and decline structure, but not advisable to buy at the high levels because the risk and reward is not favorable. It's better to wait for some bit of decline towards 260, 270. That can be a good entry point in terms of averaging as well. That can be done. For any long position, one should keep a trailing stop loss at 250. So that's a good support. If it breaks below 250, then chances are very high that we may see further selling pressure to continue. But as of now, it's good bet to be, stay put, and positionally 350 to 400 is the target.
Regards to where charts are concerned for Reddington. Our next question, in fact, our next caller, Raghuveer, is calling in from Bengaluru. Raghuveer, a very good morning to you. कैसे मदद करें आपकी?
Good morning. मेरा पास 2,400 शेयर है वकार फार्मा का, 280 रुपए में लिया हूँ।
ठीक है।
उसके पहले 750 से बेच चुका हूँ 1450 में।
ओके।
अभी एक साल रख सकता हूँ। अभी मैं ऊपर का टारगेट क्या रेट है?
ठीक है, मैं समझ गई आपका क्वेश्चन। सौरभ, आई टेक दिस अप विथ यू एंड इफ पॉसिबल आप हिंदी में आंसर कर सकते हैं तो वॉक हार्ड इज द काउंटर दैट ही इज होल्डिंग। 1 year इज इज टाइम पीरियड, व्हाट डू यू थिंक ही शुड डू?
देखिए, कंपनी ने पिछले कुछ सालों में काफी टर्न अराउंड किया, इन्हें इसी बात का काफी फायदा भी मिला। फार्मास्यूटिकल में एक अच्छी जानी मानी कंपनी मुझे लगती है। कुछ शेयर ये पहले ही 1450 रुपए में, जैसे इन्होंने बताया, बुक कर चुके हैं। मैं समझता हूँ कि कुछ शेयर इन्हें यहाँ पर भी जरूर बुक कर सकते हैं, और क्योंकि इनका 1 साल का नजरिया है, इससे ज्यादा ये नहीं रखना चाहते, तो मैं समझता हूँ कुछ अनिश्चितताएं हैं अभी भी बाजारों में। यूएस की तरफ से कुछ भी ऐसा आ सकता है जो इंडियन फार्मास्यूटिकल कंपनी के लिए नेगेटिव हो सकता है। तो मेरी सलाह रहेगी यहाँ पर भी और थोड़ा प्रॉफिट बुक करें और बाकी को होल्ड करें।
इफ यू आर स्टिल देयर, मेरे को सिर्फ एक बात समझनी थी, क्योंकि आपने बहुत अट्रैक्टिव प्राइस पे बाय किया है और ऑलमोस्ट 34 लाख प्लस के प्रॉफिट पे हैं आप। क्या सोच के बाय किया था वॉकहार्ड?
हेलो नहीं, हमें पहले 3-4 साल पहले बाय किया था।
हाँ।
हमने पहले 800 में किया, उसमें 600 में किया, उसमें 500 में किया, उसमें 200 में किया, उसके बाद लास्ट में 165 में 2000 बाय किया, तो टोटल 3000 बाय किया था मैं।
अच्छा।
उसके बाद 750, 1450 में भेजा। परसों 200 शेयर भेजा हूँ, 2770 में भेजा हूँ।
अच्छा, नहीं मैं पूछ रही हूँ कि जब आपने बाय किया तो क्या सोच के बाय किया ये?
हमने पहले 10 साल के पहले एक बार किया, तो उसमें मेरे को प्रॉफिट आया था, ऐसे ही प्रॉफिट आया था। 200 में पैसा 800 में सेल किया था, वही 800 आया था। इसलिए हमें 800 में ऊपर के करके एवरेज करके ऐसा रखा हूँ। अभी मेरा टारगेट है 2000 आ सकता है या नहीं आता, वही पूछ रहा हूँ मैं।
अच्छा ठीक है, ओके। 2000 आ सकता है कि नहीं? तो सौरभ का ये कहना है कि थोड़ा सा प्रॉफिट बुकिंग कर लो और थोड़ा सा रखो।
करने की शुरू किया हूँ।
ओके।
पिछले बार में 1750 में 200 शेयर बेच चुका हूँ। अभी हमें आज भी डाला हूँ 1900 में डाला हूँ 500 शेयर।
ठीक है, ओके, समझ गए रघुवीर। ठीक है, थैंक यू सो मच फॉर कॉलिंग एंड कांग्रेचुलेशंस ऑन द प्रॉफिट्स दैट यू आर मेकिंग। All right, our next question then is from Jai Krishnan, who's writing in from Kerala, and wants to know if this is the right time to make an entry in Technoplast from a medium term. Time Technoplast from a medium term perspective. Saurabh, I'll come to you on this one. Is Time Technoplast the right counter to make an entry into right now?
It's a very good and old company. If you look at the operational front, the business is making good progress. The company is putting up, double-digit growth year on year. In my sense, I think it is a good stock to invest.
If I remember correctly, the Q4 numbers for Time Technoplast were particularly good. And as a result of which the stock did rise quite dramatically over the course of the last 1 month. There you see about 20% or so. All right, Dheeraj is our next caller, calling us from Hyderabad. Very good morning, Dheeraj. How can we help you today?
Sir, good morning. Actually, thanks for the show. I should be very grateful to all of you guys, everyone.
It's our pleasure.
So, sir, my query is regarding Adani Green, sir.
Okay.
Sir, I have purchased 650 shares of Adani Green at 947 rupees. Sir, actually I have booked losses in Geofinance and Premier Energies of rupees 20,000.
Right.
And I have purchased these shares.
Yeah.
Because recently the stock reached a level of around 1080. In January, it reached, if you see the 1 year chart, the all-time high is around 2080 rupees.
Yes.
So, recently in January, it reached the level of 1080.
Yes.
So, I have seen strong support at 900 and 920 rupees. And Adani Green is a huge stock as in the renewable space and power space.
Yeah.
The entire power space is underperforming as of now.
Yeah.
And the entire renewable space is underperforming.
Yeah.
So if the index reaches the next level or the next week, I would like to hold it for the next 1 year actually.
Okay. So you're looking at what levels you can get. I got your question, Dheeraj, and very well analyzed. But let me get you a view on the technicals, if that is okay. Nilesh, I'm coming to you on this. 947 is the price that he's bought at. And he's looking at a 1 year potential. Of course, it's pretty far away from all-time highs. What is the upside potential that you see?
Well, Lex, this particular stock has been one of the underperformer, and recently, as he rightly pointed out, that the stock has taken a good support at 920, 930 zone. So that is still acting as a very strong support zone. With a stop loss below the same, long position can be held, and we can expect a gradual recovery towards 1050 to 1100 from a short-term perspective. And from a position perspective, a breakout is awaited. It should break the level of 1080. If that happens, then we can expect a strong movement today towards the levels of 1200 to 1300 as well. But do not expect this stock to correlate with the market because the stock has been one of the underperformer within this space as well. So keeping a stop loss near 920, long position can be held and we can expect a gradual recovery. But I'm not expecting any V-shaped kind of recovery in this particular stock.
Keep an eye on the fundamentals as well. There's a lot, Dheeraj, as you know, as you probably read, that is happening with renewable energy and what Adani Green specifically is doing. So I'd encourage you to have a look at that. But the standard disclaimer here, Adani Green is part of the Adani Group and so is NDTV Group, of which NDTV Profit is a part. The next question is from Anurag, who's writing in from New Delhi and asking about Amara Raja Energy and Mobility. He's bought 28 shares at an average price of 1,168 rupees per share and he's losing a little bit of ground. He's got a perspective for the next 1.5 to 2 years and he's wondering what he should do with this. Saurabh, on the fundamentals, is this the best play in your opinion in this space?
Well, it is a very good and old company in the battery space. They are doing a lot of research activity also on the lithium side also. They have a small business in the they have small exposure to towards mobile oil business also. But I don't know why this stock is consistently underperforming. If you look at the valuations, it is on the lower side. I think it is better. I think you should wait for this quarter, get the sense how this quarter pans out and what the management give guidance for the ensuing quarters, then take a call.
All right, so that's the view. Hold is the view on Amara Raja batteries. Our next caller, Vinod, is calling in from Karnataka. Vinod, a very good morning to you. How can we help you today?
I have brought the Varun Beverages shares of 512 rupees at 120 number of shares, ma'am.
Okay.
the share which is in negative trends still from past 6 months. I don't know what is the reason for the negative sentiment of the share, despite of doing good revenue and good profit from the last quarters and past year.
Right. And you want to continue to hold this from a longer term perspective, right, Vinod?
Yes, ma'am.
Okay, I'll take this up with Saurabh then. Saurabh, what he's talking about is that since the past 6 months, the stock has not done well. And this is because the stock had seen a significant run up before that. Plus, valuations have never gotten cheaper for something like a Varun Beverages, right? What's your sense like? Should he continue to hold this counter from a longer term perspective?
You're absolutely right. The stock has seen phenomenal rise and the valuations were always expensive. I think it is normally these 6 months are good period for this company. And after the so much expansion plans, I expect the numbers to be good for the June quarter and in fact also for the September quarter. My sense is it is better to hold.
Better to hold. Okay, Varun Beverages. Hope that answers your question, Vinod. The next question is from Sudhir Agarwal, who is asking about ACC. He's got 1,000 shares, which he's bought at levels of 1,890 and losing ground. He's wondering whether he can hold for the next 6 months to 1 year and what the potential upside is from this point. Nilesh, on the charts, what's the view?
See, on the chart, the stock has been in a downtrend. If you see from past almost 1 year, the stock has constantly formed a lower top and lower term formation. But good part is that after this correction, the stock is inching towards his multi-month support zone, and that support zone is placed somewhere around 1770 to 1800. So keeping a stop loss below 1770, one can stay put hoping for a pullback because the stock is still in a downtrend. Only pullback can be seen if at all it moves near about 1900 to 2000. That can be a good exit opportunity because the stock is not moving in an upward trajectory as of now. So looking more sort of a sideways to negative, you have better options within this space. Ambuja Cement and also counters like Ultratech Cement could be a better option. But ACC purely from a short to medium term perspective looks slightly on a weaker side.
All right, so that's a view on ACC. Govind has got the next question. Govind, very good morning. How can we help you today?
Good morning, Alex sir, and all of you. Good morning, sir.
Good morning.
Taking my query is a very honor, sir. Actually, Alex sir, I have one doubt, sir.
Yes, please.
Force Motors, can I observe for last 3 months? The stock is tremendous rally, sir. Is it right time to enter for long term investment, sir? At least I can invest at least 10 lakhs, sir. Actually,
wow.
For
Okay.
a bulk amount, actually.
Okay, so I'm glad
What
that
is the fundamentals and what is the technical?
Yeah.
Where can I enter?
Yeah, and that's an important question that you're asking, and I'm glad that you're asking before deploying that large quantity of money, because ultimately when you're buying such a large quantity, Govind, it's important that you get the right price for what you're paying. Let me go across to you, Saurabh. As he's pointed out, it's been a frenetic rally for Force Motors. I'm just wondering whether this is a catch-up rally, whether it is a little too hot, and whether you would deploy a considerable amount of money. Govind is thinking of 10 lakh rupees, or is there a better alternative? I know that people have spoken about the likes of Mahindra and Mahindra, people have spoken about the likes of even Tata Motors, because it's a contra bet at this point, considering that it's gone through a little bit of value degradation.
I would not like to recommend Tata Motors as you have said, it is a contrarian one. But in case of Force Motors, yes, there has been a tremendous improvement in the operational performance of the company and the profitability itself. I think that is the primary reason that the market is quite convinced that going forward, the profitability will be moving like this, the way the company has shown in the last quarter. And that is the reason the stock has got re-rated. My sense is if you want to be in the Force Motor, I think it is better to buy some, like maybe you can divide your investment into 4 or 5 parts and buy in a staggered manner. Maybe you can buy a part at this price, and after every 7-8% decline, maybe you can add more. And with respect to some other company in the automobile space, that yes, Mahindra looks good to me.
Yeah, because I want to establish this fact with you. I want to talk very briefly about the valuation metrics as they stand right now. As I see, the trailing 12 months price to earnings for Force Motors is at 35 times, whereas for Mahindra & Mahindra, it's at 30 times. So given the kind of relative growth that you would see, and assuming that the tractor segment grows better than it has in the past, if the monsoons are normal, then wouldn't this be a better pick, Saurabh, in your opinion?
I think Force Motors, the business is only in a segment like auto, trucks and auto and the tractors. And in this segment, there is a possibility of higher growth than Mahindra will see.
Okay, fair enough. All right, so Govind, that's the point. Don't deploy whole hog into Force Motors. Look at the price and look at declines to accumulate. And of course, M&M is also an opportunity for you to consider. Diversify your holdings. That's the best approach to have. We have to slip into a very quick break. We've got more on the other side, so do stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement.
Welcome back. You're watching Ask Profit, a show that gets all your stock related queries answered. For viewers who are just tuning in, you can either call us or WhatsApp us. I mean, you've been doing that already, but that's just a reminder. All right, with that, let's move on with the next query. The next query is from Raja, who is writing in from Hyderabad. He's bought RVNL shares, 5,000 shares in fact, at 50 rupees a piece in November 2022, and wants to know if he can buy more, hold or sell, or even book profits. His time horizon is 4 to 5 years. I'll take this up with you, Saurabh. I mean, he's bought it at very attractive levels. The stock is currently trading at 390 rupees. What would you suggest? Can he continue to hold this for the next 4 to 5 odd years?
See, while he has bought in a very good price, I feel that booking profit will be a wise decision, because after the correction also the stock seems to be highly valued. It is trading at 9 times to book value. And in fact, if you look at the operational performance, the company is not keeping up the growth pace that it should have, considering the valuation it is trading at. So my sense is better to take some money off the table.
Money off the table. Let me very quickly go to Nilesh. Nilesh, on RVNL specifically on the charts, what's the best level to take money off the table?
See, ideally, one should wait for a pullback. Pullback towards 410, 420 could be a good, could give a good opportunity to exit, because 200-day moving average is placed somewhere around 420. So the chances are very high we may see a pullback, but better use this pullback to exit from this particular counter from a short-term perspective.
All right, Advait from Kerala has got the next question. Shalby Limited is the name of the counter. 198 is the buy price. Given the current market conditions and the company's recent performance, should I consider averaging down, holding my position, or exiting the stock is a question. Do you have enough data on this one to give a view, Nilesh, on the charts?
Yes, I do have the enough data to comment on this particular counter. This stock is in a downtrend. First of all, it is trading well below all long-term and short-term moving averages. We have constantly witnessed a formation of a lower term and lower term formation as well. So, looking at the overall texture of this particular stock, looks like it is moving towards 170 to 160 levels on the lower side going forward. So better to exit from this particular stock on pullback. If you see any pullback towards 185 to 190, that can be used as an exit opportunity, because we are not witnessing any sort of a reversal candle as of now. So structure wise looks slightly on a weaker side. Better shift to better options available. This stock looks weak from a short to medium term perspective.
What would those better options be, Nilesh?
See, better option could be, first of all, Bharat Electrical Limited. That's one particular counter we are tracking, and this particular stock has been in an uptrend, and we are expecting further up move to continue towards 440, 450 levels on the upside. So from a short to medium term perspective, can be bought keeping a stop loss below 395. Apart from that, another stock, that is Trend. So Trend is also looking positive. From the lower levels, we have witnessed a good rebound in this particular counter, and we are expecting this further momentum to continue this particular stock towards 6,200 to 6,500. So yes, this can be bought with a stop loss below 5,750, and buy and decline should be the strategy here.
Okay, if you could only see Nilesh, if you could only see Mahima's eyes sparkling when you were speaking about Trent, because obviously it's a stock that she tracks very closely, and so therefore the potential upside from here that you were talking about caught her attention. All right, but on that note, thank you so much for joining us this morning, Nilesh. Always a pleasure having you on the program.
Thank you, Alex.
Okay, we will soon be joined by Ajit Mishra of Religare Broking. Ajit, very good morning to you, and thanks so much for joining us this morning. Okay, so this one's an interesting question, and I think it's a good opportunity for me to come to you on this, and I'm going to read it as is, because ultimately these are the questions that our viewers have, and the regular investor would have similar thoughts. And I'm congratulating Rajesh for putting this down, because I think it's important to address. He says it's a generic query. Why is the Nifty overreacting for every news, even though India does not have much impact? The Nifty fell almost 1% today, whereas Israel's stock market is at the year high, or at an all-time high. The petroleum minister has clearly said that we have diversified our crude imports and we have stocked up for several weeks. I don't understand. Now, this is a fair question to ask, but I do want to point out to you, Rajesh, that a move of about 0.8% on the downside for the Nifty 50 is really not too much to write home about. If anything, it's a very measured response to the global uncertainty that we're seeing. So let me go across to you, Ajit, on the charts. What can you tell us about the move today? Of course, to a certain extent, one would argue that the drop that we're seeing is on account of IT, which is underperforming today, and it's moving for completely different reasons.
Yeah, good morning, Alex. So that's true, because if you see, Alex, the top underperformer in today's session, largely they are IT majors and some of the profit taking in the heavyweights, which were under limelight in the last trading session. But Alex, one important thing that I would like to highlight is that this is something not new, what we are observing from last 5 weeks. Means every week, especially in the last 3 weeks, we are seeing Friday being a decisive directional move that we see in the index, and in the next following week we said see that move fizzle out, be it on the positive side or negative side, and this is what we are observing consistently. So at the same time, what you have rightly mentioned is that yes, today is largely due to IT, and we are still holding up the short-term average. So broadly, if you see, the texture has not changed even after this decline, and the closing is going to be important. So let's say if we manage to close around 25,000 mark, I would rather see this as a very positive close for the market, and probably this week we can see a breakout also about 25,200, which could help the index to inch toward further highs. So texture looks positive. One should not get carried away with the what we are seeing, a global noise and everything. 24,700 when it comes to the Nifty should be your key support.
Of course, keeping in mind the expiries as well. All right, then our next caller, Rahul, is calling in from Jaipur. Rahul, a very good morning to you. How can we help you today? Hi Rahul, can you hear me? Okay, I think we seem to have lost him, but we do have his question. He's holding 1900 odd shares of Kirloskar Oil, bought at 847 a piece. And I believe I'll take this up with you, Saurabh. What's the view like? We did talk about Castrol India, but I think in the similar fashion, if even Kirloskar Oil might get impacted if crude spikes, what's the outlook like?
In my opinion, I think the company is into the industrial equipment making, and it is a very old company. So the stock has seen a stupendous rise last year, and the valuations have got corrected now. On the operational front, the company is growing at a double digit. In my opinion, I think for the long term, it is a hold.
Okay, it's a hold. All right, we've got a next question on IRFC, and this is from Vijay. I'm not sure where he's tuning in from, but he's bought at levels of 182, and he's got significant quantity, 2,000 shares that he's bought. The stock is currently trading below his buy price at 135, and he's losing about a lakh of rupees. And so he's wondering what to do on the charts. He's got a near-term view. Ajit, on the charts, what's the view on IRFC?
So Alex, he bought at very high levels, maybe close to around August last year. Is something that he made those purchases. And though we were seeing some bit of a buying interest emerging in the railway counters, the lower level last couple of weeks, IRFC is not participating in similar quantum. So it's going to be a very gradual journey for IRFC. And the first hurdle exist around 150-55 marks. So in case if his view is very short term, I would recommend him to maintain a strict stop at 125, because below that again the bias would turn from recovery to negative, and upside around 155-160 he should review his position.
Okay, all right, so that's the view on IRFC. Unfortunately, buying at high levels, you'll have to widen your time horizon or book losses. Those are the two options that you have available for you. We've got our next caller. Venkat is calling us from Bengaluru. Very good morning, Venkat. How can we help you today?
Good morning, sir, and thank you all who are in the panel for your clarifications. So I have a question on Idea Forge.
Okay.
I'm holding 91 shares at 479.
All right.
Looking at the recent move upwards, so I just want to add some more quantities. And looking at the revenues, I see at the moment for the defense, it is around 5 to 6% only it is contributing. All of a sudden, it came to the picture and it rallied. So now I want to add it some more shares as it is fallen from around 1,200 to 1,300 rupees. So do we still have the margin of upwards? Can we average it here, or it is okay to hold at the moment whatever I have?
Okay. I just want one clarification, Venkat. How long do you intend to hold this for?
I bought it around 6 months before.
Okay.
So I'm thinking one more 6 months. So for the short term, 1 year I have taken it actually.
Understood. Okay. So Ajit, I'll come back to you on the charts. This is a stock, as he pointed out, that has gained quite considerably. In fact, in trade today as well, it is up 10%. And so therefore the question is, and I think other panelists, other experts have pointed out that it's better to average on the upside as opposed to on the downside. I don't know what your opinion on this is. Is this that moment for him to deploy?
So Alex, it's always recommended that you average your profits, or means you rather build on your existing profitable position instead of loss making. So that's always a good strategy, especially if it's a trading position. But since his view is 1 year, 6 months, he bought it at very decent levels. Now the stock have moved up very sharply. We are very close to the resistance. So I would not recommend him to add at current levels. So because 690, 700, means 10% is the upside. Downside, again, we have the risk that in case if market corrects and the stock also witnesses some profit taking, because the move was almost vertical from 350 to 630, in last 5-6 weeks. So probably in case if he gets any dip around 600, 550 zone again, that's a good buy, or a breakout above 700. In that case, we can see next leg of the momentum, which could help the stock to inch toward 900 plus level.
Okay, so that's a comprehensive view on Idea Forge. The stock is buzzing, as is the rest of the defense pack. By the way, it's the one sector or index that is doing particularly well in trade today. and it's up. Zentech is up 5%. The index as a whole up about 1.5%. But I do want to tell you about the next show, guys, because this is Know Your Company. I'm sure that a lot of you have already seen it, and I want to tell you what's up next. By the way, in case you haven't seen the show dives very deep into the fundamentals of one company every day, and these are stocks that you potentially hold in your portfolio, so it would bode well for you if you listen in to these conversations. Mahima is going to be on this show today. It's on V2 Retail, and this is a popular stock. A lot of you have either looked at it or invest in it. Why are they talking about it? The questions that they're asking is the growth that the company is seeing sustainable? Is the pricing that they have sustainable? How quickly can the inventory days come down? Working capital days and cash flow, can they sustain at this point? And the margin outlook as well as the return on equity sustainability. Of course, Mahima is going to talk about all of those aspects. She tracks the company very closely, but they're also going to be talking to Akash Agarwal, who is a whole-time director of V2 Retail. I'd encourage you to take a look at that entire conversation. It starts at 11:30. All right, the next question that we're taking is on Orient Green, and this is now Shoni Lal, who's writing in from Kerala. He's bought a very significant quantity at a price of 20 rupees per share, and this is why you need to be very wary of the stocks that you invest in. Right now he's holding 5,000 shares at a price of 13.29. So the question is for you, Ajit. I'm not sure if there is a fundamental view on this. Saurabh, I'm just checking with you. Do you have a fundamental view, Orient Green?
No.
Okay, so I guessed as much, which is why, Ajit, what is the strategy now? Should he book losses?
So Alex is a very volatile stock. Since listing, I've been seeing the stock, oscillating sharply, in a very volatile range. And currently, also after the failed attempt of securing its long-term averages, the stock is drifting lower with hardly any volume. So that clearly shows an underperformance. So it's a good idea. Definitely, you should book losses and avoid such stocks in future.
All right, avoid such stocks in future is the view coming in on Orient Green from Ajit Mishra. All right, our next caller, Shankar, is calling in from Kolkata. Shankar, a very good morning to you. How can we help you today?
Very good morning, ma'am. See, I'm having 50 shares of EID Parry.
Okay.
But still at 87 rupees.
Okay.
Now, the stock has appreciated a lot.
Right.
I would just like to know whether at this point I should hold on to it or whether I should book profit.
Okay, got your question, Shankar. I'll take this up with Saurabh. Saurabh, he bought at attractive levels, and plus the entire theme of ethanol going around, government raising its targets as well. Do you think he should continue to hold EID Parry or sell and book profits? He's sitting on profits of around 24,000 odd rupees.
I think a lot of cyclicality is there in the business with respect to the sugar price and the ethanol pricing. My sense is because of this huge volatility, I would recommend to book partial profits and hold the remaining.
Book partial profits is the view on EID Parry. Okay, where would you deploy the partial profits though at this point, Saurabh?
I think it is better to park money in the maybe utilities or banking.
Okay.
In the utility space, we like NTPC, and in the banking space, I would stick with the larger ones like ICICI or Axis.
Got it. Okay. So this is actually a follow-up. Vijay is writing in from the United Kingdom, and he's woken up bright and early to tune into this show. He has bought based on another panelist's recommendation, KFin Tech. Or rather, he sold KFin Tech 50 shares, and he's holding 50 more. He's asking whether it has reached its short-term potential and should he sell, or is there more upside available in the short term? The stock is up 4% or thereabouts in trade today as well. So Ajit, the question is for you on the charts, should he book out right now?
So Alex, in my opinion, he should definitely hold because the texture looks positive. Means after this sharp decline from 1600 to 700, in the last 4-5 months, the stock has formed a strong base while holding above its major averages. And off late, in fact, it has completed a fresh buying pivot. In fact, he can add more if he's planning to hold this stock at least for a month or two, with the stop loss at 1200 and potential target of 1550, 1600.
To hold or even add more at the levels that Ajit mentioned. All right. Now, next caller, Murli is calling in from Bengaluru. Murli, a very good morning to you. How can we help you today?
Good morning to you and all the panelists and anchors, co-anchors. I bought Atul Limited,
Okay.
100 shares at 6,884.
Okay.
And I had a long-term view, and the company has completed its capex of 2,000 crores recently.
Right.
And the chemical industry, probably after 2-3 years of languishing, is on the green shoots are being seen, I'm told.
Right.
So it is yet to reach its best performance of 2022 or 21 financial year, probably in the next 2 years.
Right.
What is your view from long-term point of view? Can I add more?
Okay, Murli, got your question, and as always, you've done your research very well. I take this up with Saurabh. Saurabh, Atul Limited, what's the outlook like? Can he add more? He's already holding 100 odd shares at 6,884 a piece.
See, the tough period for the company seems to be over. If you look at the operational numbers on the March quarter number, there was an improvement on both on sequential and year-on-year basis. If you look at the valuations, it is trading at the lower end of the of its trading band. If you see the long-term period, it is trading around 3 times to book value. I find merit in holding the company, holding the stock, and I would suggest to add more.
Suggest to add more. Atul Limited. And by the way, Murli, kudos to you for the kind of research that you put into each stock that you're holding. And I've noticed that you invariably have gains in the stocks that you ask us about. All right. So let's move to the next one. We've got Shashikant, who's writing in from Pune. And he's looking for a short-term trade. He's got Yes Bank, 4,000 shares that he's bought at levels of 21 rupees per share. He's incurring a small loss, but he's not too far away from the current market price, which is 19.8 or close to 20 rupees per share. On the charts, let me go to you on this one, Ajit. What is the potential upside here?
So Alex, in my opinion, though we may see some rebound due to the oversold position in Yes Bank, maybe close to around 20.50. But instead of waiting for this rebound, the ideal approach is to shift to the counters which are outperforming within the sector. So Kotak and Axis is something that if the view is short term, we can definitely switch even at current levels. And in case if you wish to continue with Yes Bank, then 19 should be his strict stop loss.
Which is not too far away. All right, so point well made. And I think this is a consensus view, both on the technicals as well as on the fundamentals. Opt for the slightly larger, more established players in the banking and financial space. We've got a next caller, Arvind from Chennai. Arvind, very good morning to you. How can we help you today?
Hi, good morning to you all. I am looking to invest about 1,000 shares in either Vedant Fashions or on Root Mobile.
Okay.
And I'm looking for a time period of around 6 months to a year.
Okay.
Would like to know which one would be a better bet.
Got it. All right, since you've established, is there any rationale that you have for selecting these two companies?
I've seen both these stocks correcting without any major negative reviews in terms of their overall financials or fundamentals, etc.
Right. Got it. I got your question. So Ajit, let me come back to you on the charts. Vedant Fashion and Root Mobile are the two counters that he's identified. 1,000 shares of either. Which would be the better bet?
So ironically, Alex, both stocks are looking almost identical on charts, means a very sharp decline followed by a very tight range of consolidation. Both stocks are witnessing. And Manyavar, which is Vedant Fashion, is seeing bit of a traction of late with noticeable surge in the volume. So that indicates a possibility of consolidation or maybe the accumulation at the lower end. So among these two, Vedant Fashion means Manyavar can be considered. And since his view is 6 months, I would recommend him to maintain a stop also, considering that the overall trend is still negative. It's just that we are buying for a recovery. So 710 should be his closing stop loss, and upside around 1,000, 1,050 something that he can maintain as a target area.
Okay, our next question then is from Shweta Kohli, who is writing in from Gurugram. Her query is regarding GPT Healthcare. She got 2 lots in the IPO last year at 172 and added a few averaging out, but the share is not going anywhere is her problem. And she's saying that should she continue holding the shares that she's already holding, or should she sell at the moment and book losses? Saurabh, I'll come to you on this one. What's the view like?
Won't be able to give you this.
All right. Then, any view on the entire healthcare space as a whole, and which pockets do you like in that in the entire space?
I think in the hospital space, we like Narayana Rudale and maybe Rainbow Child Care.
Any view, Ajit? I know that it's a relatively new listing on GPT. What would you do with it if you got allotment in the IPO? Would you exit at this point?
Yeah, certainly I would, Alex, because if you see that it's been a very volatile trend, since listing, and though we are very close to the lower band of this prevailing consolidation range, but at the same time, the stock has been maintaining lower highs during this consolidation phase. So I would rather suggest not to stick with a stock where I have opportunity loss also, and the volume is also negligible. And in case if it witnesses any bounce also, we have multiple resistance to cross. So it's prudent that she should exit her position and switch to some counters which are trading in sync with the market trend.
All right. It is time now, gentlemen, to hit the rapid fire round, and you both know what this means. We'll throw as many questions at you over the course of the next 2 minutes. Do keep your answers as concise as possible. Raghunathan has got the first question. Jyoti Labs is the name of the counter, and he's looking for an entry point for the long term. Ajit, on the charts, is this a good time?
Yeah, buy with 275 as a stop loss.
Okay, Power Grid is the next counter. Ramesh Kumar from Coimbatore has 700 odd shares at 189 apiece. Wants a view. Saurabh, your view?
Switch to NTPC book profit.
Okay, PG Electroplast for a view of more than 1 year. Can it be bought at the current market price? Of course, he wants to consider either this or Varun Beverages. Saurabh, what's the view?
Varun Beverages.
All right. IDFC First Bank is the next counter. Sanjay is holding 300 odd shares at 76 a piece and wants to know if it can continue for the next 2 odd months or not. Ajit, your view?
Hold 67 stop loss, 76 first target.
Okay, Paridhi Taneja wants to know about which stock in the energy sector should be invested in at this point. Saurabh, what's the pick?
NTPC.
Okay. Canara Bank is the next counter. Karthik from Visakhapatnam is holding 5,200 odd shares and wants to continue to hold this for the next 2 odd years. Saurabh, your view?
Hold.
Saurabh, Aegis Vopak, do you have a view?
No.
Okay. CG Power, and this is a price, okay, I'm not sure if, can we pull that up? Okay. Yeah, he's bought at levels of 8 rupees. Should he book profit? My goodness. Ajit, what's the view?
Certainly, he should book profits. It's been like almost a vertical move, so definitely he should book profits.
All right. ITC is the next counter. Raju Mazumdar is holding 42 odd shares and wants to know if he can continue to hold. Saurabh, your view?
Keep on holding.
Okay, BHEL, a long-term view is being sought by Jaya, who's writing in from Bengaluru. Could you enter the price at enter this price? Saurabh, what's the view?
Better to enter L&T.
Okay, the next question is on KPIT. The person is holding 150 odd shares at 1426 a piece. Can he continue to hold? Ajit, on the charts?
Hold 1300 stop loss.
Okay, we're out of time on the rapid fire round, and in fact, it's the end of the program as well. Ajit as well as Saurabh, thanks so much for joining us this morning. Pleasure having you on the show as always.
Thank you.
All right, and like I said, that brings us to the end of this edition of Ask Profit. We leave you searching for the dip. Thanks so much for tuning in. This is NDTV Profit.
That's huge. That is a biggie. It's on.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Imports become the exception rather than.
Hello and welcome. You're tuned in to KYC. I'm Harsh Saita. With me is Mahima Vachajani, and what we're going to do today is we're going to speak about V2 Retail. It's a value retailer and it's in focus because of the kind of stock price action that it's seen over the last year or so. The stock has more than doubled, 2.5 bagger over the last year. But look at the last 5 years. In fact, from June of 2020, and maybe that's a low base, the stock has been on an incredible run. It's up maybe nearly 40x, but to be absolutely precise, 34x since that point. So it's been a phenomenal story that's playing out in front of us, Mahima. And it's important to understand at this point, because FY26 could well be that year where rural starts to participate. We've seen rural under a bit of pressure last couple of years. Can rural start to actually participate this year, given the way monsoon is playing out? But the kind of growth base that the company has built for itself over the last couple of years is extremely high. So my first question, therefore, is can growth sustain on this kind of base? Store levels need to go up for that. Same store sales growth needs to sustain with store levels going up. And you have average selling price, which also has crept up, and that also, can it sustain above that 300 mark, will be the question. Because for full year FY25, it's a shade below 300, but Q4 was above 300. So is that the new normal? Is that the new base
The second part of this is, can growth sustain without discounts? Now, discounts have come down marginally in FY25 on a very, very low base. So that's a positive. But can that sustain? Rural pickup in FY26. If that were to happen, states of UP, Bihar will well benefit from that tailwind. Even a Jharkhand, even an Odisha, where V2 retail has a significant geographic footprint. And that will obviously further aid the numbers for it. Factors to consider, especially when it comes to store shutdowns, and they do this, very minor tweaks in terms of store shutdowns, but that could well be one of the drags, and you'll want to understand whether that is consistent year after year. I would want to quiz them this year and then thereafter next year as well, to try and understand whether those factors are changing with regard to store competition. Challenges, store shutdowns. Challenges with regard to competition and possibly leading to poor execution. That could well be a risk for this one, because we've seen very sharp growth. They are very steady in their commentary, but any slip up with regard to execution could well hurt the stock price as well as the performance, because it's certainly not trading at cheap valuations on a trailing 12-month basis. The average selling price, the trajectory is what I would want to understand. Margin risks, both on gross as well as on the pricing front. What is the calibration that is possible, and that interplay along with competition. And last off, with regard to cash flow, can that cash flow really sustain? Because in FY25, we've seen two positive things happen. One is your inventory has come down, even though your inventory days have come down, even though your inventory in absolute terms has gone up. And second is your payables have really ballooned, and that has helped working capital days to come down, and that has aided the cash flow from operations. Can that change and reverse? Is there a risk of that, is what I would want to understand. So all of that. But first off, about V2 retail, let's take you through the journey. It's been a large turnaround of sorts, Mahima.
Absolutely. It was incorporated in 2001 and it got listed on the bourses in 2007. It was renamed as Vishal Retail in 2011 after selling the entire Vishal brand, which was loss-making, and that was one of the reasons as to why it was sold. And V2 Retail stands for value as well as variety. In terms of the company, it primarily operates in Tier 2 and Tier 3 cities. So what you were talking about, because the past few quarters have been good in terms of rural spending, because rural has gone up as compared to something like an urban. And that is something that has augured growth for the company in FY25 as well. It caters to the neo-middle class and middle class demographics. So that's their overall audience. Like Harsh mentioned, their average selling price is anywhere between that 300 to 350 odd mark. In terms of their focus area, lowest price given at quality, and of course with wide assortments. In terms of the retail presence, they are present in around 189 stores in more than 150 odd cities and in 20 odd states, and retail area as of March ending stood around 20.27 lakh square feet. In terms of their product design, there is in-house product development with a team of 25 odd designers right now. In terms of how their business is divided, where it's divided in menswear, which is roughly 40%, ladies wear is 27%, kids wear is 25%, and lifestyle is roughly 8% of the overall counter.
I'm just going to chip in here. Yeah. See, this mix, when I was looking at it over the last 4 to 5 years, hasn't changed significantly. Correct. So we've seen this mix remain as is. And therefore, that's just something I want to call out, that this might not change as well into the future, because if it's not changed over the last 4 years, when the company has undergone tremendous transformation, this may well be the mix that we can continue to expect as well into the future.
And I think that also means that the company is able to understand as to what the consumer preference is, and their mix is therefore not changing. In terms of geography as well, there are expanding into strong cluster, of course populous clusters like UP as well as Bihar. They're entering into new states like Punjab, Bengal as well as Maharashtra. In terms of their overall footprint, Bihar has around 38 odd stores, Uttar Pradesh 35 odd stores, Odisha 26, Jharkhand 16, and MP and Assam has roughly 13 odd stores.
I again want to chip in here for a bit. So this basically Bihar contributes nearly 20%
Exactly.
of the store count. So does Uttar Pradesh. So these two combined
40%.
would be nearly 40% of the store count. Just for perspective, they have 190 stores. So it's very important to understand this. The other piece is Odisha also contributes roughly 15%. So if I look at the top three itself, that's above 60% in terms of store concentration. And then if I add this 16 here of Jharkhand, that takes it to nearly
70 to 75
70 odd percent, right? So that kind of really adds up when you're looking at just the top 4 states contributing to 70%.
Correct. And these are the most populous states, right?
Absolutely.
With high rural penetration as well. So I
Yes.
think that is something that is working out well for the company.
Yeah, and then they're saying that 60 to 70% of new stores are also in existing clusters. They will focus in on the existing clusters and they will not go into new geographies. And even if they do, they'll be very cautious about it. So that kind of strategy, they're just focusing on what is working.
Correct.
The question after a point will be, is growth capped beyond a point if it's in the same geography? And if they don't find new geographies, but that's just maybe one of the risks. But anyway,
and that could probably keep their overall sales per square
Yes.
feet metric as well,
Yes.
because that is one of the key metrics to watch out for when we study a retailer.
Yes.
So,
the other thing, sorry, while we're talking geography, that really stood out when I was reading up on the company was the fact that their rentals have actually come down in the last 2 years. From 56 rupees per square feet, it's come down to 52 rupees per square feet. That kind of again stood out for me, because what they are saying is we'll focus not on even within the core geography, they will not focus on the most populous part of the geography. They will go slightly outside where rentals are slightly lower. And cater to the value market.
Correct.
That's the other thing that really stands out. Where have you seen rentals really come off?
Correct.
I mean, commercial, we've seen rentals go up while they are seeing a very different trend, and that's kind of aiding their cost structure as well.
Absolutely.
But sorry, please go
and
ahead.
aiding their margins as well. I mean,
Yes.
we see that
Yes.
later as well.
Yes.
In terms of their store strategy, like he rightly mentioned, 60 to 70% of new stores are from existing cluster. Plus, I think one thing that's standing out again here is the kind of focus on their private labels. Not every company is able to scale that up. Focusing, even Trent has tried to focus on their private labels, and that's something that is working for Trent as a big retailer. Whereas your Vedant Fashions, your ABFRL has not been able to do that, but V2 Retail has been able to do that and has been able to scale that as well. In terms of manufacturing, they own a state-of-art manufacturing facility in Noida as well as Bihar. In terms of warehousing also, they're set to add a new 20 crore facility in Kolkata, and they also have an existing Gurgaon hub, which will support their overall future growth. Plus, interesting one here is that they use their own fleet to carry their overall inventory, and it's done. It's like a weekly process that they do. So that is also interesting. I think using that this metric as well, they're trying to have their control over how the company is working out their costs around, and that's how I think they're able to give the kind of guidance that they're giving in terms of margin as well as growth.
Correct. Design, manufacturing and retail, they do all three across the value chain, and that kind of aids the numbers. But let's quickly look at the metrics that we look for with regard to a V2 Retail. We start off with the income statement. We look at the balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, as well as valuations. We'll look at all of those and we'll try and give you a view with regard to each of those parameters. You want to start off income statement, Mahima?
Right, so I'll start off with the income statement. Of course, thumbs up here most certainly, because revenue 3-year CAGR has been an impressive 44%. EBITDA 3-year CAGR has been 61%, and margins also have been on a very good increasing trend. I mean, FY24 they stood at around 12%, 12.2%, which they've scaled to around 13.4% in FY25. Net profit has also grown threefold as compared to where it stood in FY24, and company became profitable, I believe, in FY23. So they've been not just able to maintain the profitability, but also scale in terms of their overall profitability, and that's why overall thumbs up when it comes to income statement. Even in terms of their operational metrics, it's important to point that out here. Since Harsh was also mentioning whether they'll be sustainable or not is one question, but FY25 same-store sales growth at 43%. I mean, no other retailer has seen this kind of same-store sales growth. Volume growth as well at 43%. Full sales price improved to 89%. Old inventory also reduced from 18% to 5%. Store economics, they added around 74 stores this year, and they plan to add 100 stores every year as per their guidance as well. And the last thing that stood out really well for me was that all of these stores become profitable from the first year itself, and they've said that the break even is at 500 per square feet sale. So that is also a very important thing and very interesting thing that came out of while reading the investor presentation.
500 per square foot, they do 750 to 800 in year one itself.
Yeah.
Thereafter, they scale up to 1000 to 1100 in 2 to 3 years. This is just for viewer perspective so that you have the complete picture on how it goes about. The break even is, of course, 500 rupees per square foot per month. But let's look at the balance sheet now. In terms of equity, it's healthy in terms of the overall equity, the number on your screen. Look at also the borrowing number. Now, mind you, the borrowing number excludes lease liabilities. Lease liabilities typically should be excluded from a rental perspective for a model that V2 Retail typically follows. Cash and bank balance around 9 to 10 odd crores. So a thumbs up with regard to where the balance sheet is concerned. You want to talk about cash flow, Mahima? Right.
So healthy set of cash flow numbers as well. Cash flow from operations has nearly grown threefold from 93 odd crores to 223 crores in FY25. Plus the cash flow from operation to EBITDA ratio is also quite healthy at 89 odd %. Net cash flow has slightly decreased, but that is because of what you were mentioning earlier as well, because of trade payables going up. That could be one of the reasons as to why the net cash flow has been impacted, but overall a good set of numbers here as well.
Yeah, and so the other piece with regard to cash flow is that two things have happened. One is your working capital days have come down, and that's largely because your payables have gone up. Want to understand how sustainable that number is? There are reasons why that has happened. Won't delve into that in too much detail, but that's something you want to watch out for because that will impact cash flows going forward. Second, 220 crore odd of capex that is in the pipeline every year, of which 110 crore will be to inventory and another 110 crore in fresh capex for new store expansion. Stores typically take a crore or so in terms of capex per store. So 100 stores will likely mean 100 crore. Just kind of putting it out there. I fully aware that there's a lot of data out there, but let's talk about return ratios very, very quickly. Return ratios on an improving trajectory. Can they sustain will be the question. That's the ROCE number, but look at the ROE. It's gone up to 23% this time around. Can that really sustain is the question. At least the number seems to suggest that it will sustain, but I'm giving this a cautious tone and therefore a neutral shareholding.
Right. So shareholding, interestingly here, this is one company where, at least that I have come across where promoters have increased their shareholding over a period of time, which was at 53.6% to now 54.24%. So that shows that promoters believe in the company and are ready to invest in the company. FI holding has, however, come down from 6% to 1.3%. DI holding has gone up in the counter from 0.4 to around 6.7%. And overall public shareholding has slightly come down from the 38.8% mark to 37.7% mark. So I think overall a thumbs up, well held company.
Okay, street cred. Let's look at the last year or so. It's done 154% in terms of returns. So it's been a 2.5 bagger over the last year or so. Year to date up 10%, not a bad return either. And you're looking at 5-year returns of 34x. And therefore we've given this a thumbs up, the street cred. Valuations, Mahima.
Right. So valuations, we've given a neutral rating here, and this is solely because it's both ways. The company is slightly cheaper than its peers, but at the same time at 26 times trailing 12 months, it's not cheap in terms of how valuations are seen. So that's the only reason why we've taken a neutral approach here in terms of how it trades and this is EV to EBITDA because a lot of other companies like Vedant Fashion or Arvind Fashions are still in losses, and that's why we've taken EV to EBITDA as metrics. But yeah, as compared to something like a Bazaar Style or something like a Vedant Fashion or FRL, it turns out to be cheaper, and interestingly, the FY27 estimated valuations go to around 11.5 times, which is quite a significant and quite an attractive valuations for an investor to look at.
Okay, now let's look at how your street coverage stacks up. Now there's just two analysts covering this one. 55% upside. Just given the limited coverage, we've been cautious. We've given this a neutral. Also, you want to quickly look at what the guidance is, and we've spoken quite a bit about some of these. 100 stores in FY26 over the next 4 to 5 years. They're expected to increase store count by 600 to 700. They're looking at a revenue growth of 45 to 50%. Same store sales growth of around 10%, EBITDA margin of around 8 to 9%. In fact, 2 years from now, the pre-Ind AS EBITDA margin, which is currently at 8%, is expected to go up to 10%. They're expecting ROEs to sustain. They're exploring franchisee model as well, but not under current consideration, but they're exploring it. No plans to enter premium. So all of that, we've given that a neutral. Plenty happening on this front. You want to watch out for all of those factors. Quickly on to how we rate this company. Finally, let's pull out all of the ratings. Let's stack them up and let's see how it adds up. There you go. Those are the 4 parameters. Let's look at the other 4. Let's give it the final rating, which is 6 out of 8. Not bad at all. No thumbs down either. So all positive. Or neutral. So that's the other big positive. But let's go across. We have Akash Agarwal, whole-time director, V2 Retail, joining us. Akash, good having you here. I want to start off with understanding whether this kind of revenue growth clip of 45 to 50% is really sustainable. You're at 189 stores right now. You're on an aggressive expansion spree. 100 stores last year was expected. You did 75. This year also 100. How deep is the market, Akash?
Yeah, hi. Thanks for having me. So to answer your first question, the actual target initially for last year was around 50 new stores.
Okay.
But since we were getting such good response in all the new locations that we were expanding to, and the SSSGs were much better than what we had actually predicted or estimated. So that's why we increased the store opening guidance, and we opened 74 stores. And that is why, in fact, we have increased the guidance for the next few years also. And we are well on track to open 100 stores this year and for the next 3-4 years.
Right. Akash, hi. Mahima also joining in. Just want to get your sense on margins. You did almost 13% ending FY25. How sustainable is that range, and what will be the levers of growth from there on?
So we always try to talk about pre-Ind AS margin. So pre-Ind AS EBITDA was 8% for us last year. And the scope, the levers that we have to increase that and move towards 10% in the next 2 to 3 years. So one would be, leveraging additional stores by using the same head office cost and warehousing cost. So your costs per square feet come down. The second lever is selling more at full price, so having a positive impact on the gross margins. And the third lever is the way we move from 650 rupees to 1,000 rupees. So next target is to move up to 1,200 rupees per square feet per month. So these 3 things, levers, would actually help us move from a pre-Ind AS EBITDA of 8% to 10% in the next 2 to 3 years.
Akash, I want to understand how relevant is rural pickup in everything that you're doing, because rural is expected to pick up in FY26. One, are you seeing signs of that? Are you expecting that to happen? And how relevant is rural and rural growth from everything that you're anticipating in terms of pickup on the per square foot sale that you're penciling in?
So yes, rural is a big market to the customers that we actually cater to. And the good thing is the last 2 years there has been a rural demand pressure, and we've been able to show the kind of growth that we've been showing, more than 30% SSSG for 2 years running. So I think when the macroeconomic picture is better, when the rural demand comes back, then it should obviously positively impact us, and we are waiting for that to happen. But it's not an excuse. Even if that doesn't work, we're still working hard on all the strengths that we have shown in the last few years, and hopefully the momentum can continue.
Akash, just want to get your sense. Last when I was reading your con call, you did mention that the e-commerce execution was delayed because of some technical difficulties, but you are planning on getting into the e-commerce space via your own website. Just want to get an update there as to how the development has taken place, and where do you expect your overall online sales to go as a percentage of your total revenue, let's say 3 years down the line?
So we are making e-commerce just an additional channel for our existing customers. We do not want to burn money in acquiring new customers. And we do not want to do a centralized logistics system. So what we are planning is an omni-channel system where all the inventory at the stores can be leveraged and delivered to the customers in the same city. So hence it reduces a lot of costs and we save on a lot of return costs also. But even at a mature stage, I would say it wouldn't be a very significant number. The e-commerce would constitute about 5 to 10% of the business after it matures. But like I mentioned earlier during the con call, that we don't want to start it with having doubts over the technology partner or the technology behind it. So we want it to be 100% robust and automated. And that is why the delays are happening, because we're still trying to figure out who will be the best technology partner to take us forward in our omni-channel hopes.
Akash, you're profitable, you're focused on profitability, you're focused on cash flow. Your cash flow has seen a bit of a turnaround in FY25. For viewer perspective, give us that perspective as to what has changed in FY25 versus earlier on the payables front especially, and can that sustain?
So there's a uptick in payables because earlier, so we have a subsidiary which has our manufacturing units. So about 20% of our sales used to be manufactured in-house, and the credit term for our subsidiary was 0 days. But that percentage has come down from 20% to less than 5% now. So that has positively impacted the working capital cycle, because the average credit that we get from vendors is 45 to 50 days. And that is why you're seeing a much better cash flow from the credit working capital cycle.
Sustain, Akash.
Yes, so we target an inventory days of about 90 to 100 days, and we've been able to actually reduce it by 10 days. And the plan in the next 18 to 24 months is to actually reduce it by a further 10 days. And if we are able to do that, and even if we maintain the average credit days that we are maintaining now, we would be able to reduce our working capital cycle by another 10 days.
So your cash flow to EBITDA, just trying to understand, would that be around the 80% number even then, or can you improve that further?
No, that should remain at around this number going forward.
Okay, understood. And what gives you the confidence, Akash, that the market is deep enough to do 600 to 700 stores over the next 5 years?
So there are retailers already with 1,000 stores. I think there are retailers with more than 1,600 stores of a particular brand. So that looking for new locations or new cities is not a problem yet. I think for that we need to reach the 2,000 or 3,000 store number. So till then, it's all about, we have more options that we want to open. So I think India, with the growth trajectory that it's on, and with the booming, middle class and more people crossing the per capita income threshold where, they have more disposable income. So I think it's all positive, and this number will keep on increasing.
Thank you so much, Akash, for coming in and speaking with us. Completely out of time on this one. Great chatting with you. Here is the rural play, viewers, which is really making the waves, both in terms of stock price returns as well as in terms of the way in which the numbers are shaping up. So you want to keep your eye out on this one. What you also want to do is keep the risks in mind, because stock price run-up has been significant. But completely out of time, folks, on this one. Thanks so much for joining us. That's all from both Mahima, myself, as well as everyone who puts the show together. Thanks so much for watching.
imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Markets recover from day's low, still trade in the red. Nifty Sensex show resilience despite Iran-Israel tensions escalating. Meanwhile, Auto wins power, HAL and Bharat Electronics. Zentech acquires 54.7% majority stake in Tisa Aerospace, stock up over 5% in trade. And it's IT that continues to be on the back foot. Infosys declines over 2%. HCL Tech falls 1.5% as well. Brokerages rule out worsening demand. Zee Entertainment plans to achieve break-even in Z5, stock up over 10%. Also proposes a preferential issue of fully convertible warrants worth 2,237 crores. And it's Tata Capital 17,200 crore IPO that got a SEBI nod. Company in fact filed for confidential DRHP and is expected to file updated DRHP publicly soon. Hi there, you're watching Markets at 12 with me, Shreyanshi Singh. Let's take a look at the sectors as well as the stocks that are buzzing away in trade. Before we take a look at the stocks though, let's take a look at what the market is up to. And when you take a look at the Nifty, it's hovering below that 25,000 levels. You've seen a little bit of weakness coming in, so tepid moves coming in as far as most of the sectors are concerned. When you take a look at the list of sectors, it's only media as well as defense and metal holding on to a tinge of green, and tinge of green I say because 0.4% uptick coming in. As far as metal is concerned, defense and media are the ones that are holding on solidly to that shade of green, and on the flip side you have IT as well as auto that are tanking away in trade. Bank as well, finance as well, similar picture coming in for all of those indices. Quickly, let's take a look at some of the counters that are reeling under pressure. So it's Infosys, HCL Tech, HUL, Shriram Finance, M&M, Hero MotoCorp that makes it to that list of losers from within the Nifty 50 pack. And on the flip side, you have a BEL, Trent, Adani Enterprises, Hindalco as well as Bajaj Finance holding on to a shade of green at this point in time. But tell you what, let's get you some more news and updates. And as the tensions in West Asia increase, oil prices in fact have been in focus, seen a spike. Will this hike then be making daily life costlier? What should you be making of it? Sessa is standing by with that answer.
Rising tensions in West Asia have left crude oil prices primed for a surge, and since crude oil is a key input for FMCG companies, consumers can expect an increase in their monthly grocery bills and household expenses in the coming weeks. Now, companies have warned that rising oil prices will drive up their packaging and freight cost, putting pressure on profit margins. To offset these impacts, they are likely to pass the additional costs to consumers, which in turn would lead to higher prices across a wide range of items, including packaged food, beverages, soaps, detergents, and even paints. But to what extent? Well, that remains uncertain as of now. The actual impact will depend on how much oil prices increase over the next 10 to 15 days. Now, this fresh uncertainty comes at a time, as FMCG companies had just begun to see signs of demand revival after 5 consecutive quarters of sluggish sales, particularly in urban markets. Analysts suggest that rising crude prices could derail the margin relief that these companies were expecting from the second half of this financial year, aided by fiscal stimulus announced in the recent budget. The market remains alert as geopolitical developments unfold, with many wondering how long this volatility will continue and what it means for both consumers and companies. We will continue to monitor the situation, so stay with us for the latest updates on this developing story.
Well, absolutely, Sasa. We'll continue to monitor the latest updates that come out. In fact, you do have an Iranian military central command spokesperson who's gone ahead and called US President Donald Trump a gambler. You have new updates, new headlines that we've got to look at when it comes to this particular issue every hour at this point. But tell you what, let's move on. Let's focus in on IT as well, because some of those IT counters are tanking away in trade. A series of top brokerages, in fact, including Morgan Stanley, Goldman Sachs, Nomura, have released their views coming in on the Indian IT sector. Following Accenture's latest earnings, we have Jasmeet who's standing by with the key takeaways.
While Accenture numbers beat estimate, as is the revenue is up by 8% and currently at 17.17 billion, while even net profits are also up, and management has increased their revenue guidance for the outlook from 5 to 7% to 6 to 7%. They have narrowed it down by creating bottom at 6%. While let's understand what brokerages say about the Indian IT. Firstly, we have MK on Indian IT. It says caution spending behavior by client amid elevated macro uncertainties and downgrade in the earning. While they also mentioned there's no further deterioration of demand. So the demand reduction is bottoming out and it can see an improvement, while the earning downgrade cycle is bottoming out. The pecking order top 3 for this particular brokerage is Infosys, TCS and HCL Tech. The next one we have is Morgan Stanley on IT. They say there's no major surprise for Indian IT based on the Accenture results, while the Accenture results are neutral to slightly positive for Indian IT. Accenture showed a strength in the financial services, while they feel it embodies the Indian IT sector as well. The demand environment has remained resilient, while the pickup in discretionary spending is still missing. While the clients have shown inclination towards more larger scale transformation. Then we have Goldman Sachs on Indian IT. While the demand environment has likely not worsened, what they say is, and they say visibility of improvement in limited, while the forecasting is 6.1% YOY basis, and they forecast a 0.4% increase in for September 2025 estimates. The next is Nomura on Indian IT. While they say the demand in financial services hold strong and there is no noticeable change in macroeconomic environment so far, while the Gen AI opportunities continue to mature and see a rise, while they prefer Infosys in large caps and Coforge in mid caps. It'll be interesting to watch out how the Indian IT results turns out in the coming months.
Absolutely. So that's the take coming in as far as some of those brokerages are concerned. Tell you what, let's take a look at some of those counters as well, because some of those counters are tanking away in trade. Let's take a look at HCL Tech as well as Infosys as well, because those are the counters that are down in trade. As you can see, a tinge of red coming in on your screens as well when it comes to some of those counters. Tell you what, let's go across and listen in fact, move on, take a look at what the defense pack and the outlook for the defense pack then looks like. India's defense capex has more room to grow, and that's the word coming in from Mahesh Tandurkar, who's the head of research and MD Jefferies India. Let's go across and listen into what he is penciling in.
As far as India's defense expenditure goes, I would say that the defense capex as a percentage of GDP today is at about 50 basis points. Over the last 20 years, if you see, it has ranged between 50 basis points to 1 percentage point of GDP. And given all the geopolitical tensions all around the world, also in the subcontinent, I think even for India, it needs to be towards the higher end of the historical range and not the lower end. So my sense is that over the next 5 years or so, I would expect India's defense capex to be rising by 25% CAGR. And plus, on top of that, there are other things like Make in India, and there are some small examples of Indian armaments being exported as well, etc. So there is a pretty strong growth outlook for many of the companies that are involved in this defense space. And I hear what you said completely, that the valuations are rich and it's going to take some time for the order book to grow and etc. But I think from a thematic perspective, it still makes sense to be positioned in that space.
Or rather, more room for the defense space. In fact, the capex to grow, and that's the word coming in from Mahesh Nandurkar as well. Tell you what, let's focus in on some of these defense counters that are buzzing away in trade. Zentech, that's the one that is up about 5%. Bharat Electronics as well. Let's take a look at some of those counters. In fact, we have Anushi who's standing by with an update on why exactly these counters are buzzing away in trade.
Right, so the focus has remained on the defense counters that we are seeing today, and this is on the back of some order wins in some of these counters. First, I'll start off with Bharat Electronics here. The company has got additional orders worth about 585 crore, and these orders pertain to fire control and sighting system for missiles, communication equipment, as well as jammers, spares and air services. Now, do note that the company did a margin of around 29% in FY25 and is on a steadfast route to continue this margin trajectory going forward, with FY26 target being 27% of a margin. Other than that, even in terms of where the order picture is considered, they're seeing about a 57,000 crore of order inflows. Of course, this includes the 30,000 crore of a QRSAM order as well. So that one would be an important one to watch out for. Now, the second counter in focus is HAL, Hindustan Aeronautics. Now, it's been bid for manufacturing small satellite launch vehicles developed by ISRO. So this is a new opportunity and foray for HAL, as well as this is one of the first given by ISRO to a company like HAL for this kind of an order. 511 crore is the kind of order opportunity that we are seeing for HAL on this. So a smaller order size, but a significant development that we are looking at. If you look at the order book positioning, that's about 1.84 lakh crore, a 95% of a jump from last year. Coming finally to Zen Technologies now, they've acquired a majority stake in TISA Aerospace. So TISA specializes in Indian development loitering munitions along with UAVs, that's unmanned aerial vehicles. So again, this move is in Zentech's line for expanding their foray into the drone technology that we're looking at. The company already has a strong presence in anti-drone space. So that is an important development that also we are seeing. So all these counters in focus on the back of order wins along with some acquisitions.
Well, absolutely. All of those counters, all of those defense counters in focus. Zentech up over 5%. Even Bharat Electronics is buzzing away in trade, as you can see on your screens as well, for some of those moves coming in for those counters. But tell you what, let's shift focus to the diagnostic space. Now, you can be booking instant, doorstep sample collection in under 60 minutes, and that's good news for customers. I'll tell you who it is bad news for, though. It's diagnostic companies. Those are the ones that are in focus on the back of this being bad news, because Amazon is a key important player that is there in this particular market. Varsha is standing by with some more details.
Thank you for that. So yes, Amazon has entered diagnostic market. Now they have launched their first ever home lab testing services in India. Now what they're going to do is that customer can now easily book lab tests, schedule and track appointments, and instantly access digital reports through the Amazon app. They've also promised doorstep sample collection in under 60 minutes, and the digital reports for the routine test will be delivered in as little as 6 hours. Initially, these services will be available in 6 major cities, that is Bangalore, Delhi, Gurgaon, Noida, Mumbai and Hyderabad, covering over 450 pin codes, and they're going to offer a selection of over 800 diagnostic tests. The new service called Amazon Diagnostic has been introduced in collaboration with Orange Health Labs. Now, why Amazon is doing this? Because they're going to, so of course the diagnostic industry itself is going into a double digit. Who would not want to go into such a a big market? Number one. Number two, they are also building integrated healthcare, and unifying services under Amazon Medical is one of the reasons why Amazon is doing this. Now, to key differentiating factors, so they will be having a rapid sample collection, timely report delivery and strict data privacy and quality standards. Real-time slot visibility would be there, map-based address and validation and secured digital report access via the Amazon app are some of the key differentiating features that Amazon will be giving. Lastly, if you see few stocks are under pressure in today, that is you have Dr. Lal Pathlab, you have Metropolis, you have Vijaya Diagnostics, and all the Indian diagnostic companies are actually under pressure because now Amazon has come into play. Now we all know that Amazon has that access when it comes to delivery infrastructure that Amazon has already set in, and with this partnership with Orange Lab will actually will be a disadvantage when it comes to overall your diagnostic companies.
Well, absolutely, it's bad news coming in for diagnostic companies, but just like Varsha said, it's a very big opportunity coming in for Amazon because it's a very big market there. But tell you what, let's also get you a list of the other counters, in fact, that are buzzing away in trade. Anushi joining us yet again with that list.
Okay, so the first counter is Bajaj Projects. Now, this is in focus on the back of an ultra mega power transmission order, the size being 400 crore over here. And this order pertains to building a new transmission line of around 138 kilometer. Again, if you look at the execution period for this, that is roughly around 29 months. Taking that in consideration with how the company did in terms of revenues last year, the company had clocked in a revenue of 2,500 crore in FY25, and the company has a market cap of around 2,333 crores. So it's a significant order that we are looking at for Bajaj Projects. Along with that, Interact is also the other stock in focus on the back of another order win. They've won a 80 crore of an order from Aether Energy, and this is for design, engineering and supply of pre-engineered steel building systems. Execution period being 9 months for this one. Just on that note, even if you look at the FY25 numbers, revenue was about 1,454 crore, and this was with a 9% of a margin that we are looking at. Company market cap is around 3,400 crore. So not a substantial order win that we are seeing, but still a significant one for Interact. That's why the stock is in focus today.
Alright, then those are the two counters that you should be watching out for. They're the ones that are buzzing away in trade. But tell you what, let's also take a look at some other important news and updates coming in. And let's also take a look at Tata Capital. In fact, because speaking of action from the primary markets, you do have Tata Capital that has in fact now gotten an approval coming in from SEBI on the confidential IPO papers as well. Agnidev Bhattacharya joining in with more details.
So SEBI is likely to have approved Tata Capital's confidential draft papers that it had filed in April for its IPO, which would have been worth about $2 billion. Now, the company is expected to file an updated DRHP publicly with SEBI after this, as is the regulatory norm. Now, the IPO is expected to be a combination of both fresh issue and offer for sale, with the fresh issue being of up to 23 crore shares. And Tata Capital is now mandated to be listed on the exchange by September of 2025. So this is one of the procedural steps that the company needs to go through before its IPO. And remember, we had reported earlier that the file for Tata Capital's confidential DRHP sat at the SEBI chairperson Tuhin Kantas Pandey's table, waiting to get approval, as is the norm with such big ticket IPOs. And Tata Capital is the latest in the line of another few big NBFC IPOs which are lined up for the year because of this RBI regulation. Other IPOs in the NBFC space which are coming up include Hero FinCorp and HDB Financial Services. So we will keep bringing you more updates about Tata Capital as and when they come in, so do stay tuned.
Well, absolutely, there's a 17,200 crore IPO coming in as far as Tata Capital is concerned. We'll trust you to get us more details, Agnidev. But tell you what, moving on, let's take a look at some of the other counters that we have as well. Zee Entertainment is the one that is also in focus. But before we get you some more details on that, tell you what, let's take a look at LT Foods. That is in focus after the US imposes around 340% duty on soybean meal exports as well. How is the stock going to be reacting? Mahima is joining in with that update.
Right, so as you rightly mentioned, so what US has done is they've imposed a 340.7% countervailing duty on LT Foods subsidiary, that is Ecopure Organic Soybean Meal Export. imports, and this is generally such high countervailing duty is only imposed when the company, when asked for certain information, does not provide that information. Either it's inadequate or it's not provided on timely basis, and this is because of this, the stock could see an impact. Now, the company does not really mention as to what kind of transaction it does with this particular subsidiary, but Ecopure in its filing did say that it will evaluate the legal remedies available for the counter and will take action accordingly. But the stock is down almost 6% as we speak today on the back of this, and this could probably hamper their overall workings in US per se.
Well, absolutely. That's LT Foods that we're talking about. But tell you what, let's also take a look at the blockbuster week that we have in fact lined up for the primary market. We have 17 IPOs set to hit the D street. 6 of them are going to be main board issues, 11 SME offerings as well that we're looking at, Mahima. So tell us about all of those as well.
Right. So, as you rightly mentioned, there are going to be 6 main board IPOs and 11 SME IPO issues in this particular week that are set to raise around 15,800 odd crores itself in this week. Now, to talk about main board IPOs, HDB Financial is the first one on the list. It's basically a retail focused NBFC, and the IPO date starts from 25th of June, ends on 27th of June. It's a total issue of 12,500 odd crores, and price band is set between 700 to 740, and the minimum lot size is 20 shares here. The next one is Sambhav Steel, which is a manufacturer of electric resistance welded steel pipes. This also opens on 25th of June and ends on 27th of June. The issue size is 540 crores and price band is 77 to 82, and the lot size is 182 shares. Then we have Kalpataru Limited also opening its IPO this week. It starts on 24th of June, ends on 26th of June. The total size is 1590. It's basically a real estate development company which is based out of Mumbai. The price band is set between 387 to 414, and the lot size is 36 shares for Kalpataru Limited. The next one is Ellenberry Industries. This is specializing in production and supply of industrial as well as medical and specialty glasses. The IPO opens on 24th of June, ends on 26th of June. The total size is 852 crores, price band between 380 to 400, and the lot size is 37 shares. Lastly, Globe Civil Projects, again another 119 crore IPO. It's an EPC company, opens on 24th, ends on 26th of June. Price band is set between 67 to 71. And Indo-Gulf Crop Sciences is also set to open its IPO on 26th of June, which will end on 30th of June. The issue size here again is 119 odd crores, and in terms of SME IPOs, a lot of SME IPOs will also be opening their IPO with the BOSes. Plus there's Ares Infra Solutions that is set to list on 25th of June. So a lot of primary market action this week certainly.
Well, absolutely. That's something that we're slating on our calendars. Lots of primary market action. But tell you what, before we wrap on this edition of Markets at 12, let's get the chart of Zee Entertainment on the screens as well, because that is the counter that is buzzing away in trade. On the back of that strong commentary coming in on plans to achieve break-even in Z5. So that's Zee Entertainment as well up on the screens for you. But tell you what, let's also focus in on arcades that are they just relics of the past, or do they still have relevance in India time zone? India, in fact, has relaunched their flagship arcade at In-Orbit Mall in Mumbai. But why now? Agnidev is joining in, who spoke to the CEO as well to get all of us a little bit of a sense on this. Take a look.
Arcades. You thought that these were things from the past, relics from a bygone era, which were only being used as cliches from horror shows from the 90s. But what if I tell you that this arcade is not just launching, but relaunching with a wider carpet area? TimeZone India claims to be Asia Pacific's largest chain of gaming arcades. How big is that? It's big. And today they are relaunching their flagship operation here in Mumbai's In-Orbit Mall. But why now? Why will a gaming arcade be relaunched in India when they are closing all over the world? And to answer this question, we got hold of TimeZone India CEO Abbas Jabalpurwala and asked him this very same question while forcing him into a bumper car ride with us. So Abbas, why do you think gaming arcades still have so much relevance in India today?
So what is changing in India is the growing middle class. As it continues to grow and disposable income rise, people are looking at avenues to spend quality time with their family, whether you're a group of friends or family, or you want to spend time with your child. So what better place than this than an arcade where you get to relive your childhood, meet your friends and have fun.
Well, if it wasn't obvious from what Abbas just said, gaming arcades are clearly a big thing in India. A JLL report from 2024 says that India has 6.6 million square feet of operational gaming arcades spread across the country. That's as much as 33 cricket fields. These gaming centers are spread across 500 different zones in 83 cities. And the segment is expected to grow 67% to 11 million square feet by the end of 2028. So relevance, that's there. But what about the money? Do gaming arcades just make enough money to justify this huge of a setup? And how good are the margins? To answer these questions, we strapped Abbas into one of his own rides, and he has been more or less kind enough to break this down for us. So Abbas, tell me, what are behind the business tactics of a gaming arcade like yours?
Arcade business is a very capex intensive business, as you know. We can see it around. Any good venue that pays us back in 2.5 to 3.5 years, considered to be a good investment. And with our 21 years of experience in the country, we now have enough and more data to basically identify a good location and make sure that our investments that we do are paying us back in the threshold limit that we have.
But gaming arcades are also booming in India because, well, it's India. And as the age-old saying goes, any place is fit for a date if you are Indian enough. Instagram today is full of content which suggests that gaming arcades are the perfect place for your online date. Just you, them, and some crazy competitive energy. But is this the same demography that Abbas targets? Third time's the charm, and we have got Abbas yet again to tell us what kind of an age group he targets with his gaming zones. So Abbas, do tell us more about this.
Look, we want to appeal to everyone who is 5 years to 50 years and beyond. And that's exactly what this venue truly represents. And apart from that, we also wanted to become a destination which becomes a go-to place to celebrate your special occasions, whether it is birthday parties or anniversaries. And that's why we have this multi-seater party room which can cater up to 100 guests. So when you get hungry, then that's where we saw that, okay, let's have an in-house cafe. And that's the whole thought process behind why we have the cafe and the demography, and that explains the demographic that we are looking at.
While the surge of multi-age oriented entertainment demands continue to rise in India, we can always expect more standalone gaming arcades turning up across Tier 1 and Tier 2 cities. But ultimately the bigger question remains, will I be coming back to this arcade for another bout of Skull of Shadow? Seems likely.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true. And today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Datia and with me is Varsha. Varsha, good afternoon. An interesting day of trade, a mild recovery that we're seeing in the markets. But what's interesting is some bit of resilience that we're picking up with regards to Israel-Iran war, with the US entering in as well. Let's quickly look at what markets are doing at this hour as we speak. If you see in terms of Nifty 50 as well, it is under pressure, trading in the red, but overall, currently, that from the day's lowest levels of 24,824, it's hit a high of 24,988, inching towards that 25,000 mark pretty closely. We're just around 50 points away from that level, so it's going to be interesting to see where Nifty ends in trade. Let's pull up Bank Nifty as well, and then the sectoral indices to see where the pressure point is. 0.6% kind of a cut that you're seeing with regards to Bank Nifty as well. And it's the private banks, and if you pick up the PSU banking index, that will tell you the story as to where the pressure is coming from. There you go, 0.2% lower on that front. Let's pull up the sectoral indices heat map to understand that trend on that front. Media is the top gaining sector. Defense is seeing some smart gains. Metals up in trade as well as we speak. Consumer durables and pharma, which is in the positive side. What's under pressure is Nifty IT, and that is taking cues from the way Accenture numbers have panned out. What's interesting is the guidance, but the brokerages have been absolutely gung-ho with regards to IT as a sector, taking cues from Accenture. But it'll be interesting to see how the day pans out there. Auto is also slightly under pressure in today's session. FMCG seeing cuts of around 0.6%. And you have Nifty Infra, which is also down in trade. But let's quickly look at what OMCs are also doing, because energy sector is taking a marginal beating to the tune of around 0.2%. Let's pull up the heat map in terms of individual stocks on Nifty 50 or even the contributors, because that will also give you a fair bit of an idea as to what's happening in terms of individual stocks. BEL on an order win is the top gainer today. Hindalco is seeing some smart moves. Adani Enterprises is also up in trade, and the reason that stock is buzzing in trade because they've actually commissioned their first off-grid green hydrogen pilot plant of 5 megawatt capacity. We'll talk in detail during the show. HDFC Bank, Infosys, ICICI Bank and Reliance Industries are the ones which are taking the Nifty 50 on a downtick. Interesting is the kind of moves, Varsha, that you're seeing in the broader markets, right?
Yes, actually, broader markets are actually in green. If you see Nifty Midcap 150, it's up 0.3%. And on the gainer side, though, you have MRPL, Poonawalla Fincorp, Dixon Tech, KEI Industries, and Linde India, which are buzzing when it comes to Midcap 150. On the loser side, though, you have Astral, you have Godrej Industries, Tube Investments, and Patanjali Foods, which are on the losing end when it comes to Nifty Midcap 150. Let's see what small cap 250 is doing. It's up almost 0.5% in trade today. You have Chennai Petro, you have K Fintech, you have VIP Industries, ITI, and Glenmark Pharma, which are buzzing in trade today. Well, Glenmark is buzzing on the back of Investec initiating a coverage on the stock. On the losers, though, you have Sterlite, you have Varroc Engineering, you have Ratan India, and MTAR Tech, Godavari Power. Which are on the downward side when it comes to small cap 250. So overall, if you see broader markets, yes, are in green today. But well, on the biggest story of the day, Iran and Israel conflict has taken another turn, with Iran proposing Hormuz closure post US markets. Listen into the veteran Ramesh Damani and expert Ajay Bagga's take on market post these escalations.
I'm generally having a more optimistic view of financial markets given what happened over the weekend. I think another way to look about this conflict between Israel, America, and Iran is to look at bark versus bite. And clearly, I think events as they've unfolded have proved that Israel and America have bark and bite, whereas Iran has only bark. So in my sense is that it was a very monumental decision that President Trump made over the weekend, but it has completely changed the contours of the Middle East. And I think investors can look ahead to an area of peace, prosperity, FDI flows in the Middle East.
A really very tough environment for traders, good environment for investors, and best environment for SIP investors who have just disciplined in a disciplined manner kept investing. They are the real winners of this year. Everybody's forgotten July 9th Trump tariff deadlines. Everybody has forgotten the big beautiful tax bill which is meandering through the Senate, and this has taken precedence. Total GDP of Israel and Iran put together is 1% of the globe. If Iran's oil goes out of the global supply, the Saudis and UAE themselves have more than enough capacity to ramp up. But if you look at the Israel bombing, they have bombed the Iranian internal storage oil depots. They have not touched the Iranian export terminals. So the Israelis also have some kind of a tacit agreement with the Chinese, who get 15% of their oil unofficially from Iran, that they will not hurt Iranian exports.
Right, so that's the word coming in from market veterans and Ajay Bagga as well. But let me also welcome in Sharmila Joshi, founder at sharmilajoshi.com. Sharmila, good afternoon and welcome to the show. My first question coming to you is, how are you seeing Indian markets in the context of what's happening globally, from the war to the kind of impact crude can see? And just a week before all of this, you had emerging markets which saw a huge inflow. I think, if I'm not mistaken, Taiwan was on the top of the list, followed by India in the form of ETFs. So there is fund that is moving into emerging markets. There are geopolitical concerns. Crude right now is not a major concern till it crosses that $80 per barrel mark. How would you advise investors to maneuver in this kind of a scenario?
It's a difficult scenario, all said and done, because I think just last week we were beginning to hope that things have taken a turn, and a lot of the moving sort of pieces that are there are now settling down. And now we've had a new sort of a geopolitical tension that has taken over. And my feeling has been over these last couple of months is that we need to be able to deal with these kind of uncertainties better going ahead. Because if everything that has happened in the last 4 or 5 years is anything to go by, it is clearly showing that that the kind of periods where we used to have, where markets are sort of going up in a directional manner, they seem to be getting those periods seem to be getting compressed, which I think makes life very difficult for traders. So I think, in a market like ours, where we are definitely seeing long-term sort of possibilities in terms of where the economy will get to in a period of 3 or 4 years, that's how you need to position yourself. So it's a very difficult time for traders. I really don't know what are the strategies they're using. But for long-term investors, I think the strategy would be to sort of buy on, when you get dips, and try and buy with a horizon of 3 to 4 years, and be in sectors which are at the moment sort of more domestic focused. But I think if things change, then obviously we will look at export-facing sectors as well. But the theme should be long-term.
Right. Thank you so much, Sharmila, for that view. Well, we all know that the crude oil prices have surged after US attack on Iran. Now, how this will impact which sectors and how this will impact the overall sectors, Mahima joins in with more details.
Right, so I'll start with paint companies, because crude is a key raw material for paint companies, and cost of crude as a raw material could make up to 30 to 35% of their overall raw material price. And because they use crude derivatives, crude prices going up is a negative for this counter, and it might impact their overall margins as well as profitability. Now, stocks that could get impacted includes Asian Paints, Kansai Nerolac, Indigo Paints, as well as Berger Paints. The next one is aviation. Of course, because of crude prices going up, your aviation turbine fuel could get expensive, and higher crude could impact the overall margins for these counters. That includes your Interglobe as well as your SpiceJet. Then we have tire companies, where tire industries use following crude derivatives for raw materials. That includes synthetic rubber, chemicals, as well as carbon black, and crude derivatives in tire also roughly amount to 30 to 35% of their overall raw materials. Now, stocks that could see impact includes Apollo Tires, JK Tires, as well as Seat. Lubricants like Gulf Oil and Castrol India might also get impacted, because they use direct crude derivatives like base oil as well as additives, and for them around 40 to 45 to 50% of their overall raw material constitutes of crude derivatives. Lastly, plastic and packaging as an industry also might get impacted, because polymers as well as polyethylene are direct crude derivatives, and a rise in crude prices could impact their overall margins as well as the profitability. So, stocks in focus could be Polyplex as well as Uflex and Jindal Poly. Now, of course, one thing to keep in mind is various experts are suggesting that this impact will only take place once crude crosses that $85 per barrel mark. Till then, the impact will not be much. So, this is the overall view as to how rising crude prices can impact various sectors.
Thank you, Mahima, for all of that, because interesting moves that you're seeing in individual stocks as well. But you have shipping companies which are buzzing in trade. So you have the likes of SCI, that's Shipping Corporation of India, and GE Shipping. Both these counters are up in trade today if you see the charts. And if let's just look at a 1 month chart, because that will give you a trend. Since the time crisis have started, you've seen that spike that has come in with regards to where shipping majors are concerned. 1 month, 12 to 13% on this one, and GE Shipping is another one which you should be watching out for. 5.5% is the last 1 month is the kind of gains that you've seen. And this is because your freight costs have surged, and this is as Indian exporters are abandoning Red Sea route amid the West Asia tensions. Pankaj Chadha, the chairman of Engineering Exports Promotion Council, spoke exclusively to NDTV Profit. My colleague Rishabh joins in with the key takeaways. Rishabh, over to you.
Right, what we've learned from conversations that we've had with exporters is the fact that Red Sea, the trade routes through Red Sea are now closed. That is not something that Indian exporters are preferring at this point in time. What we're seeing is that now shipments are being rerouted through the Cape of Good Hope trade route, that is via the African route instead of going through the Mediterranean. That means that exporters now face an additional 20 days of voyage for all of these shipments that are bound to either Europe or the West in general. That means 20 days of extra voyage. That also means extra shipping costs. And what Pankaj Chadha of the Engineering Exports Promotion Council tells me is that they are seeing seeing freight costs go up about 30 to 40% from what they were sending shipments earlier with. Apart from the cost angle, there is also the issue of in general just the uncertainties on whether containers will reach, given the fact that there is tensions that are developing and that are brewing day in day out, especially over the weekend with the US also formally entering this conflict. What we're also seeing is that exporters are also, of course, constantly tracking oil prices, which are also set to go up. They have gone up as of Monday, but they will further inch up if these tensions worsen.
Thank you so much, Rishabh, for that. All the three stocks buzzing in trade. Sharmila, let's look at the shipping companies. Let's look at companies that get impacted on the back of higher crude prices, if at all. Which companies would you advise to buy, if yes, if any? And any companies which get impacted on the back of higher crude prices, would you advise to sell?
So I think that clearly GE Shipping, I mean, in this current environment, for me, that's the stock that stands out, because I think Garden Reach and Cochin Shipyard, Mazda, we were already buying on the back of good orders, and the fact that, the defense theme and overall we have a sort of focus to improve our presence in the seas. So, those stocks, I think, should definitely be on your list. They have, however, gone up a lot, and so you need to temper down the kind of gains that you think you'll get there. But from this current conflict, I think GE Shipping seems to be the stock that could benefit clearly for the reasons that you mentioned, that dry freight costs are going up. And I was just quickly having a look at the valuations of GE Shipping, and they seem reasonable. So if this kind of period extends itself, which at this point in time it shows every signs of, then this could be the stock that could benefit from that.
Right. Thank you for that view, Sharmila. Now shifting our focus to IT sector, a series of top brokerages including Morgan Stanley, Goldman Sachs and Nomura have released their views on Indian IT sector following Accenture's latest earnings. We have Jasmeet joining in to tell us more about that.
Well, right, Accenture's numbers beat the estimate. While we see the revenue is up by 8%, but the new bookings have declined by 6%. While the management has also increased the revenue guidance from 5 to 7 to 6 to 7, basically they have narrowed down as bottom as 6%. Now let's understand what does brokerages say on Indian IT and how they read the crossover from the Accenture's result. First we have is MK on Indian IT, where they say no further deterioration in the demand environment. While the earning downgrade cycle is bottoming out, the pecking order for top three from them is Infosys, TCS and HCL Tech. The next is B&K on Indian IT. While they say the clients are aggressively pursuing on cost takeout opportunities, that's why the revenue. Next we have deal wins constitute to dominate the whole cost takeout scenario, while they feel the BFSI have a strong momentum. They prefer Infosys, TCS, Persistence and Coforge. While next we have is Morgan Stanley on Indian IT. They say there's no major negative surprise for Indian IT, while the demand environment has remained resilient, while pickup in discretionary spending is still missing. We have Goldman Sachs on Indian IT. What they say is visibility on improvement is limited, while their forecast is 6.1% for FY27, while the forecast for next particular quarter is at September 2025 estimates is 0.4%. Next we have is Nomura on Indian IT services. They say the demand in financial service still holds strong. Gen AI opportunities continues to dominate and gradually improve, while they prefer Infosys and Coforge. Lastly we have is Nuvama on Indian IT. While they maintain a positive stance on the sector from medium and long-term perspective, and they also say recovery in micro environment to accelerate the enterprise tech spending. It will be interesting to watch out how this result turns out for the Indian IT in the coming quarter.
Thank you so much, Jasmeet, for all the details. Well, Sharmila, just wanted your view on overall Indian IT sector. Which are your picks and your view and your take on Accenture's earnings?
So the earnings, obviously, I think were good, and really speaking, the guidance came as a sort of a good surprise in that sense that they improved it a little, or rather narrowed it to 6 to 7. So that I think is a positive. And I think as all these the various reports that you all were talking about mentioned that the visibility going ahead, nobody's really talking too much about that. We have July 9th in any case looming ahead of us, and this whole US tariff issue, we need to see how that plays out. Indian IT companies themselves have been very circumspect when they've given their guidance. They've spoken of like 3% and thereabouts, like absolutely low single digits. So in that sense, perhaps not as positive on the sector as one would have otherwise been. Once that environment improves, I think I'll be more positive. But however, I think prices have corrected. In the large caps, I like an HCL Tech, and then I think you need to look at some mid cap names. I think there you could possibly find more stocks that I like. I do, for instance, like a Zensar at this price, Persistent Systems, LT. LT Mindtree, so stocks like that, and again the view needs to be long term, but more sort of stocks of interest in the mid cap space rather than the large cap.
The mid cap is more preferred in terms of IT versus the large cap. But moving on, what's interesting is all the geopolitical turmoil that is going around. Whilst all of this is happening, Bernstein has actually signaled optimism on India's economy, and they've highlighted its resilience amidst the global headwinds. They've actually gone ahead and identified key stocks which could probably poised for growth. Somit brings in more from their report. Somit, over to you.
Yes, a couple of weeks back, Bernstein had gone bullish on mid caps over large caps, and now this report has come in where they're saying that it's the right time to invest in mid cap stocks, given the fact that, given the current global scenario, will not have a structural impact on India. They're saying that any dip could be an opportune time to invest in India's mid cap, and they have highlighted, or they have listed out 10 such mid cap stocks which where investors could look into over the next couple of quarters. Firstly, they are bullish on Coforge. They're saying that the high deal momentum is expected to drive robust growth for FY26. They're also bullish on KPIT Tech. They're saying that the company is positioning itself for a potential positive surprise for FY26, even without explicit double-digit growth guidance that was given by the company. When it comes to Persistent, they are saying that the company boasts a robust deal pipeline and a strong diversified client portfolio, which could turn out to be which could lead to a strong quarter or strong quarters for Persistent going forward. Delivery, they are saying that the negative impact of e-commerce insourcing appears to be plateauing, which could unlock volume growth going forward. They're also bullish on Renew, but do remember that Renew is not listed directly in India. So apart from that, it's Paytm which they're bullish on. They're saying that the company is poised to achieve PAT profitability in the next quarter, and apart from that, they'll also bullish on the facts that there is regulatory support coming in, and also a rebound of merchant lending that they're saying when it comes to Paytm. For Max Financial, they're saying that the growth and margin expansion is something that the street is anticipating, and this could follow through post the merger that has been completed with Axis and Max. Rebranding has also been done currently. When it comes to HDFC AMC, they're saying that the AMC is well positioned for market share gains and potentially higher than street estimates when it comes to asset under management growth, that is AUM growth. For Jubilant Food, they believe that the company plans to open around 1,000 new stores by FY28 and are expected to enhance delivery capabilities, which will in turn also lead to higher margins for Jubilant Foodwork going forward. And lastly, they are also bullish on Devyani on the back of the fact that a potential merger with Sapphire could unlock significant value not only for Sapphire but also for Devyani, and given the fact that Sapphire has seen a re-rating but Devyani has still not seen, so a merger could lead to a re-rating in the valuations of Devyani as well going forward.
Thank you, Somit, for that. Sharmila, let me come to you. Let's leave aside the three IT companies that Bernstein is positive on. Let's look at delivery. You have Renew, Paytm, Max Financial, as well as HDFC AMC, Jubilant Food and Devyani. If given a choice, which would you advise investors to buy out of this?
So I was actually just trying to wrap my mind around what their thinking process could have been. And as you mentioned, I think, if you remove the IT names, a lot of these seem to be sort of domestic focused themes. I personally like delivery and HDFC AMC within this list because I think that mutual funds as a business have a long way to go, and we can look at the other names as well in this space, but HDFC AMC certainly leads the way. So HDFC AMC, and I sort of agree with their whatever analysis of delivery. I think that once this is the kind of business where there is a lot of scalability in the Indian context, and you could see better revenues and numbers from them going ahead. So these could be two names that I would like.
interesting names coming in where Sharmila is positive on as well from the top picks that Bernstein has pointed out. But moving on, Zee Entertainment, that is one of the interesting stocks to focus on in today's session. Look at the stock price at the day's highest levels with gains of 9.5% coming in there. Now, the reason why the stock is buzzing in trade is on the back of the FY26 to the forward-looking guidance that the company has come up with. What they've indicated is that they're planning to achieve break-even in terms of Z5 in FY26 versus a loss of 548 odd crores that they reported in FY25. Their plan is going to be in terms of execution of the business plan and achieve this 100% target. Their maximization of risk-free treasury income is what they would be aiming for, and they would also look at surpassing the highest EPS that they ever achieved in FY19 in the next 3 years. In fact, if you talk about their FY19 EPS as well, that was at around 16.32 rupees. If you talk about 2025, their EPS is at 7.07, so it's almost doubling of EPS in the next 3 years. So that's an interesting target that they've given up. Apart from that, if you talk about their EBITDA trend as well, from FY23 to 25, it's in that 1100 odd crores to around 1200 odd crores kind of a range. In terms of the growth plans as well, they've said they're shifting strategy from long format to short format. They will look at inorganic opportunities in terms of growth through acquisitions as well and strategic partnerships. And what is interesting is the proposed preferential issue, for which they have a meeting with shareholders on the 10th of July, where they're proposing a fully convertible warrant of almost around 2,240 odd crores. Conversion price is around 132 versus a floor price of around 128. And overall, their promoter shareholding will come down somewhere to around 18.5% post this. The company is already sitting on a cash bank of around 2,400 odd crores. Sharmila, strong plans from a Zee Entertainment, 9.5% up move. Is it warranted? Is it achievable? And do you think execution will be the key over here? What would you advise investors to do from a valuation perspective? Good opportunity to buy or no?
Well, I've honestly not looked at this stock for the longest time because of everything that went down there, as well as the fact that I'm not very positive on, the old GEC model that we had. But, clearly all companies are now moving to whatever the stack model or whatever, where they try to incorporate OTT offerings with presence on web, etc. So I think that now, to my mind, makes more sort of sense going ahead than being, just a pure play GEC. So they definitely have some disadvantages because, even when you're present on the OTT space, how are they going to create the content? How are they going to finance it, etc.? And I think that this stock has already seen a run-up from the sort of low prices that it was trading at, where probably people put faith in this sort of story to unfold. So I think a lot of positives are now in the price. So I would really honestly just stay away at this point and see clearly, as you said, that the story will be whether they're able to deliver. And if they do, then I think there could be opportunity.
Thank you so much, Sharmila, for that view. Well, from one realty ancillary to another, in the latest, the Bureau of Indian Standard Certification implementation for PVC pipes have now been pushed to December. Let's get in Puneet to understand how this is a negative for organized players.
Well, thank you for that. So definitely it's a key negative for all the piping players, and that's largely because the BIS standard was expected to start implementation from sometime in July. Now that has been pushed to December of 2025. The BIS implementation is largely, it's a Indian standard, the Bureau of Indian Standard, that ensures quality products are supplied in the country. Once any kind of sector or product gets a BIS standard, that kind of becomes the benchmark of the industry, and that weeds out all the unorganized or the weaker players, and that largely helps the organized players. So if this was implemented for PVC, which is polyvinyl chloride, a key output and a key raw material for piping companies, if that would have been implemented from July, we could have started seeing the benefit of organized player gaining market share from this year itself. Now that has been pushed to December, while still a positive of implementation, is still delayed, and we could only see some meaningful impact on the financials in FY27. So we've seen some stocks recover actually from the day's low, because while the companies had mentioned about this and the implementation in July, there was some expectation that this could be delayed, and it's because similar industries and products like within something like a furniture or timber has also seen BIS implementation delayed almost 2 times over the last few years. We've also seen another one aspect which is anti-dumping of the PVC, of the said PVC product from China. Even though the BIS standard would be set, there would be still some dumping of cheaper raw materials from China, and I think the key industry players like Supreme as well as Astral are watching out for this aspect as well.
Thank you, Puneet, for getting us the details. In fact, Astral is trading under pressure. Supreme is interesting. If you can just pull up the intraday chart, because the stock was trading under pressure but has seen a smart recovery from the days, now trading pretty much in the positive. Sharmila, a quick one. Supreme Industries, Astral, 2 stocks that probably get negatively impacted on the BIS getting shifted further, and that's especially with regards to the inorganized market as well. How would you advise investors to look at these counters?
No, I would continue to be positive. I think it's a negative for sure that this decision has gotten delayed, and one hopes that it doesn't get postponed beyond December of this year. But if you're just looking at December of this year, I think, given the kind of interest that and demand that we've seen for both Supreme and Astral and their numbers, I think I would continue to stay positive for the bit. If it corrects a little more, maybe it will give us an opportunity to buy. But let's just put them on our watch list for now on the back of this news and see if they sort of trade lower than where they are currently.
Right, thank you for that view, Sharmila. Well, time for a quick break. On the other side, we'll bring you all the stock's actions along with a chat with Biocon management. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Markets recover from day's low, still trade in the red. Nifty Sensex show resilience despite Iran-Israel tensions escalating.
And order wins power HAL and Bharat Electronics, while Zentech acquires 54.7% of majority stake in TISA Aerospace, stock up over 5% in trade.
And IT continues to be on the back foot. Infosys declines over 2%. HCL Tech under pressure. Brokerages rule out worsening demand on the back of Accenture earnings.
Zee Entertainment plans to achieve break-even in Z5, stock up over 10%, also proposes a preferential issue of fully convertible warrants worth 2,237 crore.
And Tata Capital's 17,200 crore IPO gets a SEBI nod. Company filed for confidential DRHP and is expected to file updated DRHP publicly soon. Welcome back. You're watching Profit Buzzers. Varsha, an interesting recovery that you're seeing with regards to where markets go, especially with regards to broader markets. Let's just very quickly pull up Nifty 50, Bank Nifty, Mid Cap and the Small Cap Index, and that will tell you the kind of recovery that you're seeing. There you go. We are still hovering around that 24,950 mark. Let's pull up the broader markets. Mid cap 150 and small cap 250 at the day's highest levels, 0.4% higher on that front. So good recovery there. Small cap 250 as well at the day's highest levels with gains of around 0.6% coming in there. So it's the broader markets which are actually showing strength as we speak. But moving on, Adani Enterprises, that's a stock to focus on as well because they've gone ahead and commissioned India's first off-grid green hydrogen pilot plant, and this is marking a major leap in clean energy innovation and setting the pace for India's green hydrogen revolution. If you see what they are doing, it's a 5 megawatt capacity plant in Kutch, Gujarat. In fact, this is a milestone towards enabling India's green hydrogen mission, and the plant is 100% green powered by solar energy. It also has an integrated battery energy storage system. What they said is that they aim to become world's largest producer of green energy, and they are developing an integrated ecosystem for the same. This will entail renewable energy, electrolyzer manufacturing and downstream products like ammonia as well as methanol. Overall, in terms of expansion plans, they are targeting 1 million ton per annum by 2030 and a potential expansion to 3 million ton per annum by 2033. So the stock is up around 1.5% as we speak. Let me also welcome in Amit Bhuptani from Nirmal Bang Securities, and we already have Sharmila. Amit, let me take my first question with you. In terms of Adani Enterprises, what are charts indicating?
Yeah, good afternoon. So if you look at the Adani Enterprise, counter is looking positive. There is not much of a negative update on the chart specific front. Currently, the momentum is there in the counter. New long position can be created at this point of time. The breakout for the stock is at 24.95. Once the 24.95 is getting broken out, then we will witness another 40-50 points momentum on the upside levels.
Thank you, Amit, for that view. Well, green ammonia tender, so the Solar Energy Corporation has came out with green ammonia tender, wherein the goal is to decarbonize India's fertilizer sector by supplying 7,24,000 tons annually to 30 plants. Now, this falls under the site scheme with bids due by June 26, 2025. This initiative significantly reduces reliance on imported natural gas and lowers CO2 emission. Well, two sectors which are in focus, which will be in focus. One is you have the potential bidders would be you have L&T Energy Green, you have Adani Green Energy, you have NTPC Renewable Energy, which may bid for this green ammonia tender as they are already into green hydrogen. Well, fertilizer companies will also be in focus. You have Paradeep Phosphates, you have Coromandel International, then fertilizers and chemicals, Transcorp, Deepak Fertilizers and Chambal Fertilizers, which all these fertilizer companies will also be gaining in trade today. Sharmila, let me come to you on this. Your view when it comes to green ammonia tender and also the L&T Energy Green or Adani Green. What are your views when it comes to specifically on the green hydrogen and also the fertilizer sector as well?
So, I don't have a specific view on green ammonia as such, but what I have been liking and been observing is that there is a whole push towards anything that is renewable and green, and market is also liking that as a story. I think globally there is a great demand for such stories and plays, and we are seeing that play out in India as well. So definitely positive on all the three stocks that, Larsen, I think it's a subsidiary, Larsen Green, but the other two, Adani Green as well as NTPC Renewable Energy. I think I would probably add which are not related to green ammonia, but even stories like a Suzlon or a Wari Energies to it. But that is a basket I think that I like, and which market also likes. And overall, even the traditional power space is something that I like. So overall, this is the sector, and renewable energy within that as a sort of parallel sector is definitely is something that I like.
Right, thank you for that view. Well, Amit, coming to you, any of the stocks looking good on charts? You have, NTPC Renewable Energy, then you have Adani Green, and also some of the fertilizer companies like Deepak Fertilizers and Coromandel.
Currently, on the energy front, we are seeing that on chart specific structural wise, it's looking a positive sign being witnessed on the overall energy pack, but still 1 to 2 days will get more time period for the confirmation on the buying front. Currently, if we need to select any positive sign, then NTPC looks positive. While from the fertilizer space, the counter that looks positive from our end will be Chambal Fertilizer. The stock has created a base formation on the downside, with the 4 week base has been created on the downside, and a possible breakout has been witnessed in today's session. So currently, Chambal Fertilizer looks more positive in front of the overall fertilizer space. Currently on the upside, the counter is showing targets near 590 levels.
So that's with regards to where the fertilizer stocks go, and an interesting move with regards to the tender that will be coming in for green ammonia. But moving on, defense is on absolute high right now. Idea Fort, they've received an order. So strong moves there, around 137 odd crores. BL has also bagged a new order worth almost 585 odd crores for defense systems. HAL, they've won a bid for manufacturing small satellite launch vehicles by ISRO, and Zentech has acquired majority stake in TISA Aerospace. All of them buzzing, and there is a sentimental up move as well for the sector. Amit, what are charts indicating a further upside? Still a good buy?
Definitely, more good buying will be witnessed and carry forward buying will be witnessed in the overall defense pack, because if you look at the overall setup on the long-term structure, then majorly charts are showing the flag pattern formation breakouts with a healthy volume, which we are seeing currently in today's session also, and from last 2 weeks of trading session also. If we need to select any counter, then HL, BL and Garden Ridge shipment looks positive. Overall, if we look at the BL also, then the possible upside targets for the coming days of trading session will be around 445 to 460 levels.
Right, thank you so much for that view, Amit. Well, LT Foods is in focus. The stock is down almost 8% if I'm not wrong. Well, now this is on the back of US, which has imposed 340% of countervailing duty on its units exports. The duty is on Ecopure, which is a subsidiary of the companies. So duty is on the organic soya bean meal, and the duty generally is linked to not providing necessary information by the company, while company is currently evaluating all the possible legal remedies. Quick question, Amit, how are charts looking when it comes to LT Foods?
It is showing more negative strength. Currently, the selling which we have witnessed in last 2 days of trading session was completely with the volume front. So these are negative indicator. Currently, the counter can drag downside towards 375 to 370 levels. So currently, whomsoever is holding the long portion should exit at this point of time. And if a counter is holding 370 level, then we can create a new long portion at that point of time. But at this point of time, I am seeing more selling to be witnessed in coming days.
Thank you so much for that. Well, Sharmila, any views on LT Foods?
I was just trying to see what is the percentage that they actually export to the US, because I'm not clear on that, because this rate of duty sounds really absurd. So, I mean, definitely if their export is substantial, you will see the stock trade lower even from where it is at the moment.
Okay, so that's with regards to where LT Foods go. But let's quickly look at few of the volume buzzers. We've already discussed few of the stocks, but Alkyl Amines is a smart one. Volumes are up almost 7.2 times its 30-day average. And you have two sell ratings on a fundamental perspective versus one buy, one hold. That stock is buzzing in trade. VMart is another one. Volumes are pretty strong versus its 30-day average. You have 12 buy recommendations that are coming in on this counter, and it's showing you a 11.5% upside as well from the current market price. So that's an interesting one to watch out for. We've already spoken about Z Enterprises, but again, strong buy calls on that one as well. Idea Forge, again, strong volumes. We've spoken about that one, no major coverage. And a Chennai Petro, two sell calls, but the upside is around 15.5%. Volumes are also pretty strong. Amit, between a Chennai Petro, Alkyl Amines and VMart, what would your preference be?
Or if you need to select any counter, then currently Chennai Petro looks more positive. Overall, if you look at the setup from the quarterly front also, Chennai Petro, VMart and Alkyl Amines, all the three looks positive, but on the momentum front, I'm seeing that Chennai Petro is showing more positive strength. The counter can come towards 750 to 800 levels in the July series. If you look at the VMart, the pattern which has been created in the VMart on the quarterly chart, it's like a cup and handle formation. The break breakout for this counter is at 1000 level. Once the counter gives a breakout of 1000 level, then possible upside movement can come toward 1300 to 1400 level. So strength is there, but the breakout need to be done in the VMAT. But if you look at the Chennai Petro is already trading above the breakout level, so long position can be created in Chennai Petro.
Right. Thank you so much for that view. Well, Amazon has entered into diagnostic market. Clearly, diagnostic is growing into double digit. Now, Amazon has launched its first ever at-home lab testing service in India. Now they are actually promising doorstep sample collection in under 60 minutes. Digital reports will be available in 6 hours, and initially these services are available in 6 major cities, that is Bangalore, Delhi, Gurgaon, Noida, Mumbai and Hyderabad, covering over 450 pin codes. Sharmila, let me come to you. Now we all know that diagnostic is growing into double digits, and one of the reasons why Amazon has come into this sector, and Amazon already has the delivery setup and all, and that's the reason if you see Dr. Lars and Metropolis and Vijaya were under pressure. Just wanted your view, how are you taking this news, and do you think over a longer period of time all these big organized players will be affected by this?
In the short term, definitely, because I think that Amazon's entry into the market will shake things up, especially for the metros. Because they would not have entered the business lightheartedly. If they're saying that they're going to do something in 60 minutes, they're going to deliver. We've already seen a sort of a pricing shakeout in this space when larger players entered. When we had that 1mg and others entered the space, we've seen the traditional diagnostic old listed players having to sort of reimagine themselves and get focused back into how they were pricing tests, etc. But I think at the end of the day, what really matters is that this business is growing because all of us are testing more. And even when you go for any kind of ailment, you are always asked to do a list of tests before anybody, you sort of proceed with the treatment. So I think this is going to be a space that's going to grow irrespective of Amazon entering the market or not, and so will the listed players. They might get impacted for the short term, but overall I would still continue to be positive on them.
That's an interesting view coming in. But thank you, Sharmila. Thank you, Amit, so much for joining us on the show and sharing your views as well with all the stocks that we've discussed so far. But moving on and staying with the healthcare space, you have Biocon, which has gone ahead and raised 4,500 odd crores via QIP. The stock is trading at the day's highest levels with gains of around 0.8% coming in there. Now, what next for the company? We spoke to Siddharth Mittal, CEO and MD at Biocon. Let's quickly listen in to that conversation that Tamanna had with the management.
Siddharth, let's start with the rationale for the fundraise. Debt reduction, of course, but is that the primary reason?
So let me contextualize. We have a bank debt of $1.2 billion. And we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
What would your debt level sit at post this?
So the debt level will be still at $1.2 billion because we are not repaying any of the bank debt or the bond debt that we had. So we have just basically what we have done is on a fully diluted basis, Biocon would have held 72% of stake in Biocon Biologics. And once we have given the exit to these investors, we would increase our stake to 79% in Biocon Biologics.
Okay. So, one question that comes to mind, and you spoke about Goldman Sachs specifically, would they not have had the options for the conversion of their debentures in Biocon Biologics? Why would they not be exercising that?
So Goldman Sachs had the option. It was an optionally convertible debenture.
Right.
While the other investors, Kotak and Edelweiss, is non-convertible debentures. But coming back to Goldman Sachs, of course, they had an option to convert it into equity. But today we are also we are all aware that some of the headwinds that we had in the last couple of years because of facility issues, not receiving the approvals, and the growth that the business had, I mean, that probably influenced their decision to not convert. Of course, I would let Goldman Sachs comment on what was the rationale for redeeming the OCD and not converting. But today, I think I'll move forward and say that we are very well placed. We have addressed a lot of those issues, whether it was relating to facility approvals, whether it was relating to product approvals, whether it was relating to gain in the market share for various products in the US or other markets, and coming back to the growth trajectory. So I think we are very well placed. And I think the QIP or repaying some of these investors, as I mentioned, give us the opportunity to increase our stake in Biocon Biologics, which can then be unlocked at a much better valuation in the future.
Okay, is it also in part because, the Biocon Biologics IPO was expected, then there was a clarification or there was some clarity coming in on your last call that might not be the case, you are reviewing it. Can you just give us a status check, Mr. Mittal, on what's happening with the Biocon Biologics listing? Is that still in the offing?
It's still in the offing as one of the options. Okay. But as you rightly said, that Biocon Biologics IPO was being discussed since many quarters. And given that there was a lot of concerns in the equity market regarding IPOs in the last couple of months, the board constituted the committee to look at what are the other options that they should look at, including a merger between Biocon and Biocon Biologics. I think that is also one of the options. The committee has been constituted. The committee is having discussions internally along with other bankers as well, and will make a recommendation soon to the board in terms of what is the best option to unlock the value for both the shareholders of Biocon and Biocon Biologics.
Okay, so this is still a work in progress in that sense. Just want to get a sense on your entire debt reduction focus. Is that a focus area? Is there a sort of a glide path to debt reduction that you have in mind, Mr. Mittal?
So, of course, you have debt repayment obligations, and 800 million of bond is repayable in 29, and the remaining $350 million of bank debt starts. The repayment starts somewhere in calendar 27, but majority of the payments are due on calendar 28 and 29. So if you look at near to midterm, that debt reduction is not really a big burning issue. And what is more important for us is to generate free cash flow, get back to the growth levels that will support these debt repayments as and when it starts.
Okay, so that's strategically you're very clear about that. You've also talked about launching 5 new biosimilars next 12 to 18 months. Can you give us a status check on that? Or, what are the kind of timelines you're looking like? What's the opportunity size?
So we've recently announced a launch of biosimilar ustekinumab in the US. Of course, the ramp up would take its own time, but at least we've got a very good formulary coverage in the US. We are going to be launching biosimilar bevacizumab in the US in the coming few weeks. We are also expecting an approval for biosimilar aspart in the US. Now that the facility is cleared, again, that product will come up for launch this calendar, hopefully. And apart from that, we have also spoken about approval that we have in the US for biosimilar aflibercept and a settlement that we recently announced, which will allow us to launch the product in the second half of next calendar year. And we have a couple of other filings which are under review with the FDA. So with all these things, we are, of course, quite confident that, with the growth of our base products, and these upcoming launches, we should be in a very good growth trajectory in the coming years.
What is the kind of market share you're seeing for Stelara? And the other biosimilars that you mentioned, I don't want to mess up the pronunciation, so I'm not going to try. But the two that you mentioned, Mr. Mittal, what are the kind of market shares in the US market that you're looking at?
It'll be a bit premature for me to comment on the market share. As I said that we have got a very robust formulary coverage. I think that's the starting point. If you do not have a good formulary coverage, then you can't even commercialize your drugs with those customers. So today, at least, we have been listed in most large formularies, almost covering 70% of the lives in the US. And of course, the contracting has begun, and over a period of time, we'll also have to see how the push down happens, because each of the formulary might have one or more biosimilars or also the innovators. So how each company fares within that formulary is something that we'll see over a period of time. But I must remind you, unlike generics, where you see the coverage or market share build up for generic companies in a very short period of time, for biosimilars, it does take anywhere between 12 to 24 months. So I think we'll be in a better position sometime by end of this calendar / early part of next calendar to see how we fare. Now, the only thing I can say is that if you look at the other products that are already in the market, like biosimilar Glargine, where we are close to 20% market share, or biosimilar Pegfilgrastim, where we have the highest market share, almost at 30%, or biosimilar Trastuzumab, where we are almost 24-25% market share. I think that just demonstrates a good coverage that we have got in the US. Whatever efforts the commercial teams, market access team, they've been able to deliver post the acquisition of the business from Viatris.
And what about the liraglutide launch in the US? Is there any visibility on that?
Well, we definitely have a visibility of liraglutide launch in Europe, we already have the approval. The launch preparedness is going on, and we'll be launching in various markets next quarter. And US, the product is under review with the FDA, and we have a target action date coming up next quarter. And we are hoping that we will receive the approval. And depending on our settlement with the innovator, we will be preparing for the launch sometime this fiscal.
Well, this is Biocon Biologics, rather Biocon, giving an outlook for future years. But I'll just share 3 or 4 key takeaways from this interview. They're going to generate free cash flow. Rather, free cash flow generation is the main focus for them. They're also looking for various options, when it comes to Biocon Biologics, because IPO was on the cards, but now they're looking for other strategic actions. Maybe they're going to merge Biocon Biologics with Biocon.
But they're saying it's still under consideration.
It's under construction,
right now.
yeah. It's still under construction. Maybe the merging may happen, we don't know. And also, the other point is when it comes to GLP products, which is the current hot topic when it comes to pharma. So they are going big when it comes to all the GLP products. You have semaglutide and liraglutide as well.
And you have Novo Nordisk, which is leading the race right now as well. So that's an interesting conversation so far. But before we wrap the show, let's just quickly take a look at what the markets are watching out for right now, because the recovery that we are seeing is pretty smart in terms of the broader markets as compared to the benchmarks. But it's the selling that is probably getting absorbed in the markets, and that's the key aspect that we are watching out for. Secondly, Nifty, that broad range, if you look at the key trigger levels, 24,400, 24,500, moving on to 25,200 and then 25,300. These are the 4 crucial levels that the street is watching out for in terms of the range as well. Now, the indication is that probably a new round of panic that could likely emerge, and that is only if Iran retaliates against the USA. Until then, probably there will not be any panic situation, is what the experts are indicating so far. In fact, if Nifty has to break upper range, if major steps are taken at the GST Council meet, is what everyone is eyeing. The dates should be released anytime soon. So that is going to be a key thing to watch out for, where rates rationalization will be key with regards to where the GST Council meet goes. And no panic till Brent crude does not break $80 per barrel mark. So that is also another indication the street is watching out for. In fact, there is monthly derivatives expiry this week, so that volatility is the key indicator. VIX is going to be interesting to watch out for, and whether there is buying emerging as well. And the GRM movement will bring focus to stocks like MRPL, Chennai Petro, ONGC, Oil India, as well as Reliance Industries. So these are a few of the factors that the street is watching out for from a market's perspective. But completely out of time. With that, it's a wrap on this edition from Profit Buzzers from Varsha, the team that put the show together, and myself. In fact, lots more lined up on the other side. It's a half an hour of IPO coverage that you should be bracing for. Please stay tuned to NDTV Profit.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories.
Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company in focus for us is Indogulf Crop Sciences. The company is coming out with an IPO which opens on June 26, closes on June 30th, price between 105 to 111 rupees per share. It's a fresh issue of 160 crores and OFS of 40 crores. So a total of 200 crores, and the company is valued at little over 700 crores at the upper end of the price band. And joining me today is Sanjay Agarwal, who is the Managing Director of the company, and Mr. Manoj Gupta, who is the Chief Financial Officer of the company. Gentlemen, thank you for joining us on NDTV Profit. To begin with, Mr. Agarwal, give us a sense of the kind of work that you do, the manufacturing you do in the crop sciences business, because what we understand is that you manufacture products for crop protection, plant nutrition and biologicals which are used in the agrochemical industry.
Yeah, good morning, friends. So Indogulf is basically into manufacturing and export of agrochemicals. And agrochemicals has two broad segments. One is crop protection and one is crop product. So we are into both the segments. Crop protection, we have herbicide, fungicide, insecticides, plant growth regulators. And in crop productivity side, we have biologicals and nutrients. So we have a integrated basket of product, and in our technical basket, we also manufacture technicals as a part of our crop protection business. So we have around 70 registrations with us, out of which we produce some 10, 12 technicals. We also import some technicals. So our basket is a very comprehensive basket, serving to B2B, B2C, and overseas customers.
Mr. Gupta, you're raising around 160 crores in fresh equity. What is it going to be used for?
Out of this 160 crores, 65 crores we have used for working capital. 14 crores is for my new plant, DF plant is coming, and 34 crores loans repayment we are doing. 12 crores is basically for the issue expenses, and balance is the general corporate purpose.
Mr. Agarwal, you spoke about the fact that you do B2B and B2C business as well. What is the kind of outlook that you have for this sector? Because you've been growing on a top line of really 6.4% on a CAGR basis, which is compounded annual growth rate basis for revenues, and profits are growing at 3.5% on a compounded annual growth rate. So what is the kind of outlook of growth that you have for growth you have here?
All these three verticals have different opportunities. So our main focus is on our brand business, and especially for the India market. And in our crop protection, there is a segment of biologicals and nutrient, which is one of our legacy business. And when we started this company, one product which is a micronutrient deficiency corrector, that was our initial products. So we grew over 3 decades, and biologicals and the nutrients will be the major focus area, because these are the upcoming market and emerging products. We are more focused on brands. Also, we have overseas business, and in overseas business, we have been working in 34 countries. Many registrations are still in pipeline. Our business is a regulated business, and it requires some times to get the registrations, and we are doing well. However, overseas is not our major part of the business. Brand business is the major part of the business. We also do B2B, which is basically technical business, and this adds value to the barter purchase and the supply chain management also. Our commitments and our deliveries are the base for this B2B business, and we are doing well. However, for our future growth, we plan to expand our brand business more aggressively. Very recently, we have added one wholly subsidiary company by the name of Abhiprakash Globus Private Limited, which is a wholly subsidiary of Indogulf Crop Science. The objective is to increase the reach and increase our brand business, our B2C business.
Since you said it is a regulated business, can you give us an idea? Do you depend on subsidies, reimbursements coming from the government?
No, we are not into like bulk fertilizers or any such kind of subsidies. So it is a private channel, and we have over 6,000 distributors. We have around 200 channel partners for B2B business, and more than 130 business partners overseas.
Mr. Gupta, can you comment on the margin picture here? Because you had a margin of 10.7% EBITDA margin in FY24, but for the 9-month business, it is 9.36%. Is there a reason why margins have contracted for the 9-month period?
Numbers are actually for 9 months. Basically, when we go in the 12 months numbers, it will be much better. But yes, if you will compare with as comparison to last year, we have done the equal margins. So last year with the 9 months number, it was 9.5%, and it is again 9.3%. So there is not a much, but yes, we have the growth in the PAT margins, which was in last 9 month numbers, this was 4.1%, but this year it is 4.6%.
So is there a cyclicality in your business?
Well, that was the management of Indo-Gulf Corp's Crop Science. So, but it's raining IPOs. Ellen Barry Industrial Gases IPO is also set to hit the Lal Street on June 24. My colleague Sajid spoke to the management as well. Listen in.
Give us a sense of the kind of industry that you're in. What is the business structure that you have, and what are the business verticals that you have?
Okay, we started with air separation gases, that is oxygen, nitrogen and argon, and that remains our mainstay. Other than that, we are also manufacturing a number of other gases and distributing some, which are quite synergistic to the main business of air separation gases. The customers are generally the same. Other than that, we have businesses in terms of EPC. We make complete plants for separation and related equipment and directly sell them, or we also supply to them, to our customers on long-term contract basis, with operation and maintenance being done by us. We also have business in healthcare, which emerged mainly out of the needs arising from COVID, and we do hospital pipelines and turnkey supply, total gas management with regard to the hospital ecosystem. So these are generally the main businesses in the company.
Varun, can you take us through the 400 crores that you are raising with respect to how you're going to use it?
Sure. So the 400 crores is primarily for three purposes. The first is to set up a greenfield expansion plant of 220 tons per day in eastern India. This plant is located adjacent to one of our existing units, which is running at 100% capacity. So there is a need for capacity increase there. Another significant portion of the proceeds will go towards repayment of our debt. And lastly, about 100 crores out of the 400 would be towards general corporate purpose.
Mr. Agarwal, can you give us a sense of the kind of market we are in? Because you are eastbound, which is with major facilities coming in West Bengal. How big is that market for growth?
Gases are everywhere, and the market generally anywhere would grow faster than the rest of the industry. There are no published numbers in terms of the market size, but we see generally a growth exceeding 10% in all geographies. Yeah, we are strong in East and South India, but at the same time, we also cater to customers in the rest of the country.
And how do you transport these gases across the country? Because transportation is the biggest thing for gases. So how do you do that in that sense?
So, we have three modes of delivery to our customers. The first mode of delivery, which is the most important in terms of our revenue contribution, of about 2/3 of our revenue comes from delivering liquefied gases to our customers. Here what we do is we liquefy the gases in our plants and then transport it via tankers, which are owned by the company, to the customers' factories. Liquefying the gases allows us to reduce the transportation cost drastically. So it's sort of similar to, like how natural gas is liquefied into LNG and then transported. So that's about 70%. About 15% comes from supplying in cylinders. And these are cylinders all of us have seen, probably in a hospital or in any sort of a small factory. However, the cylinder supply radius is quite limited because there the transportation cost is quite high. And the third is, where we call it the on-site model. And here what we do is for our very large customers, we set up our manufacturing facility inside the manufacturing facility of the customer and directly supply the gases to them via pipeline. So these are the three sort of distribution models, and this is what sort of differentiates our industry, because you're supplying in sort of three different mechanisms.
Varun, can you also take us through your financials once? Because I'm seeing roughly around 20% odd jump from FY24 to 25 in revenues, but your PAT has almost doubled in that, and your EBITDA margins have also gone up from 22 to 35%. What has led to this huge jump in EBITDA margin and PAT?
Sure. So you're absolutely right. Our revenues are up over sort of, if you take FY23 as a base and compare to FY25 numbers, revenues are up 50% in 2 years, and EBITDA and PAT are up 3x in 2 years. And that's a result of significant margin expansion. Our EBITDA margins are close to 35%. Large portion of the expansion in margins has been driven by greater capacity utilization. As we are increasing our capacity utilization and growing in size, we are achieving significant operating leverage. The other thing is sort of a higher margin revenue mix. So typically, our revenue from on-site business has higher EBITDA margins. Our revenue from sale of argon gas has higher EBITDA margins. And these two have contributed higher in terms of share of revenue in FY24 and even more so in FY25, leading to an increase in the blended EBITDA margins for the company.
So what is the mix between on-site and your manufactured gases as of now in terms of revenue?
So about 15% of the revenue comes from on-site, and 85% comes from our merchant plants. But the on-site revenue, the way we book the on-site revenue is at a gross margin level. The revenue is recognized at the gross margin level itself. So which means even though it contributes only 15% to the top line, but it has an oversized impact to the EBITDA and PAT.
Well, so that's the overall picture that we are seeing for Ellen Barry IPO, so keep that in mind. But it's going to be a blockbuster week for the primary markets, and this is with a whopping 17 IPOs set to hit the street. 6 main board issues along with that 11 SME offerings are looking to raise a combined total of over 15,800 crores. Mahima comes in to give us more detailed breakdown on this.
Right, so as you rightly mentioned, 6 main board IPOs to watch out for certainly this week. The first one to start with is the most awaited IPO of HDB Financial Services. It's a retail focused NBFC. The open date for this IPO is 25th of June and ends on 27th of June. The issue size is 12,500 crores and the price span is set between 700 to 740 and the lot size is 20 shares. The next one is Sambhav Steel, where this particular company manufactures electric resistance welded steel pipes and structural tubes. This also opens on 25th of June and ends on 27th of June. The overall issue size is 540 odd crores and the price band is set between 77 to 82 rupees and the lot size is 182. Next one is Kalpataru Limited. It's a real estate developer company which is based in Mumbai, and the open date for this IPO is 24th of June and ends on 26th of June. The issue price is set between 1590. The issue size is in 1590 odd crores and the price band is set between 387 to 414 per share. The lot size is set at 36 shares. Lastly, Globe Civil Projects will also be in focus. It's basically an EPC company. It opens on 24th of June and ends on 26th of June. The issue size is around 119 odd crores and price band set between 67 rupees to 71 rupees and the lot size is 211 shares. And Indogulf Crop Sciences which did come out with its price band and issue size today. It opens on 26th of June and ends on 30th of June. It's engaged in manufacturing of crop protection products as well as plant nutrition. Overall issue sizes of 119 crore here as well. Couple of SME IPOs are also opening this week. To name a few, includes Profex Tech, Ace Alpha, Abram Foods, etc. And there's one listing to watch out for this week on 25th of June, that is Eris Infra Solutions as well. So certainly it's going to be a buzzing week for primary markets this week.
Okay, thank you for that, Mahima. So that's all that we have on the primary markets. But let's talk about the secondary markets, and it's an interesting day of trade that we are looking at now. With all the escalation that we have seen with Iran and Israel over the weekend, the expectation was for the markets to be under pressure. But benchmark indices, if we are looking at, are currently holding up, right, Puneet? In fact, if you look at the small cap and the mid cap indices, there's strength over there as well.
Well, definitely, and I think a couple of surprises, to say the least, was how the market is reacting to the IT names. We'd largely seen, for the numbers of Accenture over the weekend, stock was down, in its traded market by almost 8 to 10%, and that's largely because of order booking. But the results were above estimates. The company also raised its guidance from the lower band essentially, but that's not helped the IT sector at all. It's taken the sheen out of stocks like Infosys. Something like an HCL Tech and Tech Mahindra are also down. Let's also look at the mid cap and small cap. As you rightly said, it's largely outperforming the benchmark indices today. There's a lot of positive news flow, and if you can see the chart also, it's been a very positive build up right from the start till the end, and it's been at least till now at the high point of the day. It's roughly been about a 300-point range on the mid cap, while on the small cap as well, it's largely been around a 250-point gain in terms of the range of the day, and it's steadily built up after the initial blip which we saw in the morning today as well. But let's also look at the BSE 500, because those also are seeing a lot of moves both on the gainers and the losers side. On the losers, some sheen taken out of realty stocks like Godrej. The other ones, Astral, as well as something like a Supreme, was also down in trade today, and that's largely because of what happened in the morning with the company. We spoke about this as well in terms of BIS implementation being delayed to December. Largely it was expected to come in the month of July, so that will be a key for organized players to gain back some share. On the gainer side though, we have some very strong movers. AkzoNobel is one of them, largely on the block as well. In terms of the consumer facing business, VIP is seeing a very positive move after a really long time. Actually, the company has been subject to a string of poor results over the last few quarters, seeing some positive momentum. Trent as well as the other one, but the top gainer today, and that's visible on your screen as well, is Z Entertainment. Now the company is in focus after they released their investor presentation yesterday and said it plans to achieve break even in their OTT business, which is Z5, among other things. Let's bring in my colleague Vansh now to get us more perspective on this. Vansh.
Right, so the company is expecting to achieve a break-even in the Z5 segment by FY26, which previously accounted for a EBITDA loss of 548 odd crores in FY25. So their main focus remains on the maximization of the risk-free treasury income. And the interesting thing to watch out for is they have guided for the EPS. They have guided that they will surpass the highest EPS by FY19 at 16.5 rupees. So this is a key thing to watch out for, as the FY19 EPS stands at rupees 16.5 and current EPS stands at 7.5. So we can expect almost a double-digit growth in EPS over the next 3 years. Also, the company has laid down various strong growth plans for the company. They will be entering into new business verticals and will transit from long form to short form content, and they will expand the target audience and augment revenue streams. Also, they will be investing into media tech and will focus on inorganic expansion through acquisitions. Also, the company has previously raised a preferential issue of about 2200 odd crores. The conversion price per warrant was 132 rupees and the floor price for which was 128.5 rupees. 25% of the consideration was paid upfront, while the remaining 75% is to be paid within the 18 months. However, the approval is still awaited and is awaited for the meeting scheduled on 10th of July. Post-conversion, the promoter holding for the company will be raised from the current 4% to 18%. And the company has also laid down how the cash reserves from the preferential issue would be used. They will be used to fund potential acquisition targets, and the cash balance will open avenues for transformational strategic initiatives. And they will also use the cash balance to counter any financial burden like unexpected expenses or financial downturns. So this is what the overall picture is looking like for Zee Entertainment.
And Zee largely in focus on the back of the investor presentation, of course, but over the last few years, ever since the pandemic as well, the companies had a failed merger. If we can get the 1 year and the 5 year picture very quickly, a failed merger with Sony was one of the key negatives. The stock took a deep beating, almost I think went to the levels of 90 rupees actually. And you see the 12-month chart absolutely flat, but let's take a more longer term view as well, because that was one of the key negatives. Apart from that, stocks down 20% in the last 5 years, while the Nifty is up almost 80%. So definitely a key underperformer there. They are banking on the traditional business also getting back to growth with advertising as well as subscription revenue coming back, but it seems like a tall task. It's at the bottom end, as my colleague once highlighted, was roughly at around 16 rupees EPS, now is at 7. So the growth trajectory is certainly there, but if we can go back and get across from the historical highs will be some of the other key factors to watch out for on Zee Entertainment. Valuation definitely in focus, and we are seeing the stock react positively there as well. But the other set of stocks and largely dragging the markets upwards today is the defense companies. And that's one of the key segments in focus. Anushi, why don't you fill us in on some of the key ones?
A lot of stocks in the defense space, are buzzing. In fact, if you pull out the Nifty India Defense Index also, that's up in trade today, nearly about 1% or so over here. And couple of counters in focus over here. In fact, it's up around 2% in trade currently. If you just pull out the chart also to see some of the top contributors in the list. So let's take a look at that also. While we're on that, Idea Forge is the first stock in focus. Now they've received an order worth about 137 crore, and this is to supply mini UAVs, that's unmanned aerial vehicles, with accessories to the Defense Ministry, and the timeline given for this is about 1 year. In fact, this is a big order win for Idea Forge, considering that last year the order book was around 13.5 crore and they had cited slowdown in terms of where the drone industry is concerned. So a big positive that we are seeing for Idea Forge. Bharat Electronics, another stock in focus, and this is after the company has received additional orders worth about 585 crores. This pertains to missile, fire control systems as well as sighting systems as well. Also includes communication equipment along with jammers and services. Now, if you look at the order inflow picture for BEL, while they had missed their FY25 guidance of 25,000 crore. It's this year in particular, which is interesting. 50,000 crore is the kind of inflows which are expected. This is again in consideration with a 30,000 crore of a big ticket order that the company is waiting for in terms of where the QRSAM order is concerned. So BL, another stock in focus. HAL, we had already highlighted it on Friday that they had received a bid for manufacturing small satellite launch vehicles which were developed by ISRO. That is a first that we are seeing for HAL. So it's a new foray for the company as well. Order size, if you look, it's more than 500 crores. So 511 crore is the kind of picture that we are looking at. And lastly, coming to Zentech, while this is not an order win that we are seeing, they have acquired a majority stake in Tessa Aerospace. Again, with this, they are expanding their presence into the loitering munitions and UAVs as drone segment. They already have a strong presence in the anti-drone market. So this is a particularly strong foray that we are looking for Zentech as well. So all these defense counters are buzzing on the back of that. So that's where the defense outlook is concerned, Puneet.
Definitely, it's been one of those sectors that's performed very well in this particular time frame at a time where the markets have been slightly choppy, at least on the benchmark. So a key positive there, at least for the index as well. But that was largely on what's been defense. But Anushi, there's a couple of them which are buzzing on the back of order wins as well. Why don't you start off with
Right. So we already spoke about these defense names which are buzzing. We also had the likes of Solar Industries, another stock which is buzzing on the back of order win. NBCC, the stock is in focus on the back of an order win also. But I want to highlight Bajaj Projects. Now they have received order for a mega power transmission line, and this is for over 400 crores. So that is an interesting one. Interact Building also, if you are looking at, they've received a 80 crore of an order from Aether Energy, and this is for design and erection of pre-engineered steel building systems. If we look at the timeline for this, that is 9 months. So these are the two stocks in focus, currently up over 4% in trade today. But that's all that the time that we had on this edition. So stay tuned for India Market Close coming up next.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Hello and welcome. You're tuned in to India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. Let's look at how markets are doing. Fine fettle, if we look at it from a perspective of how we started and the slight wobbliness that we saw at the start, that has in some form or shape calmed down. We've reached 25k again and we've settled in around this region. We look at the intraday and we'll likely see that the Nifty Bank also not showing too many negative signs. From the lows, we've seen a decentish, more than half decent recovery, which is what is the likely positive. Let's look at the heat map as well on the Nifty. And within that pack, defense of course continues to stand out, but a Trent is doing another 5% in trade today. You have BEL, Hindalco also doing relatively okay. So a little bit of metal, defense and retail. What's not doing well is IT, slightly muted after what Accenture has done or delivered in terms of their performance as well as commentary. Let's look at the advanced decline as well on the larger index, and that it has gotten relatively or improved relatively much better than the Nifty 50 index. We've seen a tapering down of the declines, and now we're very close to 1:1 where the advanced decline ratio is concerned. So the breadth is looking markedly better compared to how we started the day off. Sectorally, before I bring in Neeraj to give us perspective on broader markets, But look at the media index, that's one which is flying, and Z is likely the largest contributor to that. But outside of that, defense 2.5% higher, metals a percent higher as well. We saw some texture of this already on the Nifty 50 index, and that heat map is very similar to the one reflecting here. What's not doing well is the Nifty IT and the auto index. You saw Hero and some auto stocks also contributing to those losses. But Neeraj, broader markets looking far better, as you can see on the screen.
And that's been the course for the start of the day, Harsh. In fact, when Ramesh Damani or Prashant Khemka, both of them said that they were surprised with the market behavior on open and which should have opened in the green. I mean, little did we know the kind of recovery that we see. But the small cap index in particular, so the trend has been good, as Harsh is pointing out. The small cap index in particular has been green from the start of trade, which is actually a really, really good sign. So that's part number one, the key takeaway for today. Let's move on. We're also, of course, seeing standalone refiners and upstream oil stocks moving higher, and we'll mark some of them. But I think this is one bucket that is doing very well for itself. So keep an eye out for some of those as well, the likes of Chennai Petro, etc. And from amongst the volume buzzers, typically you have a Vodafone, Suzlon and Yes Bank being right up there on the volumes front. Today, giving them stiff competition are stocks like Z, Ola Electric, unfortunately so, and BEL, which are trading with the highest volumes today. So keep them in mind. So these are the top movers today. Z 11%, KEI about 5.5%, BEML about 4.5%. So strong moves, and again the defense railway ecosystem doing well. Like we said, the standalone refiners 702 for Chennai Petro now, MRPL about 7.5% too. So that bucket of standalone refiners doing well. And I think the argument here is that with crude being 79.80, people will not park themselves in oil marketing companies, but go for standalone refiners. Then IT, these stocks are bucking the trend today. Harsh marked how IT is down in the red. These stocks are actually in the green, barely so, but not sulking, which is a good thing. And then specifically LT Foods 8% lower because of the CVD duty. They will contest it, but I mean, how far will they succeed? Never know. But 8% lower because of that. There is weakness in Ola Electric, and I think, Harsh, if I'm not wrong, this would be all-time lows for Ola Electric.
Very close, yes.
Very close or at all-time lows. So this is the other one to keep an eye out. And then the BIS rollout has been delayed, and as a result of which Astral in particular, which had run up quite a bit, is sulking. Some of the others are giving it company. Supreme is moved into the green, but not the best of news for these as well.
Okay, so that's how, or rather that's where we close our wrap. Let's bring in Akshay Bhagwat from JM Financial to talk to us about what he's seeing on charts. Good afternoon, Akshay. Let me first start off by taking your view with regard to how the Nifty, both the index itself as well as the Bank Nifty is moving according to you today, and what's the outlook like for the rest of the week?
Good afternoon. The positive take is that despite the geopolitical tensions, we opened gap down. But if you look at the market breadth, and as you rightly said at the beginning of the show, the small and the mid cap space is where the risk was at the beginning before the day started. But surprisingly, that space also is doing well since the opening bells. So clear-cut signs are that level-wise, if you would stick by to Nifty, 24,700 somewhere is emerging as a very strong short-term support for the coming week. And till this support is defended, there is a good chance that Nifty may attempt to retest the resistance zone of 25,200 and also try to take a breakout above those levels. If this time the breakout succeeds, then the market sets up for a momentum move, in which case you might have the markets heading for levels of 25,500 plus.
Okay. So therefore, Akshay, are you initiating any long positions on either the Nifty or the Nifty Bank at these levels?
Well, honestly, at this point, still, if you look at the broader range of the market since last 5 weeks, we have been confined in the range, the lower end of the band being 24,500, upper end of the band being 25,200. So as of now, since we are looking at a breakout about 25,200, if you are a more of a BTST kind of a trader with an intraday perspective, then 25,200 to 25,250. These are the immediate targets on cards. So for that, you can place yourself with a buy trade. Either you can buy in options for the current, the monthly expiry of the strike of 25,200. That's the best way to take a trade with a low risk and high reward scenario. And once we would revisit as to how the market behaves once it tests the key levels of 25,200. So the second tranche of the trade, we will take it once the Nifty shows an intent of breaking past 25,200.
What about your ideas for the afternoon, Akshay?
Yeah. So a couple of ideas both on the buy side of trade. The first recommendation is in Eternal or Zomato. Well, if you look at the price structure, the last 4 or 5 days, the stock has held out pretty strong on the technical charts at the levels of 250. You had strong volumes a few trading sessions back around 240 to 45 zone, which I believe is more of a buying volumes. And the way the position are set up on the technical charts, 275 is the target in the making, and you can have a stop loss of 243 on this trade. Second recommendation is in HAL, Hindustan Aeronautics, where clearly the defense names are getting back into the limelight. As we see, HAL is up by 1.5%. Clearly a range in the since last 1 odd month. 4,800 support has been defended well. Now it's time for a breakout above the levels of possibly 5,175, which I believe the stock should attempt. And I'm looking for targets of 5,375. Keep a stop loss of 4,800 as a risk measure on this trade.
Okay, Akshay, you've spoken about HAL. Any others within that defense pack that you seem to be liking? Because that's the one pack which is showing tremendous amounts of zinc. Even on a day like today, when we had a muted kind of a start, we still had the defense stocks doing very, very well. So what's your take? Any other picks within defense that you like?
Yes, most of the defense names are again getting back into the limelight. There was a time few days back, clearly, the month of May initially when the Indo-Pak escalation was at its peak, these names were doing very well. Then came a lull phase, and today again you are seeing a pickup in momentum in most of the names. So if you were to look at the mid-cap space, Cochin Shipyard and Mazgaon Dock again are showing a good intent of a bounce back. So these are more short-term trading bets. If you were to look at Cochin Shipyard, 2000 is a good strong support, and 2600 is possibly where the short-term upside can be targeted in this stock. Whereas for Mazgaon Dock, 3100 is a support base, and possibly the stock is heading for its swing high of around 3650 to 3800 zone.
Okay, and what's your take on IT, Akshay, and in particular Infosys, because top loser on the Nifty, but also top loser on the Nifty IT. Also, second part to that question, there are some stocks which are standing out, which Neeraj flagged off, something like a Coforge, something like a Persistent within the Nifty IT pack, but even outside of that, some IT play is looking half decent on a day like this. Your sense with regard to a couple of those plays?
For today, I believe there is some bit of the pain point in the IT names, primarily because of the Accenture results. It is having more of a side effect on most of the IT names. But if you were to look at the broader placement on the price charts, I think the mid-cap IT names or some other names which you just mentioned, those are the stocks you can look forward to. So specifically, since you asked about Infosys, Infosys right now is in a more of a neutral setup. 1650 is a very massive resistance if you're a short-term trader, and that level has to be overcome for some major gains. So right now 1550, 1650 is the range which we are expecting Infosys will be. So there is no trade building up as yet, but clearly stocks like a Coforge or a Persistent which you mentioned, these are better placed. With Coforge possibly might reattempt to get to 2000 or try to break out above those levels. There is a good strong support at 1750. And as far as Persistent Technology goes, a similar strong technical setup here where the stock can see a rebound from the current zone and possibly look to get past the levels of 6500, 6600 zone. But right now we are targeting 6500 with a stop loss below 5800. So Persistent and Coforge are the better placed stocks on the technical charts in the IT pack.
Okay. Now, Akshay, stay on. So much more to talk about. it's an interesting development that has happened. Amazon has launched its first ever home lab testing service in India. Let's first get in my colleague Varsha to tell us more about this and how could this impact some of the other diagnostic players, if at all. Varsha.
Well, thank you so much for that. So yes, Amazon has entered into diagnostic market. Now we all know diagnostic as an industry is growing into double digits. Now how this service will work is customer can now easily book lab test, schedule and track appointments and instantly access digital reports directly through Amazon app. They've also promised doorstep sample collection in under 60 minutes. Digital reports for routine test will be available in little as 6 hours. These services will initially be available in 6 major cities. You have Bangalore, Delhi, Gurgaon, Noida, Mumbai and Hyderabad, which will cover 450 pin codes. They are offering a selection of over 800 diagnostic tests, and then this new service called Amazon Diagnostics has been introduced in collaboration with Orange Health Labs. They're going to address key challenges. Also, they're going to build integrated healthcare, and the key differentiating features that they've highlighted is rapid sample collection, timely report delivery, and strict data privacy and quality standards, and real-time slot visibility, map-based address validation, and secure digital report access via the Amazon Health dashboard. Some of the stocks which are actually under pressure since morning on the back of this news, you have Dr. Lal Path Labs, you have Metropolis and Vijaya Diagnostics, and all the other diagnostic companies which are under pressure because of this news.
Varsha, just very quickly before we get in, the concerned spokesperson, 30 seconds. Is this materially different from what some of the others have tried in the past? 1mg or otherwise?
So Neeraj, the highlighting factor over here is because Amazon has that setup of delivery partners and the data that Amazon has. This is the highlighting factor with respect to Tata 1mg or the other online pharmacy which have evolved.
Got it. Okay, Varsha, in case you want to ask a question, stay on, but otherwise, thank you so much for joining in. Let's get in Mr. Jayarama Krishnan Balasubramanian. He's the director of the medical category at Amazon India, joins in right now on the show. Mr. Balasubramanian, thank you so much for joining in. What's prompted Amazon to do what it has done? And I mean, how is it that you make a difference versus what is already available? Mr. Balasubramanian, can you hear me? Okay, I don't think he can. But okay, is Varsha still there with us? Maybe not. Okay, never mind. The thing, Harsh, what I'm most interested in is that in the past, I remember when Tata 1mg launched those predatory pricing offers, right? And when we had spoken to the Metropolis and I believe Dr. Lal, two of the three incumbents, right, including Thyrocare, about what's the impact of this going to be. They had spoken about how the market is large for everybody to grow. Yep. They do not believe the pricing will correct, and they didn't believe that market share will go down. It has played out that far. Now the question out here is that will Amazon's launch eat into the lunch of the incumbents, or is the market wide enough for them to any which ways gain market share from the unorganized players? I think that's the key question.
And will Amazon in a big fashion disrupt the business model altogether? That will also be on the table, because whatever businesses Amazon has done, they have been disruptive. They have a record for disruption, and therefore would be very interesting to understand whether they are seeking to do that in this space. Mr. Balasubramanian, can you hear us? I'm Harsh here.
Hey, hi Harsh.
Hi.
I can hear you.
Hi. So talk to us about where this is going in terms of what's the rationale, what's the thought process, strategy, what are you planning, how are you going to differentiate?
Hey, thanks for having me in the show. Happy to kind of unveil Amazon Diagnostics as we speak. Amazon Diagnostics is a part of Amazon Medical. Amazon Medical is our healthcare offering, which has been serving customers medicines for the last 2 years. And end of last year, we launched our doctor consultation service called Amazon Clinic to complete the trifecta of healthcare, which is pharmacy, clinic, doctors, and diagnostics. We are launching diagnostics service in partnership with Orange Health, which will be live which is live in 450 plus pin codes across 6 cities. And we're super excited to get started on this. Yeah, looking forward to scaling these as we speak.
Okay. The question, Mr. Balasubramaniam, would be this, that is there a right to win for you in this category while there are incumbents there, or it is not a battle versus the 3 or 4 established players, but more like category expansion?
Thanks for asking this. Amazon is known for its customer centricity, trust, and reliability. And I don't think there is any other category as important for these services, these features as healthcare is. So we believe that it is a multi-decadal structural opportunity. There is a lot of opportunity to kind of make some of these services mainstream. And as Amazon is, we are a customer-centric company and we don't think too much about the competition. I feel like there is a lot of opportunity for many players to provide the right experience for the customers, and we are hoping we will be able to drive that, which is reliability, quality, speed, and seamless experience across all these services.
Mr. Balasubramaniam, how do you stand out in a market like this?
The intent is to stand out through our customer experience, and the whole intent is to kind of build healthcare as a longitudinal continuum. These are not siloed experiences which customers can operate. Of course, the customer has a choice of taking one experience versus the other. But the intent here is like, to put it in a simple anecdotal way, if a customer has a blood test in the morning, a fasting sugar kind of a test, and he or she kind of can talk to a doctor in the afternoon with the reports, and the medicines prescribed can be delivered to the customer the same evening. That is what I call connected healthcare. And there's a huge opportunity to build this service in a way healthcare is an intuitive, seamless, convenient experience for customers, and we'll be pushing the needle on that.
Okay. The other question is, are you, okay, I mean, I'm guessing you will be doing a lot more than as a package, if you will, right? Let's assume that way. My question to you is, stripped off all the other attachments, the basic testing which could be comparable across offerings, would Amazon pricing be a lot cheaper than what is there in the market currently, or would it be comparable?
Be comparable. We will be looking at differentiating ourselves on the quality of service, the reliability, and the trustworthiness which we can build with the customers. The pricing will be competitive.
But Mr. Balasubramaniam, I mean, I'm just thinking out loud, right? It's not that, at least across the pan-India players, the ones which exist, I would suspect there is not a trust issue that customers would have with them, at least the large incumbents, right?
I would agree with you. There is no trust issue, but the whole market is fragmented and seamlessly underpenetrated.
Okay.
Also are looking at a larger macro where customers are moving from the illness episodic way they look at healthcare to a wellness continual way, which is one of the reasons why we are thinking of it as a longitudinal continuum, where we build the experience in such a way that the customers don't feel they are taking 3 different services, but they're taking a healthcare service, which is a flywheel which comes around. Just looking at that.
It's interesting. And do you compete on price, sir?
No, price will be competitive with the market.
Understood. And so basically you are going to try to eat into existing market share just by offering a differentiated one-stop shop solution.
To an extent, yes, but we are not just thinking of eating into the existing market. We will also kind of create a market by making it available to millions and millions of customers. So and the intent here is to kind of make it so simple that customers find it very easy and intuitive to use Amazon for their healthcare necessities.
Sure. You're doing 6 cities currently, I hear.
Yes.
Is there a plan to grow? How quickly? And are there any goals in terms of how quickly you want to grow in this space?
See, for context, our pharmacy service and our clinic doctor experience is available across the country. You can get it from Andamans to Arunachals and across the country. This service also eventually has to operate across the country, but we are at the starting and we are building the customer experience as we speak. Diagnostic is a very interesting and unique customer experience. We'll have to first understand how to build it in a way which is very customer backwards. Our current focus is on going to do that. And once we have that in place, we will think of expansion.
Okay. I'm just one very basic question. How pilot is this at a stage in, or is it completely launched formally across the key markets that you want to launch?
It's not a pilot, it's a full-fledged launch. And our
across key markets?
across key markets. It's a complete launch for all the Amazon customers. They can walk into this place which we call the health intersection, where they can find all the three services: pharmacy, clinic, which is doctor consultation, and diagnostics, and they could use the services like right away. This is not a pilot, this is a full-fledged launch, because the entire play in healthcare has been 2-3 years old for Amazon, and we are continuing to build it.
Well, we wish you all the best for that and more. Thank you so much. And I hope it makes the life of the customer even more simpler. But thanks for taking the time out.
Thank you so much. Happy to be here.
All right. And guys, I just want to remark some of those stocks: Metropolis, Dr. Lal PathLabs, Thyrocare, because that's the listed universe. And if you heard the gentleman at Amazon speak about it as well, it's a highly fragmented market which deserves more penetration from the organized players. So in effect, there is a fourth organized player who's coming in with a bouquet of services, and therefore it might compel the others to try and do something if they are not doing that already. Part one. Part two, pricing is not going to be predatory. It is actually more and more comparable. So it's very highly probable that all of them might succeed together. But I can understand the market reaction. When Amazon is making a foray, you would want to be careful. But Harsh, the simple point is, and then I would want to get an Akshay's view on the stocks, but we've seen multiple other giants in India make similar forays as well. I think the market is wide enough for everybody to make hay while the sun is shining.
Yeah, that seems to be the case, basis past precedents, unless Amazon obviously comes up and really does something disruptive and new, which is how we described it. Also, this partnership with Orange Labs, I think, allows them a little bit of more bandwidth to place service rather than really get their hands dirty with regard to the testing part of the business. That the understanding seems to be that they want to remain a platform and not really venture into the service component of it, rather than so that's something different, unlike what a Tata 1mg did, etc. So that is one thing that kind of stands out. So again, not sure how this will play out, but yeah, you could well be right. Akshay, any view on any of these diagnostic counters? Some of them under pressure. Dr. Lal, let's pull that one up. That one is clearly under pressure today.
Yeah, so I was going through all the charts of the diagnostic space which was under discussion, and most of them are having a neutral setup if your time horizon is for the next 3 to 5 months. So specifically, since we're talking about Dr. Lal PathLabs, this stock is in a neutral setup. As said, there is a strong resistance zone at the point of 3,000, where multiple times we have seen selling intent getting back once it nears the zone of 3,000. Again, the chances are high if you're looking from a short-term perspective. 2,700 might be on cards, and even the stock may drift down till 2,500. So clearly, no trade is setting up as of now. If you're having this will take some more time to kind of settle in the range, and then it may see a direction. So for short to medium term, there is no trade setup, and it's better to avoid as it goes on the price charts at the current levels.
Okay, Akshay, quick view on Trent.
Yeah, so Trent, yes, it's a very positive setup. If you look at the last few days of trading action, there has been a breakout on the stock at the levels of 5,700. Strong volumes have been buzzing in this counter in the prior trades, massive volumes, and that just suggests that there is good buying intent in the stock at the current levels. In all probability, the chances are high. Short term, 6,500 is where the stock should head for, and positionally with a month, 1.5, 2 odd month, probably 7,000 can be the targets you can look forward to.
Okay, Akshay, thank you for those views. We'll let you go on that note. Also time to slip into a very short break, but before that break, let's hear out market veteran Ramesh Damani and expert Ajay Bagga's take on the markets post the escalation of the Iran-Israel conflict. Listen in.
Having a more optimistic view of financial markets, given what happened over the weekend, I think another way to look about this conflict between Israel, America, and Iran is to look at bark versus bite. And clearly, I think events as they've unfolded have proved that Israel and America have bark and bite, whereas Iran is only bark. So my sense is that it was a very monumental decision that President Trump made over the weekend. but it has completely changed the contours of the Middle East. And I think investors can look ahead to an area of peace, prosperity, FDI flows in the Middle East.
A really very tough environment for traders, good environment for investors, and best environment for SIP investors who have just disciplined in a disciplined manner kept investing. They are the real winners of this year. Everybody's forgotten July 9th Trump tariff deadlines. Everybody has forgotten the big beautiful tax bill which is meandering through the Senate, and this has taken precedence. Total GDP of Israel and Iran put together is 1% of the globe. If Iran's oil goes out of the global supply, the Saudis and UAE themselves have more than enough capacity to ramp up. But if you look at the Israel bombing, they have bombed the Iranian internal storage oil depots. They have not touched the Iranian export terminals. So the Israelis also have some kind of a tacit agreement with the Chinese, who get 15% of their oil unofficially from Iran, that they will not hurt Iranian exports.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down, cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience? The questions you care about, asked and answered. The big question.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
Welcome back to India Market Close. I am Puneet Zaveri, but let's get in my colleague Swamit Sarkar now, who joins us with all the chatter from the dealing rooms. Swamit, what are some of the key aspects in the stock that you find out today?
Well, firstly, it's the pure play refiners that have been buzzing in trade, that is Chennai Petro and MRPL. Now, dealers are indicating that smart investors are shifting their funds from oil marketing companies towards this pure play oil refiners. Now, one of the rationale behind this move is the fact that the rising GRM will benefit pure play oil refiners much more than the oil marketing companies, given the fact that they do not have any marketing exposure. So this higher crude oil prices, which could impact the marketing segment, will not in fact impact the pure play refiners like Chennai Petro and MRPL, and that's the reason why this move in funds that we are seeing towards pure play refiners from oil marketing companies. The second stock on the list is MCX. There are buy flows on institutional desks, which means that both FI and DI are accumulating this counter in trade today. Now, dealers are indicating that MCX as an exchange has witnessed strong volume numbers in the June ended quarter, which could result into strong financial numbers for MCX, and that's the reason this buy flows we are seeing. When it comes to Avenue Supermarts and Titan, dealers are indicating that large HNIs have been accumulating both these counters in trade today on anticipation of a strong Q1 FY26 update that could come in anytime in the next 15 to 20 days. So keep an eye out for Avenue Supermarts and Titan as well. And lastly, it's Polycab in trade, which has been buzzing. FI buy flows, strong FI buy flows is what dealers are indicating. The stock was up around 5% at one point of time. Now dealers are also indicating that the recent management commentaries that has come in of late show that the first quarter numbers could be very strong for the company, and that's one of the reasons why FIs have been accumulating this counter in trade today. Now apart from these stocks, couple of other stocks that I would want to highlight is Northern Arc and Aventil. Now both these stocks were part of the Herd on Street segment last week, and both the stocks are buzzing in trade. Northern Arc is up around 8% now. At one point of time it was up around 11%, while Aventil was a buy that large HNIs were accumulating given the fact that they were expecting a large order win to come in, and that stock is also buzzing in trade. It's up around 6%.
Well, thanks for that, Somit. But let me get in Hemen Kapadia of DR Choksi as well. Hemen, a very good afternoon to you, and thanks so much for joining in. Let me just start off with some of the stocks that Somit also highlighted. One of them was definitely the OMC stocks and the refiners. We're seeing that play that Somit had highlighted. Refiners are getting that traction again from oil marketing companies on the back of what's happening with Israel as well as Iran. How do you view some of these key stocks? Do you think there's more legs to room because of the volatility that we're currently in?
Hi, very good afternoon. Thank you for having me on the show. I think yes, because whether you look at PCL, you look at HPCL, I think all of them seem poised for a further upside. Having said that, they spent almost 7 weeks moving sideways. This is BPCL. BPCL has done nothing. No directional bias, 7 weeks in a sideways movement, but it seemed like it's taking a breather in an up move. So I believe further upside could be on the cards. Similar with HPCL, but BPCL does look a shade better on technical parameters. And the last one is IOC. 150 is a big resistance, but the setup does not reflect weakness. Yes, they've had a run up. So we are seeing a time and price retracement. So I believe they're in consolidation phases. But needless to say, the recent highs need to get taken out for a further upside. But that is on the anvil, maybe in the end of the month, probably next month.
Right. Okay. So that's with regards to these counters. Hemen, hi. Good afternoon to you. Mahima also joining in. Yesterday when we were speaking to experts as to how markets will react tomorrow on the back of the development of Iran and Israel conflict, a lot of analysts and market voices came out and said that buy the dips. But I think that dips has not taken place for sure today. Both the Nifty as well as the Bank Nifty have bounced back from its day's lows. What are the kind of indicators that you are seeing on the charts, and how do you think the next 10-15 odd days will pan out, considering everything that's happening around the globe?
Hi Mahima. Very good afternoon. We spent 7 weeks hatching eggs, so to speak. Hatching eggs in the sense between 24,492 on the downside and 25,212 on the upside. Mahima, 7 weeks. This is the 7th week now. So frankly speaking, nothing has happened. And there is no directional bias, but yes, the undercurrent remains solid. Like you said, there aren't any dips to buy. One comes, okay, having said that, 4 times we've come close to 24,500 over the last 7 weeks, Mahima. And 3-4 times we've come close to the 25,200 mark. So we remain safely ensconced in this range. I believe 25,200 seems to be in the offing, in the sense we could be taking that out, but till we don't take that out, I think after so many weeks we'll have to wait for that, I won't say formality, but that event to go through. The VIX is at 14, Mahima, so frankly speaking that is also a fillip for the bulls, because we are up to 16 and 17 a week or two back, and we've come off from there. So we are set, but the range still remains. If you want to tighten the range, Mahima, it's 24,792 and 25,212. The bigger range, the actual range, which I believe is 24,492 and 25,212. So 700 point range, 7th week, Mahima.
And what about the Bank Nifty?
Okay, Bank Nifty has flattered to DC, so to speak. Gave a breakout above 56,000, posted a fresh all-time high, fizzled out, went below this range and is now consolidating. But I would be more bullish than bearish. The longer term charts seems sanguine to positive. If you look at the biggies, if you look at ICICI Bank, despite overbought, doesn't want to come down. Kotak is looking good after 4 years of doing nothing. You have Axis Bank looking good. HDFC Bank also, frankly speaking, hasn't done significantly much over the last 4.5 years. So all the three guys, I think they have a significant weightage. ICICI and HDFC and maybe Kotak would have probably more than 50% of the Bank Nifty weightage. So they are looking good. So frankly speaking, above 56,500, I believe the Bank Nifty would start moving. So it remains, I believe, in a consolidation phase within a bigger uptrend. So having said that, it looks better than the Bank Nifty because better than the Nifty because Nifty high is 1,000 points away, and Bank Nifty has just posted a fresh all-time high.
So definitely it's in a consolidation phase as well as has more legs backed by the large cap ones. Heyman, what are your top picks for today?
Okay, yeah, a couple of stocks. I mean, there's after Friday move, frankly speaking, there are a whole bunch of stocks looking good. But yeah, a couple of stocks which I'd like to point out. The first one is Jubilant FoodWorks. We've been moving sideways for around 9 trading sessions. We're going to sustain above the 55-day exponential moving average today. Above 700, things should start looking better. A breakout is on the anvil. The oscillators are supporting the move completely. So one can buy Jubilant FoodWorks at around 695. Stop loss of 675, target of 735. It's a modest target. I think we could head higher. The next one is Voltas. It's taken its own sweet time to consolidate. We've taken around 8 to 9 weeks, and now we are beginning to look up. At least right now, the action positivity is restricted to the daily charts, but even the weekly seem to be in a mood to catch up. Buy on Voltas at 1295, stop loss 1275. Target of 1335. Prolonged consolidation phase. I believe we could be looking at a couple of months of an upside from here.
All right, so Jubilant FoodWorks and Voltas are Heyman's pick for the day. Now it's time for the element of stock of the day on this edition of India Market Close, and today's stock of the day is Northern Arc, and Puneet and I were discussing. Let's in fact pull up the stock and see. There you go. It's up 7.8% as we speak, and it has maintained its gain throughout the day, off from its day's highs, of course, but it's maintained its momentum since it's touched its day's high. Now, basically the entire news around this particular counter is that Madhusudan Kela has bought around 0.6% stake at 208.8 apiece, and of course the company is an NBFC, and 36% of loans from this company go to MSME, and 48% are retail loans. In terms of the overall asset quality growth, it's not been a very impressive growth per se. I mean, if you look at the gross NPA, it's improved from 0.74% to around 0.93%, but the net NPA has gone from 0.39 to around 0.36%. Even in terms of growth, although AUM growth has seen a CAGR of around 24%, but in terms of profitability as well as valuations, Puneet, what are you seeing in terms of where Northern Arc stands?
Well, definitely, it's not being one of those banks which have done very well in terms of financial performance, and that's largely led by the uncertain environment that we've seen in the spaces that Northern Arc operates. Now, it is largely, a very recent listing actually, but it's largely present in the Northeast, and that's where we've seen some pocket of pressures in the MSMEs as well as the MFI space, and we see, companies like Northern Arc being bearing the brunt essentially of that. We've seen profitability also, just the ROA is actually just stabilized around 2.4%, but that's the lowest level that it has been in the last 3 years. Specifically, we've seen valuations also almost at 1.1 time price to book, but it's been not cheap in any sense because of the asset quality issues. So we have seen the preference of market participants towards others, NBFCs and MFI stocks, as well as the other small finance bank stocks as well, because we've seen some positive pivot coming there as well. But that's on Northern Arc, because finally seeing some positive traction coming in from big HNI investors as well as big investors like Madhusudan Kela. There's not too much analyst coverage also on the stock, so we will have to see on that aspect. But largely a stock that's down from its listing levels. If we can pull up the 1-year chart as well, See, the 263 was the issue price, down 14% from those levels as well. While it is off the lows of about 140 rupees per share, so it has gained momentum from there. But definitely a stock that's not done very well for its retail investors. But let me actually pose this question to Siddharth Khemka of Motilal Oswal Financial Services as well. Siddharth, a very good afternoon to you, and thanks so much for joining in. Any specific view that you have on Northern Arc, because we've seen that kind of consolidation phase and off the lows, but in terms of performance, any specific view that you have on Northern Arc or any of your top picks from that space?
Yeah, hi, good afternoon, Sudhit. Thanks for having me on the show. I think Northern Arc, we don't have coverage, but definitely if you see last few months, what essentially RBI has done is it has loosened up a lot of its regulations around NBFCs as well as banks in an effort to push liquidity and reduce the cost of funds for the entire system. So I think that is a big positive. Apart from banks, NBFCs in the lending space, for example, L&T Finance is something that we like in the mid-cap space. Poonawalla FinCorp is another name in the mid-cap NBFC space that we like. And even today morning, the news about the small finance bank, RBI, lowering the priority sector lending norms requirements from 75% to 60%. So AU Small Finance Bank is something that has been one of our top picks for a very long time. We believe its diversified book will benefit the most among the small finance bank. And given its high growth potential, we believe that could be one stock which should be in focus.
Okay, so that's with regards to where these banking names stands. Now, let's shift focus and take a look at top 3 stocks on our radar today. Anushi joins us with more details on Bajaj Projects, BEL as well as Zentech and why they are buzzing in trade today. Anushi, what are you picking up?
So with Bajaj Projects, where that is concerned now, they are in focus on the back of an order win. They've received an order for ultra mega power transmission order, and this is at the size of 400 crore that we are looking at. This is to build a new transmission line of 138 kilometer. This is at Rewa substation that we are seeing ought to be executed in next 29 months. And if you look at the market cap, that's roughly 2,300 crore. It's a fairly big size of an order that we are seeing for Bajaj Projects. Next stock in focus is something like Bharat Electronics. Now over here, if you look at, the company has received additional orders worth about 585 crores, and this is for fire control and sighting system for missiles, along with that spares and services as well. Now do note that the company has stated that in its guidance for FY26 that it expects a 15% of a revenue growth margins should be in the upward trajectory of 27% plus or so. While for order inflows, now this is the main focal point where it's expected that the order inflows would cross 50,000 crore, while this is with the expectation of the QRSAM order coming in, which is roughly the size of 30,000 crore. So that's BEL in focus. And last one on the radar is Zentech. Now here they have acquired a majority stake in Tisa Aerospace, which specializes in Indian developed loitering munitions as well as UAVs, that's drones. Again, the company wants to expand its presence in the space that we are looking at, that's drone technology. It already has a strong presence in anti-drone systems. So Zentech in focus on the back of this news as well.
Well, thanks for that, Anushi, but stay with us because another company, Idea Forge, is actually in focus as well, and they've received a new order of almost 137 crore. Stock is locked up now up in upper circuit. What are some of the key salient features of this new order?
Well, it's a big order that we are seeing for Idea Forge Tech as well. Now, they have received order worth about 137 crore, and this is to supply mini UAVs, that's drones, with accessories to Defence Ministry, delivery timeline being 1 year. Now, why this is an interesting development? Because if you look at the performance in FY25, they had seen a substantial slowdown in the broader drone industry overall in FY25, but of course, in fact, even the order book, if you look at that, was 13.6 crore as of March 25. So, considering FY25 and taking FY26 in context, after Operation Sindoor also focus on drones have increased. So it's a big order win that we are looking for Idea Forge, and that's where the stock is in focus.
Okay, thank you so much for breaking that down for us, Anushi. Heyman, I'll come to you. A lot of these defense counters have been buzzing on the back of the entire global uncertainty taking place. But do you think that any of these counters still have some steam left? And if yes, and if an investor wants to make an entry in any of these defense counter right now, let's say from a 1 year perspective, where do charts look attractive?
Well, Mahima, you guys are talking about Idea Forge. I believe there is some more headroom left over there. because it's been a protracted decline, Mahima, almost from 1350 levels to 300. So it's virtually fallen off a cliff. Okay, there's not too much of data to go on because it's a relatively new listing, but whatever data we have seems to suggest that yes, there is some more headroom. Yes, we've had a very fast move. So probably closer to 680, 700, we take a breather, but there is some headroom left. And besides that, I also believe that Cochin Shipyard, from a defense point of view, looks quite nice. GRSE is leading the move, so it's a different kettle of fish that way, but it's heading the market. Cochin is something which can play catch up, Mahima. So my pick would be Cochin. Hindustan Aeronautics HAL also looks nice, very structured, but it would be Cochin and HAL in that order. And if you want to be the first of the blocks, it's GRSE.
Got that, Heyman. Siddharth, I've heard you being very positive on the defense space, but we have seen some sharp bull run in a lot of those stocks, Idea Forge also being one of them. Any specific view that you have on Idea Forge as well? Because as Anushi was highlighting, revenue almost halved in FY25, but the order of 137 crores almost in line with what was the FY25 revenue as well, about 160 crores. So any specific view on Idea Forge as well as what are some of the key picks in defense for you?
Sure, Sumit. So yes, we have been positive on defense for quite some time, and the latest geopolitical flare-up, I think that only supports in terms of not only sentiments, but the defense spending across would go up. We saw after Operation Sindoor, Indian government took a special off-budget increase in defense spending by almost 50,000 crores. So that those things were definitely helpful. Last year, we saw some of the defense companies, the order book execution towards the end improving. So Q3 was a slow quarter, sluggish quarter. But Q4, again, we saw sharp improvement in execution as well as new order inflows. Idea Forge, we don't have a coverage, but Zen Technologies, which is into similar business where we have a coverage, we saw strong execution in Q4, plus the order inflows that have sharply moved up. Definitely at the current price or valuations level, some of these stocks have seen a sharp run up. So margin of safety would be if they to enter only at some corrections. But nonetheless, my top pick at the current levels would be Bharat Electronics, consistently delivering earnings growth. May not see much of a fall because of the large order book, because of the size and the diversified business segments that they have. And in terms of valuation also currently, we believe given the growth opportunity, it looks good. And one pick at current levels from our coverage universe, we have a positive view on Bharat Electronics, HAL and Zen Technologies in the overall defense space would be Bharat Electronics from an investment perspective.
Right. So Siddharth is picking Bharat Electronics in the entire defense pack. Puneet and I were also discussing earlier that I think the key two things to watch out in the next few years for these defense pack would be how they execute their entire order book, and of course valuation still remains a concern in the entire pack. But now moving on to our bull versus bear segment, today's stock in focus is Z Entertainment, which aims to break even at a 548 EBITDA loss, which in fact incurred a 548 EBITDA loss in FY25 to see a EBITDA level break even in FY26. And my colleague Hiral is here to present a bull versus bear on that counter. Hiral, what are you picking up?
It's an ambitious plan, Mahima, that Z Entertainment has put out, and I think that's what the street is cheering right now at the day's highest levels is where the stock is trading at. But let's quickly consider what are the few scenarios you should be looking at in terms of our bull versus bear. Firstly, the first commentary that has come in is they're looking to break even in Z5 after posting a 548 crore EBITDA loss in FY25. Now, break even is what they're looking at in terms of FY26. And what they have said is that all their energies will be diverted towards this. And that is the bull case what investors should look at. But execution remains a key. In case they falter in terms of execution, that will be a major negative with regards to their ambitious plans. Moving on the other aspect that we have is they've said they are expecting to surpass the highest EPS in 3 years. Now that number was sitting at around, in FY19, and if they are able to surpass that kind of a number, it's more than doubling FY25, because FY25 is somewhere in that range of 7 to 7.5 rupees. The EPS volatility that we've seen in the last 5 to 7 years is going to be a major challenge, because the future target over the next 3 years is seeming to be absolutely aggressive. So this is what you should be looking at. Commentary from the management is a bull case. Execution over here again becomes key. Going ahead, they've laid out growth plans including inorganic expansion. What the company has said is they have changed the business strategy with regards to short content versus long format. And secondly, they will look at expansion in the form of strategic partnerships or even acquisitions. And that is what they've been alluding to in terms of the bull case. Whereas there could be hurdles in the inorganic growth picture if they're not able to really identify assets that they can take over as well, or partnerships that they can do in the long run, because right now there is no plan that they've laid down for the investors in terms of what would they be watching out for. So that's the overall picture. And very lastly, what they've said is they're proposing issues reflect strong promoter confidence, and this we are talking about the convertible debentures that they have said. Clearly they are sitting on a cash of around 2,400 odd crores so far already. They've said they are trying to make the balance sheet pretty strong, and the money will be used towards expansion. However, the warrant-linked dilution remains a key concern, because the board meeting with the shareholders, I would say it's a shareholder meeting which is slated on the 10th of July to get an approval. So that is going to be the deciding factor as well with regards to the warrant-linked dilution. And if it gets approved, the promoter stake will be in that range of 18 to 18.5%. So that's what you're watching out for in terms of Zee Entertainment so far. But what is interesting is the strategy that they've laid down. They've said their energies will be towards execution and EBITDA positive in terms of Z5, and an EPS target which is probably achieving the highest that they did in FY19 in the next 3 years is being really aggressive, and that's what the stock is reacting to.
Absolutely. Thank you so much, Hira, for putting that into perspective. And I think execution will remain the key here as well. Siddharth, I was just looking at the analyst rating for this particular counter, and I saw that in terms of how Bloomberg ratings span, there are 11 buys, 4 holds and 5 sells so far. But the upside potential hardly is 1%. But in terms of, if you see the past 1 year for Zee as a whole, it's been a bumpy ride for sure. Do you think FY26 should shine for them, or do you think that the kind of up move that the stock is seen today on the back of the guidance given by the management could die down?
So I think definitely FY26 will be a year of strong points for Zee Entertainment. A lot of things are falling into place. The confidence that the management has shown by infusing more money in the business and increasing its stake, I think that is a big positive. Overall, what the management is targeting is a revenue CAGR of 8 to 10% in the current portfolio, improve EBITDA margins to an industry leading of 18 to 20% in FY26 itself. I think that's something which is big positive. Plus, the only concern that is there is in terms of execution, as we just heard, and also there has to be a sustainable recovery in the ad revenues. That is key to achieving both revenue as well as the margins, and that will also could lead to potential re-rating. I think apart from that, all the other factors are falling in place. Stock has definitely run up, but with the delivery in terms of what they have guided for, I think that will lead to analysts consistently upgrading their estimates and leading to re-rating in the stock. For now, we have a neutral rating, and we, again, as I said, we will continue to monitor the stock on a quarterly basis in terms of execution and delivery. But I believe that this could be a year where the company starts delivering and starts getting re-rated by the street.
Got that, Siddharth. Hemen, coming to you as well, because we've seen a very sharp recovery in the stock price of Zee from roughly about the low of 90 rupees or somewhat in those levels at the start of March actually. In the last 3 months, we've seen a very sharp recovery. Do you think that this rally has more legs on the charts?
Yes, I think so. Because we've seen 7 years of a decline as far as Zee is concerned. We peaked somewhere at 600 plus in around March in 2018, and that's 7 years hence. Things are now beginning to look up. Yes, I agree with you. We've had a pretty sharp run up, but this promises to be a bigger turnaround because the long-term charts are supporting this move. We're running into a strong resistance area around 160, 170, but I believe the worst is over. And not only the medium, the longer-term charts inspire confidence. So yes, I'd say we are looking at a technical revival on Z after ages, so to speak.
Got that, Hemant. But let's take a very quick break. Hemant, as well as Stas, stay on with us. We'll get you the top buy and top sell tomorrow picks as well from both the gentlemen. Stay tuned to NDTV Profit. We'll be right back.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories that we have been supplying to our defense forces.
Welcome back. You're watching India Market Close here at NDTV Profit. Now, let's shift focus and talk about the IT space. A series of top brokerages, including Morgan Stanley, Goldman Sachs, and Nomura, have released their views on the Indian IT sector following Accenture's latest earnings. We have Jasmeet joining in to tell us more on that. Jasmeet, what are you picking up?
Well, right, Accenture numbers are out and they beat the estimate, while we can see that the revenue is up by 8%, but the new bookings have declined by 6% odd. Let's understand more about it and how this will impact Indian IT sector. While we have brokerages here, what MK says is the earning downgrade cycle is probably bottoming out, while there's no further deterioration in the demand environment. The pecking order which they are having is Infosys, TCS and HCL Tech, while Morgan Stanley sees no major negative impact or surprise for Indian IT. Demand environment has remained relatively resilient, while Goldman Sachs says visibility on improved is limited, forecasting a 6.1% revenue growth for FY27 estimates, while for the September 2025 estimates, they are estimating a forecast of 0.54% revenue growth, where Nomura mentions demand in financial services hold strong, Gen AI opportunity continues to mature gradually, while they prefer Infosys and Coforge. While what this means overall is the demand environment has not worsened compared to the last time, but the pickup in discretionary spending is still low. It will be interesting to watch out how this would turn out for the Indian IT sector while their results are coming up in the following month.
Thanks for that, Jasmeet. But keeping up with the IT space, we caught up with ace investor Mahesh Tandurkar to explore Jefferies' current market bets and whether IT stocks make it to the buy list. Listen in.
IT, we are not feeling that constructive. So it's a sector that we have been, underweight on. And I think, given where the stocks have moved up very quickly in the last, 1 month or so, towards the higher end. In fact, almost like 1 standard deviation higher than their historical averages. And clearly, the economic outlook in the US is not really very conducive in terms of the discretionary capex for the large US corporations to be rising at this point in time. In fact, one of the large companies that just reported results over the weekend, the numbers were actually, not that great, and they've ended up cutting the guidance as well. So my sense is that given the combination of pretty richly valued, P multiples, and combined with that, the fact that the outlook from the US corporations increasing their discretionary capex doesn't look that great, we would be underweight on IT services.
All right, underweight on IT. And in fact, even Sandeep Agrawal the other day said that he's almost sold 80% of his IT holdings. So that, will your views also echo with what these people are saying? Are you also underweight on the IT space?
So definitely, I think while the numbers or guidance from Accenture, they have upgraded the lower end of the guidance. I think the overall commentary and bookings that remains weak, and commentaries from Indian companies have also suggest that things are yet to pick up in terms of growth. Overall, we remain very selective in IT. Aggregate performance in Q4 has not been that great, although better than expectation. So may not see a big fall, but gradually from here, what we prefer within the large cap Tech Mahindra, HCL Tech. We see Tech Mahindra driven by early signs of transformation under the new leadership, as well as improvement in execution. Overall margins expectation are now reasonable. Within the mid-cap space or the tier 2, we like Persistent and Coforge, very strong executable order book, plus strong growth that we are seeing. For Persistent, there is a strong product engineering background, and that remains one of the fastest growing IT company within our coverage universe, which is also positioned to benefit from the growth in the Gen AI investments that the company has done. So remain selective, overall underweight on IT stocks that we like: Tech Mahindra, HCL Tech in the large cap, Coforge and Persistent in the mid cap space.
Got that, Siddharth. Siddharth, we leave it at that. Thanks so much for joining in, giving us the whole host of views on all these stocks. But Hemen, let me come to you also on first on a question on IT, because we've seen stocks like Persistent as well as Coforge being largely be consensus buys. How are you currently viewing the IT space on the chart? Is this something specific? Because we've seen a sentiment move essentially over the last month, not backed by too much of fundamentals. So anything on the chart that still has legs to go?
Persistent seems some of the better looking stocks on the IT back. But I think Bsoft is something which hasn't done much. If you look, it's been lagging for some time. So I would prefer to go for the underdog. Ideally, we're at around 421 now. We need a close up of 440. So I say keep an eye on this above 440. It can surprise. So nothing much to lose. It's had a significant decline. We're in a base formation. So yes, I think Persistent is fine, but Persistent and Coforge both have had brilliant run-up. So I would go for Birlasoft, and it's going out of the F&O segment soon. So hopefully the volatility will die down and we see the stock behaving slightly more better.
Got that. And I think on Birlasoft as well, we saw that brokerage note from Macquarie, a big downgrade there, not seeing too much gains in terms of on-site as well as off-site share transformation. So that stock took a knock in that time frame as well. But a stock that's doing very well in trade today is Interact Building Products. Now they're now called Interact Building Solutions. So stock has actually gotten a new order win of 80 crores from Aether Energy, which is another listed peer. And this is largely for pre-engineered steel building system. The tenure is roughly about 9 months to deliver this particular order, and it's a new segment, the heavy engineering space for the company, and that's providing an impetus of growth for Interact as well, because they did enter into a structure business agreement with Jindal Steel, and we saw the company's order inflow from these heavy structures get into its current order book as well. So they did win about a 300 crore order win from a tire maker in Gujarat in the month of April, and this was another one. So while the heavy structure plant is coming on stream, they started executing some of the key orders already as well. So what's interesting is the company's order book as of April 30th of this year was roughly about 1600 odd crores, and this order book has to be executed within the year because the clients demand that kind of schedule. And the company's revenue for last year, FY25, was almost 1435 crores. So they will need some further capacity additions to take on more orders, which the company is actually expected to do as well. Let's take this and pose a question to Sameer Darar as well of Natwaral and Sons Stockbrokers. Sameer, a very good afternoon to you, and thanks so much for joining in today. I'm not sure if you have any coverage on Interact or any view specifically, because from roughly about 900 odd issue price, the stock's done really well for its investors. Any view or specifically on this company?
So first of all, thank you for having me on your show. And unfortunately, I do not have any view on this company, so sorry.
But do you have any specific, on the pre-engineering space, we've seen that kind of, move from a lot of companies there in terms of cost, execution as well. And while Interact does not have a direct competitor, any kind of specifics that you have in terms of, the building product space as a whole, do you see that kind of picking up going forward as well?
So if the capex cycle continues, then obviously we will see a continuation of the order inflows. And we believe that India is actually well poised to see a continued capex cycle. Look, so it's going to start with consumption first. What we're going to see is some of these tax benefits, and we've discussed this with you all. We're going to see these tax benefits that the government has given, the lowering of interest rates, all leading to consumption cycles seeing a revival. And as that happens, you're going to see more people putting in more capex over a period of time. So we are of the opinion that, look, India is poised for a decent amount of growth over the next 2 years. It's going to take a bit of time to start, maybe another 3 months before you start seeing it in the numbers. And then, people will start factoring in all of these things. So capex cycle will continue and these companies will do well, but I have no view on what Interact building does. So, to comment on something else in that space also, or anybody in that, will be a little difficult for me to do.
Okay, another counter in focus is LT Foods today. Let's pull up the counter and see. There you go. A significant amount of pressure, although it's off from its day's lows. And this is after the company gave out the clarification, but still down around 6.5% as we speak. So what's happened basically is that US has imposed a 340.7% countervailing duty on companies' arm, that is EcoPure organic soybean meal exports. Just for viewers' perspective, this kind of countervailing duty is generally imposed when a certain amount of information has been asked by the Department of Commerce and that has not been provided in time, or the information provided is inadequate. Now, on the back of this, we saw that the stock tanked nearly 11% in trade today, and EcoPure, of course, did say that they're currently evaluating all kind of legal possible remedies on cards, but they came out today and clarified, saying that the amount of impact of this could be up to 50 odd crores, and that will not overall have any kind of overhang on their cash flow as well as P&L statement. So this is the entire reason as to why LT Foods is moving, and the other possible reason could also be because of the development of Strait of Hormuz. If that particular area of trade is shut for operations, LT Foods as well as KRBL and Chamanlal Setia could also get impacted, because these are major rice exporters that export rice from India. So a lot of moving parts here. Sameer, I'll come to you first on LT Foods, if at all you have a view on this one, and your view on your entire take on how these exporters could be impacted on the back of this development.
Yeah, so LT Foods, what you're talking of, obviously, even though the management says that it has 50 crore impact, I still think there is an impact that's going to happen on the P&L, because at the end of the day, the entire operating leverage comes under some amount of pressure. We are hopeful that they'll be able to resolve this issue quite swiftly. It can get resolved within the next 1 month also. And if that happens, things could normalize and business could go on as usual. Now, when it comes to the second part of the question of what happens if the Strait of Hormuz faces a problem, in the sense that ships are not able to move through quite easily, then obviously it hurts all exporters who are exporting to that region. So I know Iran does import rice from India I'm not sure what the percentage of exposure of LT Foods is to Iran and Saudi Arabia, but I'm sure they'll be able to find alternative routes in the meantime for essential products like food, whether it be through some land route from the Middle East, I mean, from Dubai or some other way. So, I mean, I'm sure there will be something that'll give, but yes, costs could go up and that could hurt profitability in the near term. Also, it could lead to some amount of delays, which could lead to certain cash flow issues, not cash flow issues, but cash coming in per se. So that could be a negative in the near term, but I don't think it's going to be that big of an issue for a company like LT Foods or KRBI because they have other markets that they export to, and they can obviously push through more goods in those regions and figure their way out from that.
And just to give viewers that perspective, LT Foods 11% of their exports happen to Middle East, as well as 41% to North America and 14% to Europe. Hemant, quickly your view on these rice exporters. Any of these rice exporters looking attractive on the charts right now?
LT Foods is looking tired. It's heavy. It's overbought. It doesn't look very good. Yeah, 480 to 390 in a few trading sessions. Dead cat bounce possible, but the longer term charts seem to be under pressure. So I'd stay away from LT Foods. As far as the other stock you mentioned, Chamanlal Setia, it looks similar, but once again, not looking. I mean, there aren't any technical reasons why I would want to buy the stock.
Okay, so that's the view with regards to where charts are concerned for these rice exporters. Now, former HPCL CMD M.K. Surana said that oil marketing companies are facing a squeeze in margins due to LPG losses. He expects crude prices to hover between $75 to $80 per barrel. That is as long as the Strait of Hormuz remains open for ships. Listen to what he had to say.
As far as the crude prices are concerned, we are slightly in an uncertain territory right now. It depends on how Iran reacts to the situation which has developed on Sunday. And the two possibilities we should concern is one, closure of Strait of Hormuz. Second thing, if Iran retaliates with some action against the other oil producing assets or storage assets. While generally it is believed that the possibility of both should be lower, in spite of the fact that yesterday Iran Parliament has approved a closure of Hormuz, but subject to their Supreme Leader's assent. But I'm sure that US would have considered this scenario before taking the action which they have taken. Now, in the current scenario, the crude oil, which is running right now at $78 or so, I think, as I mentioned earlier also once on your channel, that till $80, I don't think that there is likely to be any change in the prices. And if it goes above $80 only, there is some thinking maybe there on that issue. And of course, the reduction of the excise duty remains as a tool with the government. As far as oil companies are concerned, if the market prices are not adjusted to the international prices, it will have an hit on their margins, especially the marketing margins. But in past few months, the marketing margins were good, so they will have a little bit of leeway to play with that temporarily, not on a long basis.
Well, that was the outlook on crude, but let's quickly pull up Polycab as well, because stocks really flying in trade today, up almost 4%. And my colleague Swami did highlight that he's seeing some buying in terms from FIIs as well, stock almost up 5% now. I just want to pose that question to Samir as well. Samir, because we've seen brokerages come out with positive views on Polycab. We had one from Jefferies today saying that its market share has gone up by 1% again in the organized space, now commands almost 1/4 of the organized space as well. And we've seen the stock actually recover from multiple jolts. One was of Ultratech coming into the cables and wire space, and we saw that reaction on that stock as well. IT raid a couple of years ago. How are you viewing Polycab specifically, and do you have any picks within the cables and wire space? Any top picks, and if it is Polycab one of them?
So obviously, Polycab is probably one of the best companies in the space to own, right? It's the largest player in size of market share and all of that. You have RR Cable, you have a couple other companies that are there. But you've got to remember there are there's one big overhang. And we've seen this in the past when some big, large competitors come in. In the paint industry, we saw when Grasim entered, what kind of negative impact it had on the space and on stocks in particular. And now Polycab's valuations are not cheap in any which way either. They're quite rich. So when you have two large players entering, you have Adani who's going to be entering into the buyer space, and then you have the Ultratech, the Grasim group again, the Aditya Birla group entering into this space. It's obviously going to put some amount of pressure when it comes to margins or growth or both. Now, in a situation like that, when you don't have the pricing power, and at the end of the day, it is a bit of a commoditized product. You can have a brand name of Polycab, but at the end of the day, the guy who's going to be doing it is going to look at cost at some point, and if the product is the same, delivering the same result, it's going to put some amount of pressure on growth. So for me, because the valuations are high and because we know of these two entrants coming in, the re-rating possibility on the upside is limited. Yes, growth will be there. They will get some amount of growth from increase in organized market share. But it'll be very muted growth once the competition increases. So I'm in no rush to go out and buy the stock. I think whenever you hear more news on operationalization of certain plants, maybe in the next 6 months to a year, you'll get an opportunity to buy these stocks again at lower prices. So why invest in that? Let's find something which has more of a structural bull market kind of situation, which could be around something like the renewable energy space or the power space or the electric vehicle space. I think there's more of a growth opportunity there, and I'd rather put my money there than put it in a Polycab, even though it's the best company in the space.
Got the view, Sameer. Hemen, do you concur with the view? Because again, very sharp reaction on something like Polycab, but post Q4 results, we saw very sharp reaction on RR Kabil as well. Do you have any particular view in the wires and cable space and anything that on the chart suggests a positive up move continuing from here as well?
Yes, Puneet. Yeah, I think so. As far as Polycab is concerned, 6,200 was a level which had been a point of resistance. Okay, it's the beginning of the week. It's a weekly level, so we need these levels closing above this level at the end of the week. But having said that, 7 weeks, there's a 7th week now. It's finally moving out from here. It's breaking out. So yes, I believe Polycab further upside seems like a distinct possibility. As far as RR Cable is concerned, we are in a time price consolidation, 850 to 1450. So we are digesting the rise of the time price retracement, but it's a correction within an up move. So as long as it doesn't close below 1250, things remain hunky-dory. Above 1450, we are going to 1550 and maybe 1600. So, and as far as Polycab is concerned, we're probably moving towards 6700 or so. So both looking good, but I believe Polycab is already off the block. So this is more of a 1-2 month point of view. Further upside seems possible.
Shifting focus now, Biocon is set to raise over 4,000 crore through a QIP and its first equity raise since 2004 IPO. We spoke with Siddharth Mittal, the company's MD and CEO, to learn how the funds will be primarily used and discuss about Biocon's global expansion plans. Listen to what he had to say.
We have a bank debt of $1.2 billion and we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
All right. just a quick correction there. It is 4,500 worth of 4,500 crores worth of QIP that the company is raising. Heyman, quickly on the charts, how is Biocon faring?
Looks good. Setup is fine. Hasn't done much, but I would be more positive than negative.
Heyman would be more positive than negative. And Heyman, that brings us to the point of the day where you give us, buy today, sell tomorrow calls, or vice versa. What are you picking up?
BTST, buy today, sell tomorrow. So I have a buy call on BOI, Bank of India, at 114, stop loss 112, target 118.
Okay, so that's the pick that Heyman has given today. Samir, I'll come to you on some counters that are buzzing in volumes today. I'm just seeing Vodafone Idea pick up. There's Ratan India Power. There's Vishal Megamart. But I think one thing that's standing out for me is Vishal Megamart. Certainly, we've seen the counter buzzing in trade for quite some time now, and it's the value retailers. In fact, we spoke to V2 Retail's management as well today. That have exceedingly done well in FY25. Your view on how FY26 will fare for these retailers, because we've seen Vedant Fashion, ABFRL, Arvind Fashions not doing well versus that of something like a Vishal Megamart or Bazaar Style or V2 Retail. So what's your take on that?
Yeah, so I think there's going to be that similar kind of continuation where you're going to see the mass market continuing to do well, because we believe the revival there will be quite good. We've gone through a few years of pain for that space, and now we are coming out of it. And at the end of the day, the bottom of the pyramid really needs to start performing if we believe that the trickle-through effect is going to continue to happen. Plus, we've also gone through this period where you've seen, the microfinance industry is having a slowdown, which has impacted some of the consumption in the very lower end. So what I believe is all of this will start coming back. And as that keeps happening, you'll see companies like Vishal Megamart, Trent, V2 Retails, and all of these guys continuing to see a good uptick. And I also believe that this discretionary spending will also start seeing an uptick going forward. So I believe the entire consumption basket, and I've said this to you all, quite a few times, I believe the consumption basket is where one needs to start investing in, be it on the lower end, be it on the discretionary. I think that is going to see a re-rating going forward. Right now, the valuations for all of them look very expensive because of the kind of slowdown that was there, or kind of low growth that was there. But the SSSGs, once they start picking up, the operating leverages for these companies start picking up. And once that happens, what you'll see is a massive uptick in the earnings, and the valuations will stop looking as expensive. So this is a space that I am focused on, I am invested in. Of course, I don't have an investment in Vishal Megamart, but some of the other counters in the space we do have in QSR, in retail. Vedant Fashion is one of the companies that you mentioned. We do have exposure. We think that will do well going forward. So that we believe is a great opportunity to invest in.
Samir, just a follow-up there. You mentioned Vedant Fashion as a company, and in terms of the growth has been largely absent, right, over the last few quarters, despite a very strong wedding season last year. I think only Q3 is when they did well. But some concerns, what's happening in Telangana also, because they have a really high exposure there. It's something that, tricking analysts as well. What's your view with the positivity on the stock? Some of the key aspects that you like in Vedant Fashions?
So like I told you, what I like about them is the kind of business model that they've built. Okay, so let's work on the business model first. So you're basically not setting up a lot of stores yourself. You're working on a franchising model, right? The minute you start doing that, your operating costs start coming down, and as the franchisees' demand starts picking up, your profits per piece keep increasing. And we believe that because we've gone through this lull kind of a period, we've not been able to see that operating leverage. Yes, there may be certain issues in one or two states here and there, small issues, but at the end of the day, they are a consumption product. And once we see the consumption story start picking up, and yes, you're right, wedding season was good last year, but the weddings is something that's going to keep happening year on year. There's not going to be like a lull or a slowdown or anything. These are seasonal businesses, yes, but every year you're going to see that increase, and you're going to see once people have more disposable income, their demand for these kind of products will increase. So my take on this is, we've seen a slowdown. We've seen the margin, the PE multiples look expensive, and growth not happening, but the expansion of the retail business happening. And as the growth comes in, then you will see the stock starting to perform. So my take is simply that the consumption growth will drive operating margins, which was going to make valuations look attractive. And then when something is attractive and growth is good, obviously the re-rating in the valuation multiples start happening again.
Heyman, on the charts, anything on Vedant Fashion as well as something like a trend also, as you can comment, because post Investor Day, it's a very strong number that the company is looking at, a 25% growth, a constant growth essentially over the next few years. Anything on the charts among the retail pack, and I think Mahima also mentioned a few of them, V2 retail, V-Mart retail. Anything on those that look attractive to you?
Trend is in a correction within a bigger bull market, highly volatile, but yeah, our 60-200 thing should look better. But yeah, if I take a longer term point of view, it's going to take times because it's been a humongous multi-bagger. It would take a decent amount of time for this whole move to get digested. As far as Vedant Fashion is concerned, it's in a base formation. 700 to 850 is in the range. Downside appears limited. I'd say medium term bottom is in place. The longer term charts are beginning to look just a shade better, but as of now, the positivity is restricted to the medium term chart. So I would say it looks good. Nothing much to lose. As far as Vishal Megamart, relatively new listing, not too much of data, good above 134, but can't value add much. It's been just a few months.
Okay, so that's with regards to where these retailers are concerned. Heyman, quickly, anything that you're finding on the charts of VIP Industries? Again, one particular stock that has been standing out since the past 1 week. I mean, the volumes also are high, even in terms of the stock performance. It's been on an uptrend. What are the charts indicating, and do you think there's more steam left there as well?
I think so. 3 years of a decline, Mahima, deep decline. Even if you were to say that it's a bounce back, there is a lot of room for a bounce back, considering the fact that we've gone from 760 to 250. It's become 1/3. 450 is a major resistance, but I believe we could be heading towards 520 and 540. This is not a very short-term call. It's going to take a few months because this 450 level is going to be a source of significant resistance. So yeah, probably by the end of the year. So having said that, further upside seems like a possibility.
And Samir, you spoke about the consumption basket very well. I just wanted to, cap off that discussion as well, because I think I wanted to get a view on Trent as well, because analysts, post the analyst day, the stock's not done too much. But how did you view some of the key highlights coming in from the analyst day of Trent, and what's your view on the stock?
So unfortunately, I haven't gone through the details of some of the analysts or the other analysts have written on Trent. I can tell you what my views are on Trent. So I believe, like I said, growth is still there. The Zudio side, they're continuing to grow. They are expanding their West Side stores as well. Now you have Utsa, which is a standalone brand also, which they want to increase, but at the moment it's been going slow. And then they have the shoes and the makeup business, which is also starting to see some traction. The problem is all of these will lead to great operating efficiencies. And like I said, SSSG, because all of this is happening in the similar stores, right? So the makeup, the shoes all come into the West Side stores, into the Zudio stores and the like. And as this SSSG goes up, you will see profits going up.
Right.
But valuations have moved up far ahead. And I think the stock needs to go through a bit of consolidation time-wise before you see an uptick.
Right. Got it. Thank you so much for that, Samir and Heyman. Thank you so much for taking out the time and giving us all those insights throughout the show. All right, it's time to close the markets now. Let's pull up the Nifty as well as the Bank Nifty and see at what levels are we closing. Well, it's just whiskers away from that 25,000 mark for the Nifty 50, and it doesn't seem like it'll touch that 25,000 mark today for sure. The Bank Nifty as well is down by about 0.4%. The Nifty 50 down by about 0.6%. Let's pull up the advanced decline ratio. That is going to be an interesting thing to watch out for, certainly in trade today. There you go. It's been narrowing throughout the day. It's almost even Stevens there, 1,000 odd advances versus 1,200 odd declines. But let's also pull up the Nifty 50 heat map and see how stocks have been faring today. Trend up 3.4%. So I think it's the consumption and the defense pack that's playing well. Defense and the defensives both doing well. Something like Hindalco, Tata Consumer, Bajaj Finance, Coal India, as well as Adani Enterprises up in trade today, but some counters are not doing well. It's majorly the IT counters. Infosys down by about 2.3%, HCL down by about 2.3% as well. L&T, Hero MotoCorp, M&M, as well as HUL and TCS seeing that pressure in trade today. So some FMCG names here also facing pressure. Let's also pull up the sectoral heat map and see how sectors have fared during the day today. There you go. Nifty Media, top gainer on the back of Z Entertainment, up by almost 9%, followed by Defense up by about 2%. Consumer Durables up 0.7%. But something that's not doing well, of course, Nifty IT, followed by Nifty Auto down by about 0.9%. Nifty FMCG down by about 0.7%, and overall Nifty Infra also not doing very well in trade today. But Puneet, how are the broader markets looking like?
The Nifty Auto was an interesting one because we saw some reports coming at the fag end that Hero might be replaced out of the Nifty, and we could see that kind of impact basis on that. So I think that's definitely one of them. We also might see something like an IndusInd Bank also see losses on and removal from the Nifty as well coming out there, and that will be one of the key levels to watch out for as well. So stocks not doing too much today, but largely been a down trick since the discrepancies started for the accounting as well. Let's also look at the mid cap and the small cap, how they did today, because we've largely seen a broader market recovery, essentially, if we can say, compared to the benchmarks, up 0.4% and very close to the highs as well. For the small cap 250 as well, we ended almost at the day's high today at 17,058. A very strong day compared to what we've seen on the benchmarks, Mahima, as well. Absolutely. And finally, in terms of BSE 500 as well, because that's been another one where we've seen a lot of stocks. We've discussed Z Entertainment, Supreme Petrochem was the one we saw a leg up over the last couple of hours of trading. The other one's Whirlpool as well, because it's seen a very good trading day, while KEI Industries is the other one, and we spoke about the positive momentum largely seen on the cables and wire makers. We discussed Polycab, but KEI was also one of the key winners. On the loser side, Astral was one of the negative ones, and that's largely because we've seen the BIS implementation being deferred to December, which was largely expected to help the organized players come in. We've seen that impact on Astral today. Something like Siemens also is down almost 4%, but overall, it's been a very good trading sessions for the broader market compared to the benchmarks, and that kind of momentum. Hopefully, we can continue tomorrow as well, both on the Nifty as well as the Bank Nifty.
Right. And quickly, what to watch out for tomorrow? Let's pull up that. There is US manufacturing and services PMI data that will come post market hours today. Something to watch out for certainly. Companies that are going to have their interim dividend, ex-dividend date is Alkyl Amines for 10 rupees, Vedanta as well as Polycab India. One of the reasons why it's trading higher today. There is also anchor lock-in expiry for Muthoot Microfinance for almost 20%. So certainly a stock to keep an eye on. And of course, with that, we're completely out of time on this edition of India Market Close. Hopefully, the Nifty opens with 25,000 plus tomorrow. With that, we'll leave you at that, but do stay tuned to NDTV Profit for more news and updates on the other side.
Source is an ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Hello and welcome. Good afternoon. You're watching Market Express and I'm your host Malika Mishra. Let's get straight into the show. GAIL India has announced a major investment of 844 crore rupees to boost its capacity. The company plans to add nearly 2.5 million metric standard cubic meters per day to its output. Additionally, the Srikakulam pipeline project is on track for completion by December 2025. Markets closed in the red with the Nifty 50 closing below the 25,800 levels. Meanwhile, the Sensex declined 500 points. Infosys, L&T, Hero MotoCorp, M&M, HCL Technologies were the top losers from within the Nifty 50 pack. Sectorally, auto and IT were the top laggards. FMCG and bank were also on the back foot. Meanwhile, media and defense were in the green. Oil prices jumped to their highest since January as the United States' weakened move to join Israel in attacking Iran's nuclear facilities stoked supply concerns. Iran is OPEC's third largest crude producer. Market participants expect further price gains amid mounting fears of an Iranian retaliation. Goldman Sachs flagged risks to global energy supply amid concerns over a potential disruption in the Strait of Hormuz that would lead to significant spikes in oil and natural gas prices. The bank said in a note dated Sunday, the bank estimated Brent crude could briefly peak at $110 per barrel if oil flows through the critical waterway were halved for a month and remained down by 10% for the following 11 months. Zee Entertainment was abuzz in trade with gains of over 9% after the company shared its growth roadmap for FY26. The company in its investor presentation said it plans to achieve break-even in ZEE5 from EBITDA losses of 548 crores. The company also wants to double down on the execution of its business plans and maximize its risk-free treasury income. The Indian IT sector is in the red after Accenture's Q3 results painted a cautious picture. MK notes client spending remains subdued amid macro uncertainties, with Nifty IT underperforming broader markets by 16.6% over 6 months, though it gained 4.6% recently. Analysts see no further demand deterioration, with hopes pinned on US interest rate cuts. Morgan Stanley and Goldman Sachs view Accenture's results as neutral to slightly positive, highlighting resilience in financial services but a lack of discretionary spending revival. Nuvama remains optimistic long-term, citing Accenture's solid growth and raised FY25 guidance. Top picks include Infosys, TCS and Coforge, but rich valuations and muted earnings limit upside. Mahesh Nandurkar, head of research at Jefferies India, remains unenthusiastic about the IT sector, citing persistent FII outflows and global macro pressures. While the sector has shown resilience, Jefferies believes valuations remain stretched and near-term triggers are lacking. For now, IT stocks don't make it to their buy list, as the firm prefers sectors with clearer earnings visibility and stronger domestic tailwinds. Nathan Ark, a lesser-known NBFC, is gaining attention after investor Madhu Kela bought a stake, sending the stock higher. With most loans to MSMEs and retail borrowers, it's quietly building a strong growth story. Despite no analyst coverage, its clean asset book and consistent returns make it a dark horse in the financial space. GAIL India has announced a major investment of 844 crore rupees to boost its capacity. The company plans to add nearly 2.5 million metric standard cubic meters per day to its output. Also, the company announced in an exchange filing that the Srikakulam pipeline project is on track for completion by December of 2025. Pradeep Kumar Das, CMD of IRDA, tells NDTV Profit that no provisioning is being made yet under the RBI's draft project financing guidelines. He points out that while the norms propose higher provisioning up to 5% during the construction phase, they remain under review and are not yet in effect. Das expresses optimism, calling the guidelines a disciplinary mechanism that enhances the perception and quality of project finance in the long run. Biocon raises 4,500 crore through a qualified institutional placement at a floor price of 340 rupees per share. CEO Siddharth Mittal says the funds help repay equity investors while total debt holds steady at $1.2 billion. Plans for the Biocon Biologics listing remain active, signaling the company's forward momentum in biosimilars and global expansion. Akash Agarwal, whole-time director at B2 Retail, outlines a steady financial outlook with cash flow and EBITDA expected to hold firm. The company is targeting 90 inventory days and plans to scale up its presence by opening 100 new stores in FY26. E-commerce will serve as a key distribution channel complementing its expanding offline footprint. In a bold move shaking up India's diagnostics market, Amazon launches its first ever at-home lab testing service, Amazon Diagnostics. Partnering with Orange Health Labs, the service is now live across 6 major cities covering 450 plus PIN codes. Customers can book tests, track appointments, and access digital reports via the Amazon app. The Bureau of Indian Standards has postponed the implementation of quality norms of PVC pipes to December 2025, a setback for organized players like Astral and Supreme Industries. While BIS certification would have helped weed out substandard competition, the delay prolongs market disruption. Compounding the challenge is the absence of anti-dumping duties, with cheap, low-quality PVC, especially from China, flooding the market. Cement companies are getting up for another price hike, with key players planning to increase rates by 10 to 15 rupees per bag across India effective July 2025. Industry experts note that the success of this proposed hike hinges on market absorption, as rising costs for raw materials like petcoke and limestone royalties drive the move. However, regional demand variations and growing competition from new capacities may impact its sustainability. The south has shown price stability, while north and east regions have seen sharper gains. Bharat Electronics Limited, or BEL, has secured new orders worth 585 crore for advanced defense systems. These include missile fire control and sighting systems, along with communication equipment, jammers, and related services. This latest order adds to BEL's strong performance, with the company reporting a robust revenue of 23,769 crore in FY25 and an impressive profit margin of 29%. BEL continues to strengthen its India's defense capabilities with cutting-edge technology and reliable solutions. Bajaj Projects has won a significant ultra-mega power transmission order worth 400 crore. The project involves constructing a 138-kilometer, 400 kV new transmission line, along with substation bay extension works at the Reva substation. With a project tenure of 29 months, this order marks a major boost for Bajaj Projects, reinforcing its position in the power infrastructure sector. Interdat Building Products has secured an 80 crore order from Ether Energy for the design and erection of pre-engineered steel building systems. The project is slated for completion within 9 months, showcasing Interdat's expertise in delivering timely and quality infrastructure solutions. In FY25, the company reported a revenue of 1,454 crore with a healthy profit margin of 9%, reflecting strong operational performance. The U.S. Department of Commerce has slapped a massive 340.7% countervailing duty on organic soybean meal exports from EcoPure Specialties, a subsidiary of LT Foods. This steep tariff follows the U.S. applying an adverse facts available methodology typically used when required information isn't provided, severely impacting EcoPure's access to the crucial U.S. market. LT Foods is currently evaluating all legal options to challenge this decision, which could have significant consequences for its export business and margins. HG Infra Engineering has received a letter of intent from PFC Consulting to establish an interstate transmission system as part of the Eastern Region Generation Scheme 1 in Odisha. This project, awarded through a competitive bidding process, will be executed under a build, own, operate and transfer model with a completion deadline in March 2028 and a 35-year operation period. This marks a significant diversification for HG Infra, expanding its footprint into power transmission and strengthening its position in India's infrastructure sector. NLC India subsidiary NLC India Renewables has won a letter of award from Tamil Nadu Green Energy Corporation to develop 3 standalone battery energy storage system projects with a combined capacity of 250 megawatt and 500 megawatt hertz. This marks NLC's first large-scale BESS project designed to support on-demand power usage with 2 full charging and discharging cycles daily. The projects will be implemented under a build, own, operate model with viability gap funding, strengthening Tamil Nadu's renewable energy infrastructure and grid stability. Hindustan Aeronautics, or also called HAL, has won a 511 crore contract to manufacture small satellite launch vehicles developed by ISRO, marking its first foray into the space launch sector. Under a 2-year technology transfer agreement, ISRO will handhold HAL to build and launch 2 SSLVs, after which HAL will independently own, build, market and operate these launch vehicles. This strategic move positions HAL to tap into the growing global demand for small satellite launches and marks a significant milestone in India's commercial space ambitions. Walmart-backed fintech giant PhonePe is gearing up to file draft papers by August for a $1.5 billion IPO, valuing the firm at nearly $15 billion. The company, a leader in India's UPI ecosystem, boasts over 610 million users and processes more than 330 million daily transactions. Investment banks like JP Morgan, Kotak Mahindra and Morgan Stanley are advising on the listing. If successful, this could be one of India's largest fintech IPOs to date. A sharp rise in crude oil prices driven by Iran-Israel tensions is set to disrupt the fragile recovery of India's FMCG sector. Companies are bracing for higher packaging and freight costs, key inputs heavily reliant on crude derivatives. With packaging forming up to 20% and freight up to 30% of production costs, firms warn of price hikes on essentials like soaps, snacks and paints. While early signs of demand revival had emerged, weak urban consumption may force some players to absorb cost-squeezing margins. India's stainless steel utensil makers are sounding the alarm over the upcoming quality control order that mandates BIS certification. In a letter to Commerce Minister Piyush Goyal, the All India Stainless Steel Industries Association warned that without urgent relief, the move could trigger major production halts, job losses and supply chain disruptions. They've urged the government to extend QCO deadlines for micro and small units, citing a shortage of BIS certified raw materials, unresolved and technical issues and long delays in the licensing process. Indian exporters are grappling with a 30 to 40% surge in freight costs as escalating Iran-Israel tensions force a shift away from the Red Sea route. With missile threats and naval risks rising, shipments are now rerouted via the Cape of Good Hope, adding nearly 20 days to delivery schedules. The disruption affects nearly 30% of India's exports to Europe, North Africa, straining supply chains and squeezing margins. Exporters in engineering, textiles and chemicals are among the hardest hit. Indo-Gulf Crop Sciences is launching its 200 crore IPO from June 26 to 30th with a price band of 105 to 111 rupees per share. The offering includes a 160 crore fresh issue and a 40 crore offer for sale. The company, known for manufacturing crop protection products, plant nutrients and biologicals, aims to use the proceeds for working capital, debt repayment and capex. At the upper price band, the market cap is estimated at 701.5 crore rupees. The primary markets are up for a booming week with 17 IPOs, 6 from the main board and 11 SME offerings, getting up to raise over 15,800 crore rupees in total. Leading the charge is HDB Financial Services with a massive 12,500 crore issue. Other notable listings include Kalpataru, Elenbari, Industrial Gases and Sambhav Steel Tubes. The surge reflects heightened investor appetite and strong pipeline activity across sectors, signaling robust market momentum. Tata Capital's $2 billion IPO is moving closer to launch, with the market regulator SEBI likely approving its confidential draft papers, according to sources cited by NDTV Profit. The non-banking financial company is now expected to file updated offer documents publicly in line with SEBI's regulations. The IPO will include a fresh issue of 23 crore equity shares, along with an offer for sale by select existing shareholders. India will grow faster than G7 economies in 2025, says an Equirus report. Strong rural demand, up 6%, and 17.4% growth in government spending drive the surge. A 2.5 lakh crore rupees liquidity boost supports the economy. India's GDP share is higher than Japan's, and Germany is making it the fourth largest economy globally. Manufacturing growth and smart policies fuel the rise. India's expected 6.8% growth rate in 2025 beats the G7's 1.3% average. The report advises investors to focus on strategic investments to benefit from India's strength, even as global markets face uncertainty. India's solid fundamentals position it as a top performer. Counting for the 2025 Assembly by-polls in 5 constituencies across 4 states concluded today. Congress-led UDF's Aryadan Shokat won Kerala's Nilambur seat by 11,077 votes, defeating CPI M. Swaraj. In Gujarat, AAP's Gopal Italia clinched Visavadar by over 15,000 votes, while BJP's Rajendra Chavra secured Kadi. AAP's Sanjeev Arora led in Punjab's Ludhiana West, and Trinamool Congress's Alifa Ahmed won West Bengal's Kaliganj. By-polls held June 19th were triggered by resignations and deaths of sitting MLAs. Nilambur saw the highest voter turnout at 73.26%, while Ludhiana West recorded the lowest at 51.33%. Results reflected shifting political dynamics. An Air India Express flight IX-195 heading to Dubai had to return to the taxiway at Jaipur Airport early morning. The plane was scheduled to depart at around 6:05 a.m. IST, Indian Standard Time. The aircraft had already boarded all passengers and was moving towards the runway when pilots discovered a technical issue. The pilots then turned the aircraft back to the parking bay as a precautionary measure. A public interest litigation has been filed in the Supreme Court seeking the immediate suspension of Air India's Boeing aircraft fleet until a comprehensive security audit is completed. The PIL also seeks directives to the Centre, Air India, DGCA and BCAS for the effective enforcement of mandatory regulatory rules for international commercial flights. An Indigo flight 6E6332 bound for Bhubaneswar from Indore with 140 passengers on board was delayed by an hour after its pilots detected a minor technical snag. The issue arose as the aircraft was taxiing towards the runway for takeoff. Following the detection of the snag, the plane was brought back to the apron. Engineers quickly addressed and rectified the issue without requiring passengers to deboard. The monsoon is making rapid advancements, with the IMD forecasting its arrival in Chandigarh, Uttar Pradesh and Himachal Pradesh within the next 2 days. The weather system is also expected to sweep into Rajasthan, Punjab, Haryana and Delhi over the same period. Furthermore, central, east and northeast India are all set to experience very heavy rain over the next 7 days. Flash floods from a river have devastated Odisha's Balasore district, affecting over 50,000 people. Heavy rainfall in Jharkhand and water release from Chandil Dam submerged 61 villages across Baliapal, Bhograi, Basta and Jaleshwar blocks. Now 1 person died and another is missing. Roads and farmlands are underwater, with Bhograi block hit hardest. The district administration deployed ODRAF teams distributing water, ORS and halogen tablets, but residents report delayed relief. Balasore MP Pratap Sarangi called Jharkhand's water release a criminal misconduct. Water levels are receding, but recovery may take days, with farmers facing heavy crop losses. A deadly overnight assault by Russian forces on Kyiv has left at least 5 civilians dead and several others injured. The attack, which struck resident areas, caused a section of a high-rise apartment building to collapse, sparking fire and trapping people under debris. Emergency crews are still conducting rescue operations. The strike marks another escalation in Russia's ongoing campaign, with Ukrainian officials calling it a massive and deliberate targeting of civilian zones. A deadly shooting and suicide bombing struck St. Elias Church in Damascus on June 22nd, killing at least 22 and injuring 63 during a packed service. Authorities blamed the Islamic State for the attack, the first of its kind in the capital since the fall of Bashar al-Assad. The assailant opened fire before detonating an explosive belt, leaving the church in ruins. The international community has condemned the act, urging Syria's new leadership to ensure the safety of minorities amid ongoing instability. The International Atomic Energy Agency confirms no radiation leaks at Iran's Fordo, Natanz and Isfahan nuclear sites after US airstrikes on June 21, 2025. Rafael Grossi says field surveys show no contamination, ensuring safety for nearby residents. The agency offers to mediate between Iran and the US to de-escalate tensions following the strikes, which targeted Iran's nuclear program. Iran's parliament considers suspending IAEA cooperation, while the US urges diplomacy. The strikes, part of Operation Midnight Hammer, aimed to curb Iran's nuclear ambitions but risk further conflict. Global leaders call for peace as oil prices rise, threatening market stability. In a thrilling climax to the NBA Finals, the Oklahoma City Thunder have claimed their first ever championship, defeating the Indiana Pacers in a heart-stopping Game 7. The Thunder's clutch performance sealed the title on the road, marking a historic moment for Oklahoma City and their passionate fans. They win the series by 4-3. Jasprit Bumrah etches his name in cricket history, equaling Kapil Dev's record for the most 5-wicket hauls by an Indian in away tests during the thrilling Leeds Test against England. With a stunning spell of only giving 83 runs and taking 5 wickets, Bumrah also surpassed Wasim Akram to become the first Asian bowler to claim 150 wickets in Sena countries. Manchester City thrashed Al Ain 6-0 to advance to the Club World Cup knockout stage, with Juventus from Group G. Ilkay Gundogan scored twice, while Claudio and Erling struck before halftime. Substitutes Oscar Bob and Ryan Cherky completed the rout in the closing stages. City will face Juventus next in Orlando to decide the group winner, showcasing their dominance in the tournament's expanded format. And with that, it's a wrap on Market Express, but do stay tuned to NDTV Profit as we continue to give you a lot more news and updates.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Nifty and Sensex end lower over 0.5%, bouncing back from the day's lows. Nifty IT was the day's worst performing sector. Meanwhile, broader markets outshined the benchmarks. Mid-cap and small-cap indices rose for the second day straight. Brent crude oil prices rise nearly 2% to $78.53 a barrel as the US and Israel attack Iran's nuclear facilities. Indian exporters face a sharp spike in logistics cost, with freight rates rising by 30 to 40% as they abandon the Red Sea route in the wake of escalating tensions between Iran and Israel. Amazon officially launches Amazon Diagnostics, its inaugural at-home lab testing service in India, marking its first ever global foray into the diagnostics sector. And it's a busy IPO week ahead as 6 main board and 11 SME IPOs worth combined 15,800 crore are set to hit the market. The highlight is HDB Financial Services launching a 12,500 crore IPO, the largest in 2025 so far. An Air India passenger files a PIL in Supreme Court seeking suspension of the company's Boeing aircraft until the security audit is over, calls for effective enforcement of mandatory regulatory rules and regulations compulsory for flying commercial planes on international routes. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it and have a look at how the markets fared today. Markets ended the session with marginal cuts showing resilience amid rising geopolitical tensions in the Middle East. Benchmark indices came off their intraday highs in the final hour of trade and the Nifty closed above the 24,900 mark while the Sensex held above 81,000. Sectoral performance was negative, barring media, defense and metal. All other indices ended in the red. Nifty IT, Auto and FMCG were the day's top laggards. My colleague Anushi now joining with the detailed market roundup.
Interesting day of trade that we are looking at now in terms of where the Nifty and Sensex are. They closed more than 0.5% lower. This is after recovering 150 points from the low levels that we are looking at, and despite all the geopolitical tensions that we saw escalating over the weekend. Now, in fact, 15 out of the 50 stocks did gain in Nifty. However, Infosys and HCL Tech were the top losers in Nifty and Nifty IT, again bearing that brunt of the Accenture earnings that we are looking at, and Nifty IT fell the most, becoming the worst performing sector for the day. In terms of the broader markets, they definitely outperformed the benchmark indices. In fact, Nifty Midcap 150 and Small Cap 250 have gained for a second day in a row. MRPL and Poonawalla Fincorp are the top gainers in Nifty Midcap 150. Meanwhile, Z Entertainment and Chennai Petro Corp are the top gainers in the Nifty Small Cap 250. In terms of where the sectoral action was concerned, Nifty Media, Metal, Oil and Gas, Pharma gained for a second day in a row, while Nifty Auto snapped a 3-day gaining streak. So this is the overall picture that we are looking for the indices today.
Thanks, Anushi, for that. And meanwhile, Biocon has raised 4,500 crore through qualified institutional placement, its first equity fundraise since 2004, by issuing shares at 330 rupees each to institutional investors. The funds will be primarily used to repay private equity investors in its subsidiary Biocon Biologics, including buying back debentures from Goldman Sachs funds, as well as to retire other outstanding debt and support general corporate needs. CEO
CEO Siddharth Mittal said the capital will strengthen Biocon's balance sheet, lower interest costs and fuel innovation and global expansion in affordable biopharmaceuticals.
We have a bank debt of $1.2 billion. And we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
And amid ongoing economic uncertainties and changing consumer behavior, Ashish Dikshit, Managing Director of Aditya Birla Fashion and Retail Limited, acknowledged that the past couple of years have been challenging for the retail sector, but noted the industry has weathered similar cycles before. He pointed to shifting consumer trends, but expressed confidence that brands will recover and growth will return soon.
Couple of years have been relatively difficult for most of the premium brand segments, but we have seen this cycle before. These brands have withstood consumers sort of shifting consumer dynamics, competitive landscape over a very long period of time. So I have no doubt that over a period of time, as consumers resettle to the new reality, the brands will also find the right level and you will see the growth coming back very quickly.
Now, Amazon India has ventured into the diagnostics sector with the launch of Amazon Diagnostics, an at-home lab test booking service. Partnering with Orange Health Labs, the service is now available in major cities including Bengaluru, Delhi, Mumbai and Hyderabad. The announcement triggered notable movements in diagnostic stocks during today's trading session. Let's turn to my colleague Varsha for more details.
The highlighting factor over here is because Amazon has that setup of delivery partners and the data that Amazon has. This is the highlighting factor with respect to Tata 1mg or the other online pharmacy which have evolved.
And we have Tarun Bhamra, co-founder Orange Health Labs, joining us today. Tarun, welcome to NDTV Profit and thanks so much for your time and congratulations on this partnership. Tell us, how does this exclusive partnership with Amazon impact Orange Health Labs' independent brand identity and direct consumer and customer acquisition strategy moving forward?
Well, thank you so much for having me over, Sanjana. Absolutely. I think there was a lot of, we have spent a lot of time in the last 4 years in Orange Health Labs focusing on making a very consumer-centric experience. Today, we are the fastest online on-demand diagnostic lab in the country, and we are also the highest rated and reviewed lab as well. So I think Amazon found a lot of common ground with us in terms of consumer centricity to partner with us and take us on their platform. For us, I think this is going to be a massive boost in terms of our reach and distribution across these cities because we share the same consumer base. And I think it's going to be a very meaningful upgrade for Orange Health's ability to distribute its services to patients across the country.
And Amazon's entry is being seen as disruptive. How do you anticipate this partnership will reshape the competitive landscape for Orange Health vis-a-vis other standalone diagnostic chains or even hospital-based labs?
Yeah, absolutely. I think there is, since COVID has been a one-way revolving door in terms of people moving away from at-center testing to at-home diagnostic testing. I think the biggest challenge in 2021 when this change happened was that there was nobody who was being able to come to you fast enough to do testing real time. At-home testing was essentially for wellness packages, which was done later in the week or maybe booked next day. Orange Health was the first company that was able to create, I think, arguably India's fastest logistic network for blood sample movement, which allowed us to deliver, get samples in 60 minutes and process results in 6 hours. That started the journey for moving at-home testing from just 5% of the market to 15% of the market today. With the might of distribution of Amazon and their brand name, we believe that the market soon will move from 15% to even as much as 50% in 10 years' time. And that is going to be a fundamental change, for the industry, because all the incumbents right now are designed for ad center testing. They are not capable of giving on-demand, real-time, fast logistics for delivering results.
Okay, and will this partnership then lead to a re-evaluation of Orange Health Labs' own pricing strategy in markets where Amazon Diagnostics operates, or is the pricing primarily dictated by Amazon?
No, in fact, Amazon is maintaining the prices that Orange Health does. Orange Health is not a discounted player, and healthcare is not a market where consumer is looking for discounts. In any case, India's diagnostic market is among the cheapest in the world. So I don't think there is much scope for reducing prices without compromising quality. I think consumers want high quality, reliable results, and are already suspicious of highly discounted pricing strategies with regards to healthcare. So I don't think consumers are looking for downward pricing, and neither is Amazon. Our partnership is contingent on delivering extremely fast, responsive and reliable service, and that's what we will be delivering. I think their primary reason for choosing us, because there were many players in the industry they could have partnered with for lower pricing, they chose Orange Health, which is not a discounted player, primarily for the fact that our reviews and our reliability is the highest in the market.
Arun Bhamra, thanks so much for speaking with NDTV Profit. This is, remember, as Amazon now launches its first ever at-home lab testing service in India with partnership with Orange Health Labs. Thanks so much for that. Let's move on to our top focus this evening. Following US airstrikes on 3 Iranian nuclear facilities, including a massive 30,000-pound bunker buster attack on the fortified Fordo site, global tensions have sharply escalated, with Iran vowing retaliation against what is now the largest Western military action targeting Iran since the 1979 revolution. The strikes, coordinated with Israel, mark a significant deepening of US involvement in the ongoing Israel-Iran conflict, which has already seen over a week of missile and drone exchanges between the two regional rivals. Meanwhile, airlines worldwide are scrambling to decide how long to suspend Middle East flights as conflict escalates following Israel's strikes on Iran that began June 13th. Major routes have been chalked off, with global carriers cancelling flights to key hubs like Dubai and Doha, reflecting mounting safety concerns. For over 10 days, airspace from Iran and Iraq to the Mediterranean has been largely deserted, forcing airlines to reroute flights north over Caspian Sea or south via Egypt and Saudi Arabia, adding fuel and crew costs as cancellations mount. Now, with oil prices rising after the US strikes, airlines are now facing the added threat of surging jet fuel costs. And it seems to be that even Indian exporters are grappling with the sharp rise in freight costs as escalating tensions in West Asia force them to avoid the volatile Red Sea route. Pankaj Chadda, chairman of the Engineering Exports Promotion Council, discussed the impact exclusively with NDTV Profit. For the key takeaways from that conversation, let's go over to my colleague Rishabh.
Right, what we've learned from conversations that we've had with exporters is the fact that Red Sea, the trade routes through Red Sea are now closed. That is not something that Indian exporters are preferring at this point in time. What we're seeing is that now shipments are being rerouted through the Cape of Good Hope trade route, that is via the African route instead of going through the Mediterranean. That means that exporters now face an additional 20 days of voyage for all of these shipments that are bound to either Europe or the West in general. That means 20 days of extra voyage. That also means extra shipping costs. And what Pankaj Chadda of the Engineering Exports Promotion Council tells me is that they are seeing seeing freight costs go up about 30 to 40% from what they were sending shipments earlier with. Apart from the cost angle, there is also the issue of in general just the uncertainties on whether containers will reach, given the fact that there is tensions that are developing and that are brewing day in day out, especially over the weekend, with the US also formally entering this conflict. What we're also seeing is that exporters are also, of course, constantly tracking oil prices, which are also set to go up. They have gone up as of Monday, but they will further inch up if these tensions worsen.
Thanks, Rishabh, for that. Meanwhile, India has started to evacuate its nationals from Israel as the ongoing conflict in the Middle East escalates. In fact, India's ambassador in Israel said that the evacuation of Indians from Israel is being looked at on a daily basis through their 24/7 control room. Let's listen in to what he has to say.
अभी तक तो कल हम लोगों ने 162 लोगों को भेजा था, आज 182 जो जॉर्डन के थ्रू जा रहे हैं एंड 290 जो इजिप्ट के रास्ते से जा रहे हैं। एंड सिमिलरली डिपेंडिंग हमारे यहाँ जो एम्बेसी है, एम्बेसी में 24/7 कंट्रोल रूम है। हमारे जो ऑफिसर्स हैं वो कंट्रोल रूम में शिफ्ट वाइज काम कर रहे हैं। जितने भी हमारे इंडियन नेशनल्स हैं जो इजराइल में हैं, स्टूडेंट्स हैं, केयर गिवर्स हैं, कंस्ट्रक्शन वर्कर्स हैं, बिजनेसमैन हैं और जो बाकी विजिटर्स हैं, तो हम लोगों ने हमने काफ़ी एडवाइजरीज इश्यूज़ किए हैं। एडवाइजरी के थ्रू हम लोगों ने उन लोगों को रीच आउट किया, उनको बोला है कि जो भी जाने के इच्छुक हैं, जिनको लगता है जिस तरीके से सिचुएशन इवॉल्व हो रही है और जो हम लोगों के साथ रजिस्टर कर रहे हैं हमारे कंट्रोल रूम में, तो उसी के हिसाब से हम देख रहे हैं कितने लोगों को भेजना है। तो जो हमारा कंट्रोल रूम है 24/7, उसमें अभी डेटाबेस में काफ़ी लोग हैं जो जाना चाहते हैं। तो अभी 1-2 दिन और चलेगा। जैसे मैंने बोला कि ये डे टू डे बेसिस पे सिचुएशन रिव्यू हो रही है और अकॉर्डिंगली हम लोग डिसीजन ले रहे हैं।
A sharp spike in crude oil prices is threatening to derail the fragile recovery of India's FMCG sector as companies are now bracing for higher packaging and freight costs, both heavily dependent on crude derivatives. Now, with packaging accounting for up to 20% and freight up to 30% of production costs, FMCG firms are warning of imminent price hikes on everyday essentials like soap, snacks and paints. Let's go over to my colleague Sesha for more details.
Rising tensions in West Asia have left crude oil prices primed for a surge, and since crude oil is a key input for FMCG companies, consumers can expect an increase in their monthly grocery bills and household expenses in the coming weeks. Now, companies have warned that rising oil prices will drive up their packaging and freight cost, putting pressure on profit margins. To offset these impacts, they are likely to pass the additional costs to consumers, which in turn would lead to higher prices across a wide range of items, including packaged food, beverages, soaps, detergents, and even paints. But to what extent? Well, that remains uncertain as of now. The actual impact will depend on how much oil prices increase over the next 10 to 15 days. Now, this fresh uncertainty comes at a time, as FMCG companies had just begun to see signs of demand revival after 5 consecutive quarters of sluggish sales, particularly in urban markets. Analysts suggest that rising crude prices could derail the margin relief that these companies were expecting from the second half of this financial year, aided by fiscal stimulus announced in the recent budget. The market remains alert as geopolitical developments unfold, with many wondering how long this volatility will continue and what it means for both consumers and companies. We will continue to monitor the situation, so stay with us for the latest updates on this developing story.
Thanks, Sesha, for that. We'll continue tracking those latest developments and bring you all of the details. Meanwhile, a surge in crude prices could hit a wide range of sectors, Paint companies, airlines, tire makers, lubricant producers, plastic and packaging firms all risk margin pressure as input costs rise. Now, higher oil costs may force companies to pass on price hikes to consumers, fueling inflation and squeezing household budgets. Oil marketing companies like HPCL, BPCL and IOC could see profits shrink while aviation and manufacturing face operational cost spikes. The ripple effect could weaken the rupee, widen the current account deficit and dampen overall economic growth. My colleague Mahima is here to break down the sector-wise impact in detail.
Right, so I'll start with paint companies because crude is a key raw material for paint companies, and cost of crude as a raw material could make up to 30 to 35% of their overall raw material price. And because they use crude derivatives, crude prices going up is a negative for this counter, and it might impact their overall margins as well as profitability. Now, stocks that could get impacted includes Asian Paints, Kansai Nerolac, Indigo Paints as well as Berger Paints. The next one is aviation. Of course, because of crude prices going up, your aviation turbine fuel could get expensive, and higher crude could impact the overall margins for these counters. That includes your Interglobe as well as your SpiceJet. Then we have tire companies where tire industries use following crude derivatives for raw materials that include synthetic rubber, chemicals as well as carbon black, and crude derivatives in tire also roughly amount to 30 to 35% of their overall raw materials. Now, stocks that could see impact includes Apollo Tires, JK Tires as well as Seat. Lubricants like Gulf Oil and Castrol India might also get impacted because they use direct crude derivatives like base oil as well as additives, and for them around 40 to 45 to 50% of their overall raw material constitutes of crude derivatives. Lastly, plastic and packaging as an industry also might get impacted because polymers as well as polyethylene are direct crude derivatives, and a rise in crude prices could impact their overall margins as well as the profitability. So, stocks in focus could be Polyplex as well as Uflex and Jindal Poly. Now, of course, one thing to keep in mind is various experts are suggesting that this impact will only take place once crude crosses that $85 per barrel mark. Till then, the impact will not be much. So this is the overall view as to how rising crude prices can impact various sectors.
Now, moving on, in yet another impact of Air India's AI-171 crash in Ahmedabad, a passenger has filed a PIL in Supreme Court seeking suspension of Air India's Boeing aircraft. The petitioner cited his personal experience and previous news reports on non-compliance to DGCA guidelines. He also mentioned that the recent Ahmedabad crash to highlight the threat of life to citizens. The petitioner travelled on an Air India flight from Delhi to Chicago in business class on the 20th of May when he found that the in-flight entertainment system was entirely non-functional and the seat's mechanical functions were not operating properly. He says he raised the issue since it was an 18-hour flight. The plea has sought directions to the Centre, Air India, DGCA and the Bureau of Civil Aviation Security. And it's a blockbuster week for the primary markets with 17 IPOs, 6 main board and 11 SME issues set to raise over 15,800 crore rupees. Major launches include HDB Financial, Sambhav Steel Tubes and Kalpataru, reflecting strong investor appetite across sectors. Mahima now joining us with all of the details.
Right, so as you rightly mentioned, 6 main board IPOs to watch out for certainly this week. The first one to start with is the most awaited IPO of HDB Financial Services. It's a retail-focused NBFC. The open date for this IPO is 25th of June and ends on 27th of June. The issue size is 12,500 crores and the price span is set between 700 to 740 and the lot size is 20 shares. The next one is Sambhav Steel, where this particular company manufactures electric resistance welded steel pipes and structural tubes. This also opens on 25th of June and ends on 27th of June. The overall issue size is 540 odd crores and the price band is set between 77 to 82 rupees and the lot size is 182. Next one is Kalpataru Limited. It's a real estate developer company which is based in Mumbai, and the open date for this IPO is 24th of June and ends on 26th of June. The issue price is set between 1590. The issue size is 1590 odd crores and the price band is set between 380 437 to 414 per share. The lot size is set at 36 shares. Lastly, Globe Civil Projects will also be in focus. It's basically an EPC company. It opens on 24th of June and ends on 26th of June. The issue size is around 119 odd crores and price band set between 67 rupees to 71 rupees, and the lot size is 211 shares. And Indo-Gulf Crop Sciences, which did come out with its price band and issue size today. It opens on 26th of June and ends on 30th of June. It's engaged in manufacturing of crop protection products as well as plant nutrition. Overall issue sizes of 119 crore here as well. Couple of SME IPOs are also opening this week. To name a few, includes Profex Tech, Ace Alpha, Abram Foods, etc. And there's one listing to watch out for this week on 25th of June, that is Eris Infra Solutions as well. So certainly it's going to be a buzzing week for primary markets this week.
Thanks so much for that, Mahima. Moving on, Adani New Industries has launched India's first off-grid 5 MW green hydrogen plant, a pilot plant in Kutch in Gujarat, which is a major leap in the country's clean energy push. Fully powered by solar and backed by battery storage, the plant operates entirely off-grid and features a fully automated closed-loop electrolyzer system that adapts to real-time renewable energy inputs for maximum efficiency and reliability. And now a quick look at what else is making news around the country. According to a report by Equirus, India is all set to grow faster than other G7 economies. Strong rural demand, which is up 6%, and 17.4% growth in government spending has driven the surge. India's GDP share is higher than Japan's and Germany's, making it the fourth largest economy globally. Counting for the 2025 Assembly by-polls in 5 constituencies across 4 states concluded today, Congress-led UDF's Aridan Shaukat won Kerala's Nilambur seat by 11,077 votes. By-polls held on June 19th were triggered by resignations and deaths of sitting MLAs. Nilambur saw the highest voter turnout at 73.26%, while Ludhiana West recorded the lowest at 51.33%. Former Andhra Pradesh Chief Minister and YSRCP Chief Jagan Mohan Reddy, along with 5 others,
imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to NDTV Profit. You're joining us on this special broadcast where we're actually talking about a very crucial issue that affects India's nuclear power ambitions. Now, India's nuclear power ambitions have set a new set of backers coming in, and that is the private sector. While delivering her budget speech in February, the Finance Minister Nirmala Sitharaman had spoken about a proposal to allow the private sector to participate in the efforts that India has. By 2033, India plans to have 5 small and modular reactors with the private sector. This is to aid India's plan to have 100 gigawatt of nuclear power capacity by 2047. Already, the Nuclear Power Corp of India, the Corporation of India, has sought bids from private players to set up 2 small reactors of about 220 megawatt electrical each. The response to this bid has actually been very strong. Leading private players like Adani Group, the Reliance Group, and L&T have all expressed their immense interest in participating in this entire process. The Finance Minister has, of course, also spoken about the changes to the Atomic Energy Act and the Civil Liability for Nuclear Damage Act to boost these efforts. Our guest on today's show, who is Vinayak Chatterjee from InfraVision, he has estimated in a recent column that the private sector could contribute about 50% of India's nuclear power needs in the coming few years. And I want to welcome Mr. Chatterjee to this conversation. Mr. Chatterjee, welcome. I want to first start off this conversation with this 50% number. Now, I know that you were quoting the NPCIL chief when you said that, but how do you see this playing out?
This is a very important, shall I say, point of inflection for India's power sector. And I want to step back for a minute to just share a statistic with your viewers, is that in France, 70% of French energy needs are from nuclear. Now just think about that. Whereas in India, only 2% of our capacity is nuclear. France has gone overboard in terms of relying its dependence on fossil fuel from a strategy that they unleashed in the 1970s to reduce the dependence on fossil fuel. And I think in many senses, India has lost a fairly large number of years, because I would say that we've probably lost, close to 75 years, because the nuclear program was envisaged and unveiled by Dr. Homi Bhabha in the 1950s. And since then, it has kind of been sputtering, with the net effect that we've got only 8.8 gigawatts out of our 400 gigawatts installed capacity. But now, what you just said is that there seems to be a fresh reawakening that nuclear power is going to be a very important portion of our energy basket. For a variety of reasons. Obviously, it is to reduce dependence on hydrocarbons. It is to meet our clean energy commitments of net zero by 2070. And also to, in a sense, look at not the complete dominance of the sector by the public sector, but to allow private sector to come in with the view till 2047, as you just said, that was announced, to have private sector contribute about 50% of the envisioned capacity of 100 gigawatts. 50% will be private sector, but through a very important technology, not heavy duty large plants of 3,000 or 4,000 megawatts, but a series of small, what is called SMR, small module reactors, which are anywhere around 300 to 400 megawatts. They unlike the large atomic energy generation plants that need to be set up in situ, means assembled at site, these can be like turbines and generators. These can be factory made and assembled at sites. It could be an industrial cluster, it could be a refinery, it could be a city to supply. So it's a completely different way of looking at nuclear energy for 2 reasons. For three actually. One, to consider it as an important element in the overall basket, to have private sector do about 50% of it, and 3, to use this SMR technology, which is safer, factory produced and in smaller modules in a largely dispersed manner. But over to you.
Let me break this conversation down into multiple pieces then. The first one, which you said that we've lost about 75 years in developing our own sort of nuclear power capacity. I just wanted to get a sense of what the legislative part of the story has looked like over these last years, and of course then what the public sector has achieved in all of these years of attempting to develop a strong flow of nuclear power.
Look, I wouldn't blame the public sector for lack of, shall we say, the state of our small capacity today. Because remember, nuclear power is has been an extremely closely held technology by the superpowers. And they have been very, very reluctant over the decades to supply, the fuel, nuclear fuel, uranium and other derivatives to India because of the fear that India would develop, nuclear armament capabilities. That has always been the fear. And therefore, there have been a whole lot of restrictions where the Atomic Energy Club has been a very closed club with all kinds of barriers to entry. And India suffered because of that, because of our neutrality, because of our, non-alignment, etc., etc. So the fact that Dr. Homi Bhabha's vision could not be fully unveiled was, I suspect, a creature of geopolitics and the fact that it was a closely held technology in a closed club. But that's about to change right now. That's the hope, right? So over to you.
Mr. Chatterjee, I wanted to pick your brain a little bit and try and explain to me a little bit about what is it that you are looking forward to at this point in time. Yes, the private sector is slowly coming in. NPCI is opening up certain bids for these SMRs or small module reactors that you spoke about earlier, inviting private sector participation in developing them. But at what pace do you think this is going to grow? Because the ask is 50 gigawatt, because 50% of 100 gigawatt, that's what we're talking about, by 2047, which is just about 22 years away. How do we reach that number with the current level of private sector participation?
See, it would be to open up the field to a large number of investors, right? But there are two impediments, and you touched upon them in your opening remarks. The first is the Nuclear Liability Act, which was kind of signed off during the famous Dr. Manmohan Singh's signing of the Civil Nuclear Act with USA in 2005, which also was a seminal step, but it then kind of lost momentum after that, where we signed the Civil Nuclear Liability Act, where India was fairly, was fairly adamant that the nuclear liability, should any accident happen, would remain with the suppliers. In essence, there are many other bells and whistles in that, but this was the fundamental point. And since then, suppliers, like major suppliers like Westinghouse, like Hitachi, like Areva of France, have been extremely cagey about participating, because they said, look, after we have supplied the equipment, for the next infinite number of years, we can't be held responsible for any misdeeds that may happen in the operating style, which may lead to an accident or a leak or anything of the sort. So the Nuclear Liability Act was, looking back, quite harsh and prevented the rapid development of the sector even after signing the act in 2005 with USA, Civil Nuclear Act. So one of the ideas now is to reduce the liability clause to make it far more practical, to share the risk between the equipment supplier, the operator, and the conditions thereof, and the harshness of it. That's point one. Point number two is to actually make, since we are now expecting the private sector to contribute 50% of the capital. Remember, nuclear power is capex intensive and is therefore, in many senses, unviable. The capex could be, anywhere which 4 to 6 times the capex required to produce the same unit of electricity, whether it's renewable or coal thermal. Now, if you have to get private sector in, then you have to look at incentive packages like viability gap funding. For example, let's take a look at semiconductors. In semiconductors, the Tata Group is investing 90,000 crores for, obviously, a proud investment for India to take our march into semiconductors at Dhodera and Gujarat. But it is getting a 70% fiscal support, often called viability gap support. 50% is from the center and 20% is from the state of Gujarat. So 70% of 90,000 crores semiconductor investment is taken care of by the state to encourage the sector. Now, it's extremely important that we encourage the nuclear sector, and therefore options like viability gap funding, like fiscal support, soft loans, all of these need to be welded into a package to make it not just attractive for the private sector, because attractive is an interesting word, but to actually make it viable for the private sector to enter nuclear power production. That is point number two. And point number three is that currently the private sector believes that even operating the plants after putting the capex is subject to many restrictions, that the plant will be operated by people who are employees of National Power Corporation, or that they will be in charge of many aspects of operations, and that private sector will only put in the capex and take the market risk. Now, this is the current set of perceptions, and these perceptions require to be handled, and therefore the exact nature of the public-private partnership is still work in progress. But I am told that the government is alive to the fact that it needs to balance private sector interest, enthusiasm with the necessary regulatory safeguards and come up with a package that is a win-win for all players, including the citizens of India. But over to you.
If you were in charge of developing these amendments to the Atomic Energy Act or the Civil Liability Act, I'm trying to understand what specific changes would you recommend if this was a decision that laid with Vinayak Chatterjee?
I would find it difficult to answer the question because it involves extremely scientific and technical details which are beyond my pay grade, to be frank with you. I know the issues, but it is actually, the subject is extremely technical, and therefore I will not be able to give you the exact contours.
Fair enough, Mr. Chatterjee. I wanted to ask you, so you mentioned the cost aspect of it. Of course, the numbers that we have, and these are numbers largely provided by you, about 16 to 20 crore per megawatt. That's the capital cost of setting up a nuclear power plant, power project, versus coal, which is about 9 to 10 crore, and solar, which is even less, at about 4.5 to 5.5 odd crore. I wanted to get a sense of, is this a situation where higher volumes means lower costs? So therefore, as the expansion happens, as more and more capacity comes in, you will find it cheaper to then develop more future capacities?
It's a difficult question to answer. I will draw a parallel situation with hydropower. You know, hydropower is very capex heavy because you have to build huge dams and catchment areas and all kinds of stuff. But over the life of the first 5-6 years of a hydro project always look unviable in a feasibility report, because you got to service the capital, etc., with very heavy capex in the first years. But the beauty of hydro projects is that the raw material is virtually free. You know, in a sense, it's water flowing down. So the balance years of a hydro plant make it an extremely profitable venture. But the first 6-7 years have to be taken care of by having a long tail, where large part of the financial, servicing the financial burden has to be pushed to the longer end of the tail. Similarly, nuclear is very capex heavy, but going forward, it is expected, with the nature of the costing of the fuel supplies, which will be government controlled, it is expected to have far lower operating cost. So the balance between high capex and lower operating cost on a running basis has to be handled in a similar to the challenge handled in hydro. But all said and done, even if that is done, there is no question that it will require various kinds of capital servicing, capital subsidy, as well as soft loans, as well as a long tail to service the capex. And that should be one of the critical financial issues that the government has to address. But as I said, the government is alive to such issues, and the semiconductor example makes the point.
Okay, I want to touch upon the status of infra development in India in general, and we'll add nuclear development on top of that. To your mind, what are the specific sort of efficiencies that a private sector player brings in? Because we've had about 70 odd years, 50 odd years of private sector players coming in and starting to build projects en masse, and especially over the last 30 odd years. How do you see the efficiencies that a private sector contractor, private sector builder can bring in? And here we are talking about names which are, Adani Group, Reliance Group, L&T, who are all given the sort of title of being India's biggest builders, right? How do you see the efficiencies coming in then?
Look, this is an easy question to answer. I mean, there has always been the question of why PPP? Why do you want private sector in the infrastructure sector? It's not just about money. It's about bringing in efficiency. So why I'm saying it's easy for me to answer this question is you just have to look around you. What was telecom before private sector came in? What was the state of our airports before GMR, GVK, Adani came in? what was the pace of implementation of power projects before the biggies came in? How much has the distribution increased, the efficiency increased in Mumbai and Delhi and many other cities when distribution was thrown open from the moribund State Electricity Board and DISCOMs to the private sector? So the answer is today not a theoretical question anymore, that why should private sector come? Just look around you and you will see the kind of modernism, efficiency, service level that private sector brings in. Not just capital, although bringing in capital is an important point, because if you notice that in the last union budget, the growth in the union budget, the growth in infra spends has plateaued. It has just been an increase from around 10.2 to about 11.1. So it's plateaued. So, and the FM is concerned about meeting her fiscal deficit targets, which are tough. And therefore, to build infrastructure in the country, obviously the capital from the private sector is important, and not just from domestic capital. Please remember that foreign capital, long-term pension funds, insurance funds, etc., are very bullish on investing in Indian operating brownfield assets. So, and so therefore, look around you, and the answer is clear.
Yeah. Then I want to add a point to this. So then, are we to think of newer styles of financing these projects? Because as you said, they are nuclear power projects are significantly capex heavy. You would have to think about it differently than what you would look at a conventional power plant as such.
See, let me give you one extreme example, and that's not a private sector example. Sure. Look at the financial structure of the bullet train. Japan through JICA has given 60-year money at 0.5% interest with a moratorium of 15 years. Now, just think about it. Think about that capital structure which enables a high capex bullet train project to be developed by a developing country like India. Now, I'm not saying you need that level of, shall I say, an extreme financing structure, which is very welcome. But if the state were to bundle a financial plan and then have and give it, and package it for, let's say, Japanese or Nordic or Gulf sovereign funds, and the government of India stood as sovereign guarantor to them and has a package which is long, low interest, high moratorium, and then distributed that finance to the developers of nuclear energy. Those are the kind of steps I'm looking at, that the state must be a partner, not just in creating an appropriate regulation, not just in supplying of regular fuel assurance at appropriate prices, but also to create a financial structure based on the strength of the Indian state and the confidence that people have that India never defaults, to stand as a sovereign guarantor to a very long-tailed, cheap finance available in a holistic manner, a line of credit, which it then cuts and makes available to the chosen developers of nuclear power. Those are the kind of thoughts that's going through my mind.
I want to ask you last couple of questions. Now, there is talk about allowing, considerable foreign direct investment. Of course, there's no confirmed news at this point in time. We don't have confirmations on this. But news reports have suggested a 49% FDI might be allowed for nuclear power projects. Is that kind of, when you say foreign capital is needed to develop these capacities in India, is that the kind of push that you're expecting?
Well, it's one of the elements. Allowing 49% is safe, 51% remains with Indian players. But remember, we ultimately, while we are developing SMRs with NPCL technology and our own initiatives, a wide variety of dependence will be there on foreign equipment suppliers. And there are just a handful of them. As I mentioned, there is Westinghouse, there is Hitachi GE, there is Areva, etc., etc. But giving 49% not only gets the capital in, but also gets the expertise in building and running these plants. And that would be welcome. And we have a case of 100% FDI. If you take the new airport outside Delhi at Jewar, it's 100% FDI by Zurich Airport. Bangalore Airport is owned also by largely with FDI, with Mr. Prem Vatsa's investment. So we have reached a stage where large portions of Indian infrastructure have welcomed coal thermal plants. We have foreign players who have invested. So giving 49% is logical, both from the view of attracting capital as well as from the fact of accessing technology and competence.
One last two more questions, but one question specifically, because the current geopolitical situation is talking about a nuclear power nation which is being accused of developing weapons grade nuclear power. What I wanted to understand is, in case there is some kind of geopolitical tension, what happens then? Does the presence of the private sector, does the involvement of the private sector sort of take away that kind of negative view around nuclear power?
I suppose so. I mean, as I started your session by saying, 70% of France's energy is nuclear. Does that mean that all of us are extremely wary about France as a nuclear power? No, we aren't. Because the uses of nuclear technology for civil nuclear power are vastly different from its usage in military applications. And you cannot deny the fact that across countries in the world, many countries have a high percentage of their energy needs coming from nuclear. So to my mind, they are in two separate bins. And I don't think that India increasing its share of nuclear would largely create any fright in the rest of the world, because India is considered a very mature player in this regard.
And my last question then is the energy transition goal that India has. Now, of course, I mean, everybody, including the government, has specifically said that this 100 gigawatt target that they're talking about 2047, that is going to be crucial as part of India's goal to have a more sustainable energy source in the future. To your mind, what is then the goal once you have achieved that? What do you go for next?
Well, actually, 2047 is not the real goal. 2047 is fine for a target that we've got to get 100 gigawatt of nuclear by 2047. The real goal, the committed goal by India, is at COP26 in Glasgow, where we said that we would be a net zero nation by 2070. And that is a tough target, because we have that many years to add all kinds of non-fossil fuels, whether it's solar, wind, tidal, geothermal, nuclear, all kinds of and hydropower. All of these have to be added as non-fossil sources of power to enable India to be net zero. So nuclear is with 100 gigawatts target by 2047. Hopefully by 2070, we will not only be 100 gigawatts, but we'll be 200 gigawatts. That or more, that would be a very important element of driving India's commitment to be net zero by 2070. So nuclear has a very major role to play.
All right, Mr. Chatterjee, thank you so much for taking time out and talking to us about these different aspects about nuclear power and India's ambitions, as well as, of course, the private sector push that's coming in. That was Vinayak Chatterjee from InfraVision Foundation joining us on this conversation, especially to talk about nuclear power. What is he saying? Well, essentially 100 gigawatts by 2047 is a great target to have, but the eventual goal is to be net zero on the power side by 2070. So this will aid in that entire journey. That's it from me right now. Thank you so much for joining us. Stay tuned to NDTV Profit for more news and updates.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
source is an ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold.
Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you answers to all of your personal finance related questions. And today, I'd like to focus on two very important, very useful tools that individuals use to accumulate money for their retirement. One, for employees, is the Employee Provident Fund. And the second, which is also an option for employees, but also for people that are working for themselves, is a national pension scheme for people who work on contract, for example. We'll talk about the kind of wealth creation that you can have over the course of your careers, but we'll also, more importantly, talk about how you should invest the proceeds of these two investments, as well as what you can do with the gratuity money that you will receive if you decide to work for one company for protracted periods of time. Joining me today is in studio Sharad Tandon, who is the founder of Invest at Ease, as well as Santosh Joseph, who is the founder of Germinate Investor Services. Thank you so much, gentlemen, for taking the time. Sharad, I'll start with you since you're sitting in front of me. The EPF, for the longest time, has been one of the foremost products for employees to invest, and you can't beat that kind of return. But to help people understand the kind of wealth generation that can take place, how would you draw that out?
So Alex, pleasure to be here and talking on this. EPF file might not be the right product to compare returns to return, but it creates wealth. So just to give you an example, in EPF, there is actually around 24% contribution which goes into it, 12% from the employee side and 12% from the employer side.
Right.
And this is percentage of basic plus DA which the salary draws. Now, the employee's contribution, the 12% goes into EPF totally, while from the employer side, the 8.67% goes into something which is known as the employee pension scheme, and rest 3.67% goes into EPF.
Right.
Now, look at a simple calculation. So, even if you are at 25 years of age, starting your job, probably a basic salary of 5,000, 6,000 bucks. That low, which is possible every time today. So you are looking at 12% of your contribution and 3.67% of employer, so 15% going into it. So around 750, 800 rupees to go into it as a contribution. The returns of the products are controlled by the government, and every year end they declare.
Yeah.
But the best part is it's a classic example of compounding. As people in investment talk, there is nothing which beats compounding. So look at it. Your safe bet to assume over a long period of time, 5 to 10% increment of a salary every year will happen.
Right.
Some years it will be 2, some year 12, but average will come around 8-10% odd. So if you had only 1,000 bucks starting point of your basic going into it, as a contribution, put yours and employers together and 10% increment, in 35 years of your job, that would grow to more than 1 crore. At assuming at 8.25% return, which was last year's declared return. Now, I'm not even talking about 15 years back where EPF returns were slightly higher, but that sort of compounding of wealth is, which it creates. So for me, the simple advice is people who are starting their career should not commit only one mistake when they change job to withdraw.
Yeah. Yeah.
Because so let the money compound.
Keep it going. The whole analogy of a snowball in sticky snow. Santosh, this is an important point because when it comes to the new tax regime, which a lot of people are now using, they're finding that deductible, at least their contribution to the employee provident fund, is no longer available as a deductible from the taxable income. And so some of them are tempted to say, okay, limit my contribution to the bare minimum available and the rest give it to me as a paycheck. So what would you say about that and about the kind of money that can be generated over long periods in the EPF?
So what he said is absolutely spot on, and there are just 2 points I'd like to add to this. I think there's nothing that beats compounding, we know, and I think this example that he gave was phenomenal. But I think if ever you want to get the best out of the power of compounding, he gave it in his example, that is the 35 years an average 25-year-old will get to let his EPF contribute. We are for long taken time for granted. The secret why this works, even though the contribution amount is small and even though the return is lower than what normally people expect, it's in time that these things swell up to become a huge kitty. Now, even before this taxation came, people were sometimes trying to ensure and calculate how to keep that EPF contribution from their side the lowest because they were always hungry for a greater return. Now the taxation has made it even more evident for people to leave the least possible, because over the last decade or maybe a decade and a half, we've realized the power of compounding with a slightly extra 1 or 2% return can have meaningful impact on your portfolio. But I think the benefit that EPF gives all of us, salaried class and maybe even the guys who do PPF, is that the luxury of hard coding some bit of your investment where even you can't touch it too often. There's a certain bit of ring fence around it, that money is considered and left to stay for long term. The secret in all this is the long term nature of this investment. So there are people who now calculate the post-tax and effective return by reducing the amount of money they contribute. But I still think for many salaried class people, this is their de facto long-term saving tool.
Yeah, a very important point. By the way, I asked Sharad about how you can keep a tab on your investments in the EPF, and he's very helpfully shared some key points. One, you can visit the EPF portal. You can click on e-passbook and you can see that on the home page. You can also enter your UAN number and password and captcha and say, click on the sign in button, check on the passbook and select member ID to see your PF balance. If you sign up for the notification, you can also get that at the end of every quarter, if I'm not mistaken, or at a certain period, on a monthly basis. Yeah, quarterly or monthly basis, you can get some updates there. But see, the thing is that if you don't invest or if you are out of a job, there is a certain availability of recovering that money. And that's exactly what Sharad was pointing out, which is that you should, if possible, not withdraw that PF when you change jobs or if you have a break. But it's important to point out that if there's a protracted period of absence from work and there are no contributions to the EPF, it's not going to generate income. Sharad, you want to explain that? 36 months?
Okay, so the clause reads like, if you are not contributing to an account for more than 36 months at a go, it's deemed to be inoperative and the compounding interest doesn't come into play. But most of us want to find an alternate job if we are in a job, or if you want to decide separately, then the NPS is an alternative. But try to hold on to that 3 years, at least that will compound because it's on the accumulated wealth and it's compounding growth. And the other option for us is, at one point of time, which a lot of people are doing, is take a sort of part-time gig which contributes some money so account is active.
Sure, but you need to be an employee. Yeah. Okay, so that's an important point. Now, before we get into gratuity, I do want to discuss the NPS, which I think a lot of people have gravitated towards Santosh because it's been pushed, and primarily because of that 80CCD, which allows for that 50,000 rupee deduction. Even in the new tax regime right now, you can have your deduction to the taxable income if you're telling your employer to contribute on your behalf to the NPS. So if you are an employee, and here I'm specifically talking about employees, Santosh, does it make sense to also contribute to the NPS?
The answer is yes. And now, if you look at it for the people who really save on taxes, the segment is really small, that the people will have a meaningful impact on their 50,000 rupees extra saving on taxes alone. I think this should be seen a little more holistically, that NPS offers you really long-term savings, which is essentially something that we all want to at some level commit to. So therefore, tax saving apart, I think for wherever people can, some bit of their money to be set aside for really long term should be considered, because you can always do things aggressively yourself. But this bit, it's also, like you mentioned earlier, a government scheme. Why would you want to miss the opportunity? So tax benefit, long-term savings, letting it happen from your salary through your employer. These are all a great, ways to save money at a grassroots level.
Fair point. Let's get into the nitty-gritties just a tad bit though. Sharad, the question to you is, how much should you contribute? If you have the ability, obviously you have the ability to decide if you're already contributing to the EPF, and of course you can go the route of voluntary provident fund and maximize your contribution to the extent of the whole of the basic. Of course there are restrictions in terms of taxability. 5 lakh rupees
5 lakh.
or thereabouts is actually not thereabouts, 5 lakh rupees exactly is where it is set. But how much do you contribute to the NPS, particularly because only 60% of the proceeds when you do withdraw it are tax-free?
Okay, so for me, the guiding principle which I suggest to a lot of people is, if you are saving around $100 in equity SIPs, at least 25 put into NPS. Reason being very simple. In the change scenarios, the expense ratio is the least of the product you could find in the market. It gives you an extension instead of 60 years to 75 years. So it enhances your compounding. It also gives you an option to manage your allocation actively, which was not the case some time back. So it was driven by your age, your equity allocation used to get added, but you can manage actively, take 100% equity exposure, compound. If you look at only pure equity NPS offering schemes, their returns vary from 12% to 20% in last 5 years annualized. Now, which is as good as any other MF.
And tax-free and low expense ratio.
Exempt in category, that's advantage. The only drawback is you will have to buy 40% annuity of the fund value whenever you decide to withdraw.
That's one of the drawbacks. I'll point out another one, but you finish.
Okay. The advantage of that is, now in the change regime, the government has allowed you to withdraw 15% as a SWP.
Okay.
So now when you do a reverse of SIP, SWP post your retirement, you can start withdrawing. Your taxation is still limits. And second is NPS tier 1 accounts. You can't withdraw till you retireable age, or you can partially withdraw subject to certain conditions like your hospitalization, house loan, child.
And that's limited.
That's limited. 25% is limited.
Yeah. That was the second drawback, which I thought is very important, because as much as this is a great product, it reinforces the fact that you have to work till you're 60, and the inflexibility of that point is what I think will push a lot of people away.
No, so I beg to differ on that. It doesn't force you to work. The way to look at it, even if I say quit job, say in my case I left my job last year, 51 odd, I left. I continue contributing to NPS, which is only $1,000 is minimum requirement. To continue doing it. And that's why that 25% allocation from the overall SIP was only a bucket for your retirement kitty. So in that sense, you can still continue the same product with the same flexibility with a reduced sort of liquidity. That's the only drawback.
But it's a nest egg that you're building for when you're post-retirement. It's an interesting perspective that you have. Even if you're not earning to the extent that you were earning, if you decide that you've saved enough. When you're 50 years old, you want to kick back and have an early retirement. I'm sure that's not what you did.
No, I did that only.
Okay, so we okay, I've gotten your reason. But Santosh, the question is then, how do you choose what you want to invest? Because there are several options in the NPS category as well, and several service providers as well. And as Sharad has pointed out, the returns can go anywhere between 12% to 20% over the last 5 years annualized. And the reason for that is because you can choose from a wide variety of combinations.
So for beginners, I'm one who quit work 9 years ago. I still got my NPS active. So I do this annual contribution, sometimes twice a year, sometimes once a year, because I want to keep my account active. And now for me, this is really long-term savings where I want to block me from accessing my own savings because I want to really keep it long-term. Now, there will be certain disadvantages. I agree, like you just mentioned right now. But we have to remember, that's when you learn to compartmentalize your money and your savings and your basket of money for different age and time profiles. For me, this is really a 60 or post 60, where I also hope that when it comes to 60, I do not have to depend on the NPS, but I still have something at the back of my mind to take care while I'm at 60 or post 60. That's number one. Number two is that, yes, there are many people that offer, but the beauty is this, all of them are very well regulated and even very well priced. He again said this so well. This is possibly the cheapest product that you can get in terms of the quality of the product that is available in the market. Finally, at my own plan, I've tried to get the maximum equity exposure possible while also getting a little bit exposure to corporate bonds and GSEC. There are people that I know who only want GSEC. There are people that I know who are very happy with corporate bonds and GSEC. So the flexibility that it offers is you can be in all the three, equity, corporate bond and GSEC, or a combination of the three. It's not that you'll be restrictive in your asset allocation. You have the luxury of choosing the asset allocation that your time horizon demands.
Yeah, I have a follow-up on this to Sharad. Sharad, when I'm comparing, and not necessarily like-to-like comparison, but if I look at fixed income mutual funds, and I look at the NPS and those that are oriented more towards fixed income than equity, and I know that the suggestion invariably is go towards the equity allocation, the higher equity allocation is the aggressive option. Post-tax, if I were to talk about it. In fixed income mutual funds, the drawback is that your returns are taxed at slab rate. So if you are to build in that allocation towards fixed income in your overall investment portfolio, which is a good thing to do, then should you opt for the NPS and use it for that purpose?
Okay, so a bookish answer is yes. A very practical answer is, if you have to look at a debt, then look at a balanced advantage fund as a category. I'm digressing to the extent of the products, but see, in the NPS, there are three buckets which you can run. Yeah. So from 25% equity to 75% equity, that's as per age goes. Yeah. So which is as good as the moment you cross 50, you're saying you're 35 or 40% only in equity, which a balanced fund will do. And the tax advantage comes there without any negatives which we have discussed in terms of lock-in or withdrawal amount and all. So typically for me, advising to anyone or suggesting to anyone, equity is the way to go in NPS. For other buckets, look at the other open-ended options which are potentially possible in today's scenario.
Okay. Is there a dramatic difference, Santosh, when you're choosing, and here I want to now move towards when you are at that 60-year threshold. First of all, in your opinion, should you extend the maturity of the NPS if you can do that and push that down the road, because you're taking advantage, one, of compounding, and two, of the fact that 60% is withdrawable without taxation?
Alex, the most ideal answer is to delay the NPS as much as possible, but we also have to appreciate and acknowledge the fact that not all of us would be in that situation. I mean, it's a sweet spot to be in, that you come at 60 and then you realize, hey, really NPS doesn't matter for me because I'm otherwise sorted financially and my goals are taken care of. Again, we have to answer this question here. What happens at 60? The primary thing that happens is there is a drop or there is a stoppage of active income where you go to work and you earn money actively. But there could be passive income that you would have built, or there's building in, or there could be so many other avenues for it. I'm not getting into that. So the straightforward answer is, the longer you delay, the better it is because of growth and compounding. But if you do have to start, then you start it because you start ensuring that your financial goals are being met.
Okay, good answer. Now, you have to choose from various service providers when it comes to your annuity product, right? Is there a of course there is a difference. These are different service providers, but objectively, Sharad, how do you choose from these various options?
So that's a tricky one. And that's probably one of the drawbacks of choosing an annuity provider. So very easy to do it. You go to CRA annuity quotes, you will find all the providers, what is there. But the problem which I have seen in the life is, the moment I decide to retire, more often than not, all of us want to go to a place which is either our hometown or to a different location than our work location. Now, we need to be cautious at that point of time. Out of the 14-15 service providers which are there for annuity fund management, whose office is closest?
Right.
Because for any service issues, it will be tough for you to travel back to a bigger town and get it service. And typically all of us, including me, or probably Santosh, you, all of us have been committing the same crime of being lazy, of not updating our KYC records in, say, EPF, gratuity, NPS, which can be as simple as updating your changed phone number, change address. Now, the moment this happens and you get into service issues, you want a provider to be closer to you.
Yes.
So probably letting go of 0.25% annuity return makes sense for that service, and then the product choosing is a problem. Each of them provide single annuity, a joint life, and return of premium annuity. Now in joint life also, our understanding till now has been, it's between husband and wife.
Yes.
There are providers now who offer between son and father, grandson and grandfather. So all those tricky questions you have to select and choose, and depends on situation to situation. So more often than not, it's better to have a person to handhold. But again, the challenge is most of the point of service or point of sales staff itself is not so geared to give you all those details at a go for all 14 providers.
Okay. Speaking of this, I have a question on NPS. Obviously, you can only withdraw it after the age of 60. But what happens, God forbid, if you don't make it? You have to give your nomination details, of course. But how does that payout happen?
So in case of any eventuality, the nominee gets the whole payment out. And
100%?
He gets it, then he is supposed to buy 40% annuity.
Sure.
Also.
Okay.
So now it's non-taxable at that point of time also. But for all those things to fall in place, the critical is your updation of your own PI.
Yes. Yeah, that's an important point. I do want to get into gratuity as well very quickly before we talk about deployment. And Sharad, you've got an interesting data point that you've shared with me just to talk about the kind of benefit that you can have. By the way, the rule is, I thought it was less than 5 years. It's 4 months and 4 years and a few months, right?
So for all the practical parlance, it's 5 years.
5 years, okay.
Because for Gratuity Act, productive month is counted as 26 days. So the new changes says 4 years plus 240 days.
Okay.
So you can complicate it. 240 days of productive work will be calculations, say 9 months or 10 months or to be safer. But easy to remember thumb rule. It's like old time's sake, and probably we can use it in our calculations also. Rule of 72.
Sure.
So anything which you want to compound, say post office used to compound in 64 months, 70 minutes, so simple. 72 divided by interest, that many days. So same, it's easy to remember 5 years. And that's where it is.
So I know somebody, wink wink, who missed out on gratuity by a few days. So I know the pain that you can feel. But assume that you've got all of this amount that you're receiving at the age of 60. The question then arises, how do you deploy that? And Santosh, I'll come to you first on this. Assume that you have an EPF, you have a 60% of NPS, you have a gratuity. This is a very substantial pool of money that you have available to you. How do you allocate it at the age of 60 or beyond?
I think first of all, for those people who are hearing this conversation, we need to, acknowledge them by saying that maybe for the salaried class, this will be one of the largest pockets of money they're receiving during their working careers. You have to be extremely critical and careful about how you manage it. Like they say, success is relative, and when you have money, you'll have even more relatives. So be careful about how you handle this corpus. The first things first is that you have to gather all of these together, put a good plan, figure out your financial goals and go about it. My point is that while the money coming in is good, what is going to be even more critical and important is how you take care of that money, because this will be a large kitty to take care of you and maybe the family that is dependent on you for long time to come.
Okay, let's get into some details here. Assume that I'm the person that is asking this question. Imagine that I have more white hair and I'm asking you, Sharad, how do I deploy this large sum of money that I've received? I've worked all my life. How do I deploy it?
So anyhow, you don't have more gray hairs than I have. So the way to look at it is very simple. First question first, and we have to prod each of the investors to the second level of questioning. Do they have a sort of pensionable job? Some of us can still retire from central government, state government, have a pensions. Does it cover your expenses today?
Right.
Do we have a rental income or a investments income coming in form of dividend, interest, everything else? Now we add those amounts and figure out if my expense will be met.
Yeah.
Then we start allocating into buckets. The thumb rule for 60 plus is very simple. Have 12 to 18 months of your money lying into a short-term fund.
Which is an arbitrage fund or a liquid fund or something like that?
You can do it anywhere, because now with 12 lakhs income, non-taxable will depend on person to person.
Sure.
So if you have 2 files in the house, 24 lakhs become non-taxable.
Yeah.
If you don't have pension, probably put into a short-term fund, it doesn't make a difference to you. Otherwise, arbitrage will make sense. Liquid, if you are opting, then monthly dividend is one of the way to do, because you can have certain portion of the dividend as a tax-free income.
Sure.
Second, 12 to 24 months again. So I'm putting into that 12
buckets,
to 18 buckets only. Get into hybrid funds. Any bucket after that goes into a sort of multi-asset, multi-cap fund, and last 5-10% of your portfolio is still continue having into a sectoral equity mid-cap portfolio, because you have to beat inflation. The biggest problem at age of 60, which all of us have done. So when I started my career in 96, the assumed age of life expectancy in India was 55. Today it's gone up to 72, 73. Now Bangladesh used to be 80.
Right.
Now if that happens in India, you are running a fear of outrunning your retirement kitty if you are becoming too defensive.
Yes.
So you need to compound slightly more than the inflation. And also, I'm sure at that age, all of the grandparents, grandfathers, grandmothers would want to enjoy their life. So keep a kitty separately for that, whatever it can be.
Yeah. So I think you've answered quite a few questions, and Santosh, you as well have answered quite a few questions. And what we'll do is we'll do a masterclass perhaps next week just to talk about how to construct this kind of a portfolio. I think the objective of this conversation has been how to identify what to do with your EPF and your NPS. Now, I do want to very quickly address one more aspect, which is specifically with the EPF. Sharad, I know that the EPFO has been working towards fixing a few of these problems with regard to the withdrawal and redemption, but there are still a few niggling issues. From the perspective of the investor, how do you avoid these issues?
So, I'll take my own case. So when I left my job in August last year, typical IT company, HR is all automated. So now the challenge is half the time you don't have anyone to talk to. So the only option is first get into all the KYC norms completed, nomination completed, and the key thing is not to forget your family pension. Because the portion which goes into family pension creates that additional pension for you. So it's a generic tick mark like your mutual fund investment or life insurance. But if you are cautious of that, things will fall in place.
Great. Okay. So on that note, if you've got any specific questions for us with regard to the withdrawal of your EPF, make sure to write to us in the comment section. And that brings us to the end of this edition of Your Money Matters. Santosh, Sharad, thanks so much for joining us today, and pleasure having you on the show. All right. Do stay tuned. Lots more coming up on NDTV Profit.
imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Hello and welcome. You're tuned in to KYC. I'm Harsh Saita. With me is Mahima Vachajani, and what we're going to do today is we're going to speak about V2 Retail. It's a value retailer and it's in focus because of the kind of stock price action that it's seen over the last year or so. The stock has more than doubled, 2.5 bagger over the last year. But look at the last 5 years. In fact, from June of 2020, and maybe that's a low base, the stock has been on an incredible run. It's up maybe nearly 40x, but to be absolutely precise, 34x since that point. So it's been a phenomenal story that's playing out in front of us, Mahima. And it's important to understand at this point, because FY26 could well be that year where rural starts to participate. We've seen rural under a bit of pressure last couple of years. Can rural start to actually participate this year, given the way monsoon is playing out? But the kind of growth base that the company has built for itself over the last couple of years is extremely high. So my first question, therefore, is can growth sustain on this kind of base? Store levels need to go up for that. Same store sales growth needs to sustain with store levels going up. And you have average selling price, which also has crept up, and that also, can it sustain above that 300 mark, will be the question. Because for full year FY25, it's a shade below 300, but Q4 was above 300. So is that the new normal? Is that the new base? The second part of this is, can growth sustain without discounts? Now, discounts have come down marginally in FY25 on a very, very low base. So that's a positive, but can that sustain? Rural pickup in FY26, if that were to happen, states of UP, Bihar will well benefit from that tailwind, even a Jharkhand, even an Odisha, where V2 Retail has a significant geographic footprint, and that will obviously further aid the numbers for it. Factors to consider, especially when it comes to store shutdowns, and they do this very minor tweaks in terms of store shutdowns, but that could well be one of the drags, and you'll want to understand whether that is consistent year after year. I would want to quiz them this year and then thereafter next year as well, to try and understand whether those factors are changing with regard to store competition. Challenges, store shutdowns. challenges with regard to competition, and possibly leading to poor execution. That could well be a risk for this one, because we've seen very sharp growth. They are very steady in their commentary, but any slip up with regard to execution could well hurt the stock price as well as the performance, because it's certainly not trading at cheap valuations on a trailing 12-month basis. The average selling price, the trajectory is what I would want to understand. Margin risks both on gross as well as on the pricing front. What is the calibration that is possible, and that interplay along with competition. And last off, with regard to cash flow, can that cash flow really sustain? Because in FY25 we've seen two positive things happen. One is your inventory has come down, even though your inventory days have come down, even though your inventory in absolute terms has gone up. And second is your payables have really ballooned, and that has helped working capital days to come down, and that has aided the cash flow from operations. Can that change and reverse? Is there a risk of that, is what I would want to understand. So all of that, but first off, about V2 Retail, let's take you through the journey. It's been a large turnaround of sorts, Mahima.
Absolutely. It was incorporated in 2001 and it got listed on the bourses in 2007. It was renamed as Vishal Retail in 2011 after selling the entire Vishal brand, which was loss-making, and that was one of the reasons as to why it was sold. And V2 Retail stands for value as well as variety. In terms of the company, it primarily operates in Tier 2 and Tier 3 cities. So what you were talking about, because the past few quarters have been good in terms of rural spending, because rural has gone up as compared to something like an urban. And that is something that has augured growth for the company in FY25 as well. It caters to the neo middle class and middle class demographics. So that's their overall audience. Like Harsh mentioned, their average selling price is anywhere between that 300 to 350 odd mark. In terms of their focus area, lowest price given at quality, and of course with wide assortments. In terms of the retail presence, they are present in around 189 stores in more than 150 odd cities and in 20 odd states, and retail area as of March ending stood around 20.27 lakh square feet. In terms of their product design, there is in-house product development with a team of 25 odd designers right now. In terms of how their business is divided, it's divided in menswear, which is roughly 40%, ladies wear is 27%, kids wear is 25%, and lifestyle is roughly 8% of the overall counter.
I'm just going to chip in here. Yeah. See, this mix, when I was looking at it over the last 4 to 5 years, hasn't changed significantly. Correct. So we've seen this mix remain as is. And therefore, that's just something I want to call out, that this might not change as well into the future, because if it's not changed over the last 4 years, when the company has undergone tremendous transformation, this may well be the mix that we can continue to expect as well into the future.
And I think that also means that the company is able to understand as to what the consumer preference is, and their mix is therefore not changing. In terms of geography as well, there are expanding into strong cluster, of course populous clusters like UP as well as Bihar. They're entering into new states like Punjab, Bengal as well as Maharashtra. In terms of their overall footprint, Bihar has around 38 odd stores, Uttar Pradesh 35 odd stores, Odisha 26, Jharkhand 16, and MP and Assam has roughly 13 odd stores.
I again want to chip in here for a bit. So this basically, Bihar contributes nearly 20% of the store count. So does Uttar Pradesh. So these two combined would be nearly 40% of the store count. Just for perspective, they have 190 stores. So it's very important to understand this. The other piece is Odisha also contributes roughly 15%. So if I look at the top 3 itself, that's above 60% in terms of store concentration. And then if I add this 16 here of Jharkhand, that takes it to nearly
70 to 75
70 odd percent, right? So that kind of really adds up when you're looking at just the top 4 states contributing to 70%.
Correct. And these are the most populous states, right?
Absolutely.
With high rural penetration as well. So I think that is something that is working out well for the company.
Yeah. And then they're saying that 60 to 70% of new stores are also in existing clusters. Correct. They will focus in on the existing clusters and they will not go into new geographies. And even if they do, they'll be very cautious about it. So that kind of strategy, they are just focusing on what is working.
Correct.
The question after a point will be, is growth capped beyond a point if it's in the same geography? and if they don't find new geographies. But that's just maybe one of the risks. But anyway,
and that could probably keep their overall sales per square feet metric as well, because that is one of the key metrics to watch out for when we study a retailer.
Yes. So, the other thing, sorry, while we're talking geography, that really stood out when I was reading up on the company was the fact that their rentals have actually come down in the last 2 years. From 56 rupees per square feet, it's come down to 52 rupees per square feet. That kind of again stood out for me, because what they are saying is we'll focus not on even within the core geography, they will not focus on the most populous part of the geography. They will go slightly outside where rentals are slightly lower. And cater to the value market.
Correct.
That's the other thing that really stands out. Where have you seen rentals really come off?
Correct.
I mean, commercial, we've seen rentals go up, while they are seeing a very different trend, and that's kind of aiding their cost structure as well.
Absolutely.
But sorry, please go ahead.
And aiding their margins as well. I mean, we see that later as well.
Yes.
In terms of their store strategy, like he rightly mentioned, 60 to 70% of new stores are from existing cluster. Plus, I think one thing that's standing out again here is the kind of focus on their private labels. Not every company is able to scale that up. Focusing, even Trent has tried to focus on their private labels, and that's something that is working for Trent as a big retailer. Whereas your Vedant Fashions, your ABFRL has not been able to do that, but V2 Retail has been able to do that and has been able to scale that as well. In terms of manufacturing, they own a state-of-art manufacturing facility in Noida as well as Bihar. In terms of warehousing also, they're set to add a new 20 crore facility in Kolkata, and they also have an existing Gurgaon hub, which will support their overall future growth. Plus, interesting one here is that they use their own fleet to carry their overall inventory, and it's done. It's like a weekly process that they do. So that is also interesting. I think using that this metric as well, they're trying to have their control over how the company is working out their costs around, and that's how I think they're able to give the kind of guidance that they're giving in terms of margin as well as growth.
Correct. Design, manufacturing, and retail. They do all three across the value chain, and that kind of aids the numbers. But let's quickly look at the metrics that we look for with regard to a V2 Retail. We start off with the income statement. We look at the balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, as well as valuations. We'll look at all of those, and we'll try and give you a view with regard to each of those parameters. You want to start off income statement, Mahima?
Right, so I'll start off with the income statement. Of course, thumbs up here most certainly, because revenue 3-year CAGR has been an impressive 44%. EBITDA 3-year CAGR has been 61%, and margins also have been on a very good increasing trend. I mean, FY24 they stood at around 12%, 12.2%, which they've scaled to around 13.4% in FY25. Net profit has also grown threefold as compared to where it stood in FY24, and company became profitable, I believe, in FY23. So they've been not just able to maintain the profitability, but also scale in terms of their overall profitability, and that's why overall thumbs up when it comes to income statement. Even in terms of their operational metrics, it's important to point that out here. Since Harsh was also mentioning whether they'll be sustainable or not is one question, but FY25 same-store sales growth at 43%. I mean, no other retailer has seen this kind of same-store sales growth. Volume growth as well at 43%. Full sales price improved to 89%. Old inventory also reduced from 18% to 5%. Store economics, they added around 74 stores this year, and they plan to add 100 stores every year as per their guidance as well. And the last thing that stood out really well for me was that all of their stores become profitable from the first year itself, and they've said that the break even is at 500 per square feet sale. So that is also a very important thing and very interesting thing that came out of while reading the investor presentation.
500 per square foot. They do 750 to 800 in year one itself.
Yeah.
Thereafter, they scale up to 1000 to 1100 in 2 to 3 years. This is just for viewer perspective, so that you have the complete picture on how it goes about. The break even is, of course, 500 rupees per square foot per month. But let's look at the balance sheet now. In terms of equity, it's healthy in terms of the overall equity, the number on your screen. Look at also the borrowing number. Now, mind you, the borrowing number excludes lease liabilities. Lease liabilities typically should be excluded from a rental perspective for a model that V2 Retail typically follows. Cash and bank balance around 9 to 10 odd crore. So a thumbs up with regard to where the balance sheet is concerned. You want to talk about cash flow, Mahima?
Right, so healthy set of cash flow numbers as well. Cash flow from operations has nearly grown threefold from 93 odd crores to 223 crores in FY25. Plus the cash flow from operation to EBITDA ratio is also quite healthy at 89 odd %. Net cash flow has slightly decreased, but that is because of what you were mentioning earlier as well, because of trade payables going up. That could be one of the reasons as to why the net cash flow has been impacted, but overall a good set of numbers here as well.
Yeah, and so the other piece with regard to cash flow is that two things have happened. One is your working capital days have come down, and that's largely because your payables have gone up. Want to understand how sustainable that number is? There are reasons why that has happened. Won't delve into that in too much detail, but that's something you want to watch out for because that will impact cash flows going forward. Second, 220 crore odd of capex that is in the pipeline every year, of which 110 crore will be to inventory and another 110 crore in fresh capex for new store expansion. Stores typically take 1 crore or so in terms of capex per store. So 100 stores will likely mean 100 crore. Just kind of putting it out there. I fully aware that there's a lot of data out there, but let's talk about return ratios very, very quickly. Return ratios on an improving trajectory, can they sustain will be the question. That's the ROCE number, but look at the ROE. It's gone up to 23% this time around. Can that really sustain is the question. At least the number seems to suggest that it will sustain, but I'm giving this a cautious tone and therefore a neutral shareholding.
Right, so shareholding, interestingly here, this is one company where, at least that I have come across where promoters have increased their shareholding over a period of time, which was at 53.6% to now 54.24%. So that shows that promoters believe in the company and are ready to invest in the company. FI holding has however come down from 6 odd % to 1.3 odd %. DI holding has gone up in the counter from 0.4 to around 6.7 odd %. And overall public shareholding has slightly come down from the 38.8% mark to 37.7% mark. So I think overall a thumbs up, well held company.
Okay, street cred. Let's look at the last year or so. It's done 154% in terms of returns. So it's been a 2.5 bagger over the last year or so. Year to date up 10%, not a bad return either. And you're looking at 5-year returns of 34x. And therefore we've given this a thumbs up, the street cred. Valuations, Mahima.
Right, so valuations we've given a neutral rating here, and this is solely because it's both ways. The company is slightly cheaper than its peers, but at the same time at 26 times trailing 12 months, it's not cheap in terms of how valuations are seen. So that's the only reason why we've taken a neutral approach here in terms of how it trades and this is EV to EBITDA because a lot of other companies like Vedant Fashion or Arvind Fashions are still in losses, and that's why we've taken EV to EBITDA as metrics. But yeah, as compared to something like a Bazaar Style or something like a Vedant Fashion or FRL, it turns out to be cheaper. And interestingly, the FY27 estimated valuations go to around 11.5 times, which is quite a significant and quite an attractive valuations for an investor to look at.
Okay, now let's look at how your street coverage stacks up. Now there's just 2 analysts covering this one. 55% upside. Just given the limited coverage, we've been cautious. We've given this a neutral. Also, you want to quickly look at what the guidance is, and we've spoken quite a bit about some of these. 100 stores in FY26 over the next 4 to 5 years. They're expected to increase store count by 600 to 700. They're looking at a revenue growth of 45 to 50%. Same store sales growth of around 10%, EBITDA margin of around 8 to 9%. In fact, 2 years from now, the pre-Ind AS EBITDA margin, which is currently at 8%, is expected to go up to 10%. They're expecting ROEs to sustain. They're exploring franchisee model as well, but not under current consideration, but they're exploring it. No plans to enter premium. So all of that, we've given that a neutral. Plenty happening on this front. You want to watch out for all of those factors. Quickly on to how we rate this company. Finally, let's pull out all of the ratings. Let's stack them up and let's see how it adds up. There you go. Those are the 4 parameters. Let's look at the other 4. Let's give it the final rating, which is 6 out of 8. Not bad at all. No thumbs down either. So all positive. Or neutral. So that's the other big positive. But let's go across. We have Akash Agarwal, whole-time director. V2 Retail joining us. Akash, good having you here. I want to start off with understanding whether this kind of revenue growth clip of 45 to 50% is really sustainable. You're at 189 stores right now. You're on an aggressive expansion spree. 100 stores last year was expected. You did 75. This year also 100. How deep is the market, Akash?
Yeah, hi. Thanks for having me. So to answer your first question, the actual target initially for last year was around 50 new stores.
Okay.
But since we were getting such good response in all the new locations that we were expanding to, and the SSSGs were much better than what we had actually predicted or estimated. So that's why we increased the store opening guidance, and we opened 74 stores. And that is why, in fact, we have increased the guidance for the next few years also. And we are well on track to open 100 stores this year and for the next 3-4 years.
Right. Akash, hi. Mahima also joining in. Just want to get your sense on margins. You did almost 13% ending FY25. How sustainable is that range, and what will be the levers of growth from there on?
So we always try to talk about pre-Ind AS margin. So pre-Ind AS EBITDA was 8% for us last year. And the scope, the levers that we have to increase that and move towards 10% in the next 2 to 3 years. So one would be, leveraging additional stores by using the same head office cost and warehousing cost. So your costs per square feet come down. The second lever is selling more at full price, so having a positive impact on the gross margins. And the third lever is the way we move from 650 rupees to 1,000 rupees. So next target is to move up to 1,200 rupees per square feet per month. So these three things, levers, would actually help us move from a pre-Ind AS EBITDA of 8% to 10% in the next 2 to 3 years.
Akash, I want to understand how relevant is rural pickup in everything that you're doing, because rural is expected to pick up in FY26. One, are you seeing signs of that? Are you expecting that to happen? And how relevant is rural and rural growth from everything that you're anticipating in terms of pickup on the per square foot sale that you're penciling in?
So yes, rural is a big market to the customers that we actually cater to. And the good thing is the last 2 years there has been a rural demand pressure, and we've been able to show the kind of growth that we've been showing, more than 30% SSSG for 2 years running. So I think when the macroeconomic picture is better, when the rural demand comes back, then it should obviously positively impact us, and we are waiting for that to happen. But it's not an excuse. Even if that doesn't work, we're still working hard on all the strengths that we have shown in the last few years, and hopefully the momentum can continue.
Akash, just want to get your sense. Last when I was reading your con call, you did mention that the e-commerce execution was delayed because of some technical difficulties, but you are planning on getting into the e-commerce space via your own website. Just want to get an update there as to how the development has taken place, and where do you expect your overall online sales to go as a percentage of your total revenue, let's say 3 years down the line?
So we are making e-commerce just an additional channel for our existing customers. We do not want to burn money in acquiring new customers. And we do not want to do a centralized logistics system. So what we are planning is an omni-channel system where all the inventory at the stores can be leveraged and delivered to the customers in the same city. So hence it reduces a lot of costs, and we save on a lot of return costs also. But even at a mature stage, I would say it wouldn't be a very significant number. The e-commerce would constitute about 5 to 10% of the business after it matures. But like I mentioned earlier during the con call, that we don't want to start it with having doubts over the technology partner or the technology behind it. So we want it to be 100% robust and automated. And that is why the delays are happening, because we're still trying to figure out who will be the best technology partner to take us forward in our omni-channel hopes.
Akash, you're profitable, you're focused on profitability, you're focused on cash flow. Your cash flow has seen a bit of a turnaround in FY25. For viewer perspective, give us that perspective as to what has changed in FY25 versus earlier on the payables front especially, and can that sustain?
So there's a uptick in payables because earlier, so we have a subsidiary which has our manufacturing units. So about 20% of our sales used to be manufactured in-house, and the credit term for our subsidiary was 0 days. But that percentage has come down from 20% to less than 5% now. So that has positively impacted the working capital cycle because the average credit that we get from vendors is 45 to 50 days. And that is why you're seeing a much better cash flow from the credit working capital cycle.
Sustain, Akash.
Yes, so